People back here today. We had a wonderful day yesterday, really substantive and a lot of fun, and I'm sure we'll have the same today. So without further ado, I'd like to introduce Lord Guyte, Chair of the King's College Council, to give a welcome for the day.
Thank you very much, Rhys. Good morning, everybody. It's my very great pleasure to welcome you all to this, the second day of the second annual conference of the Qatar Centre for Global Banking and Finance at King's. I'm pleased to say we have a truly global audience for this event. Among our attendees are participants from several continents, from central banks, and from other public and private sector financial institutions, and from many of the world's leading universities. This is important because the challenges we face in our societies more than ever are overwhelmingly global, be it recovering from the pandemic, addressing the implications of the ongoing war in Ukraine, and those effects on the economy and food stability, or tackling the climate emergency, so that facing up to these challenges will require global cooperation. It's precisely therefore through events like this where we can share fresh ideas that improve the lives of people around the globe. It's a great pleasure to welcome the various distinguished speakers we have on the programme today, including Dr. Hugh Pill, the Chief Economist of the Bank of England, Sir John Cunliffe, Deputy Governor of the Bank, Cecilia Skingsley, the first Deputy Governor of the Swedish Riksbank, who I believe also has been recently appointed as the head of the BIS's Innovation Hub, and Professor Rangaran Rajan, a former Governor of the Reserve Bank of India and Chief Economist of the IMF. Finally, I would like to take this opportunity to say how very grateful we are to Qatar Central Bank for the strategic vision they had in supporting this centre, and for the counsel and insight that has guided this development so far. I'm sure His Excellency Sheikh Bandar and his colleagues will agree that it's been a joy to see the development of the centre over the past 2 years, and particularly the strength of the links that have been created across academia, the central banking community, and with those working in the financial sector. So with that, I wish you all an intellectually very stimulating day of discussion and debate. Thank you very much.
Thank you very much for those remarks. So it is my pleasure to introduce Dr. Pill. It's difficult, perhaps, to design a CV more appropriate for the role he now holds, or for speaking to such an audience as this, than the one he's accumulated over many years in policy, private sector and academia. In terms of institutional experience, a CV featuring Oxford, Stanford, Harvard and various policy and private institutions is a good start. But the substance of Dr. Pill's experience while at these institutions makes him even more suited to these challenging times. So as the title of our conference suggests, the world of central banking is in flux. But of course, the past can be some guide to the best way forward. Dr. Pill has produced well-published academic research on financial liberalization, fiscal rectitude, or the lack thereof, and is a specialist on the functioning of money markets, the money transmission, and central bank mandates, all topics that are in stark focus today. As we heard yesterday, the interactions between monetary and fiscal policy have become tighter in recent times, at least in some people's eyes, and having a policymaker with such a firm grasp of the breadth of issues involved is a boon for the bank and, of course, the wider central banking community. The nuts and bolts of the first steps of the transmission mechanism have gone from being fringe back-office discussions to being front and centre of monetary policy communications. The ability to communicate policy in this new environment is key, where the old textbook monetary policy is out of the window, the previously unconventional is now very conventional, and where engagement with financial markets, especially as some central banks unwind their balance sheets, is at the heart of policy concerns. Dr. Pill's experience here in the public and private sector and knowledge of, say, Target 2 intricacies are very timely. Indeed, with an eye on our CBDC panel later today, it's also a real advantage that as payments technologies innovation is a pressing topic, we have an economist who is as comfortable discussing abstract policy topics as he is the plumbing details. Certainly as central banker's central banker, it's my pleasure to welcome Dr. Pill to the stage.
Thanks. So good morning, everyone. Let me just put my slides up. How do I do that? Here we go. So good morning, everyone. It's a great pleasure to be here to speak at King's College and the Qatar Centre this morning. And I'd like very much to thank the organisers of the conference for their invitation and their hospitality. So I thought I should start by explaining the title of my speech. So the first part, which is English, I think is pretty self-explanatory. It's neither obscure nor very original, but it is very important. Returning inflation to target is where I'm going to focus the bulk of my comments this morning. The second part of the title, which is in Welsh, requires a little more explanation. It's a nod to our hosts and my nationality, and indeed the nationality of Rhys as well, who just introduced me. For the first time since 1958, Wales have qualified for the Football World Cup, which of course will be held in Qatar this year. So there's a connection there. During that qualification process, Welsh football fans have embraced Davin Ewan's folk song, Yma o Hyd, as their kind of theme. This was a song originally written as a tribute to the resilience of the Welsh language over the centuries, and its anthemic chorus states, and I don't know if there are any Welsh speakers here, so I will not, as a non-Welsh speaker, I won't offend you, so I'll only report in translation. The anthemic chorus states, "In spite of everyone and everything, we are still here." Now that might sound a little bit melodramatic in a sporting context, but for someone who's lived through the trials and tribulations of various Welsh qualifying campaigns for international football tournaments over the last few decades, it actually captures the roller coaster psychology of that experience pretty well. But now that Wales have finally qualified for the World Cup and brought 64 years of pain to an end, perhaps it's time for Welsh fans to pass that song on to another constituency. And of course, I have one to recommend: central bankers. Because surely if there's a group that needs to show the persistence, the patience, and above all, the perseverance necessary to achieve its goals in the face of adverse circumstances at the moment, it's today's monetary policy makers. As an MPC member, I'm not here to seek your sympathy in the face of those challenges. Rather, I hope to convince you that, in spite of everyone and everything, we on the MPC are still here, and in the face of those challenges, we will deliver inflation back to its 2% target. So in my remarks today, I aim to make 3 points. First, I want to emphasize the MP's focus is on returning inflation to that 2% target. Second, I want to recall the drivers of recent inflation developments and how they've shaped the MPC's policy actions. And third, I want to restate and unpack the MPC's most recent communication about the outlook for monetary policy decisions. So working through these 3 points has the character of peeling an onion, progressively working from the most visible public comments towards more detailed technical or detailed arguments. And I hope each of the different audiences that I seek to address today, not all of which are in this room, from the wider public through the media and market participants to the experts attending this conference, can find some layer of that onion that speaks to them. So let me start with some broader comments aimed at the wider public. Given today's high level of inflation, it is time for plain speaking. In recent talks, I've offered more detailed discussions of the mechanics of monetary policy, on topics like quantitative tightening, activism, and portfolio balance effects. But today I want to speak, at least for the moment, more directly, more simply, perhaps more bluntly. That's not to deny the complexity of the challenges the MPC faces and the finely balanced character of the decisions it has to take. We've entered a new phase for monetary policy. Risks to the economic outlook are two-sided. As the governor has said on several occasions, the MPC has to navigate a narrow path in managing these risks. On the one hand, ensuring that the current elevated level of headline inflation does not become embedded in inflation expectations and price-setting behavior. And on the other hand, weighing against the current squeeze on real incomes that threatens to create slack in the economy and downside risks to inflation further out. I anticipate that we'll have time to discuss these complexities in the QA that will follow, and I hope to leave plenty of time for that. But first I want to reiterate the commitment I gave in my first interview on joining the MPC last autumn. I see my role as an MPC member as being in the price stability business. That means returning inflation to the 2% target in a sustainable way. If there's one message that the wider public audience should take away from my remarks this morning, it is that. Returning inflation to 2% is at the heart of the MPC's actions over the past 10 months. Ceasing asset purchases, starting to raise bank rate, beginning to shrink the asset portfolio. All these actions serve to tighten monetary conditions and weigh against inflationary pressures. Of course, there's always a question of whether these actions should have come earlier or been more aggressive. In assessing those claims, we need to be wary of hindsight bias, and we need to recognize the benefits of adopting a measured, determined, and purposeful approach to the transition from the very accommodative policies introduced during the global financial crisis and maintained more or less ever since. But now that the initial stage of that transition has been successfully navigated, an immediate issue for monetary policymakers is whether the pace of policy tightening now needs to change. In May, inflation reached 9.1%. The MPC forecasts, as you can see on this slide, a further rise to around 11% later in the year, once rises in international commodity prices stemming from Russia's invasion of Ukraine pass through to UK utility and food prices. For an MPC member charged with achieving the inflation target of 2%, someone in the price stability business, if you like, this is obviously a very unsatisfactory situation. But that discomfort pales in comparison with the challenges facing those most directly exposed to the current cost of living crisis. For those who spend a high proportion of their income on energy and food, unfortunately, a group particularly numerous amongst the less well-off, recent price rises have imposed a significant squeeze on their real incomes. These are obviously difficult times for many people. Our current experience is therefore a salutary reminder of the importance of price stability. It reminds us why having the MPC in the price stability business remains so crucial. It explains why bringing inflation back down to target is essential so as to reduce the uncertainties facing households and allow firms to plan for the future. Achieving price stability serves as an anchor for wider macroeconomic stability and prosperity. The institutional framework for monetary policy here in the UK, an independent central bank held to account for its pursuit of an explicit inflation target, is in place. For the first time in its 25-year history, that framework is being put to the test in an inflationary global environment. We have to meet that test successfully. Achieving the 2% inflation target is now more important than ever. In the MPC, we have both the tools we need and, perhaps more importantly, the resolve it will take to restore price stability. And even in the face of current challenges, I'm confident that we will succeed. So let me turn a little bit more to the more detailed debate. If that commitment is as strong as I claim, it begs the question of how we've ended up in the current situation with inflation so uncomfortably high. Answering that question requires that we delve a little further into recent economic developments, peeling back another layer from the onion. So let me turn to the question of what's caused the recent jump in inflation. In large part, recent price developments have been driven by a succession of unanticipated external disturbances to the UK economy. Among others, the COVID-19 pandemic and its aftermath, and the Russian invasion of Ukraine. In the jargon of economics, we label this a sequence of adverse external shocks. I think 4 features of these disturbances are worth emphasizing this morning. First, they were genuinely shocks in a specific technical sense. They were not, and perhaps more importantly, could not have been anticipated. Second, they've transmitted into UK inflation relatively quickly. Just for a moment, I'll focus on the impact of higher international oil and gas prices on consumer price inflation. The direct implications of these external shocks for UK price developments transmit within a matter of months, even with the added complications created by this Ofgem price cap mechanism that we all unfortunately know a little more than we wanted to about now. Higher European wholesale gas prices entered UK utility prices, and thus UK CPI inflation that we target, within half a year. Moreover, many of the subsequent indirect implications of higher international energy prices, that's to say, their impact on a wider set of UK goods and services prices via, say, higher transport or utility costs, are already also being felt. These indirect effects account for part of the widening incidence of above-target inflation developments across a broad set of core goods and service components of the overall index. Third, these shocks have been large. Again, it's useful to use energy prices as an example. Looking at the daily data, from its trough in May 2020 at 8 pence per therm, spot UK natural gas prices have risen to above 500 pence per therm in the immediate aftermath of the invasion of Ukraine. Taking a somewhat wider perspective, we've seen wholesale European gas prices rise by more than 300% over the past year, while electricity prices have risen by 30% and oil prices by 50% over the same period. And indeed, as you can see a little bit in this chart, wholesale gas prices have surged again in recent days. Fourth characteristic of the shock I want to emphasize is that since the UK is a net importer of goods and energy, these large increases in international goods and energy prices represent a deterioration in the UK terms of trade. Simply put, the goods that the UK buys from the rest of the world have become more expensive relative to the services it sells. Other things equal, this will weigh on the international purchasing power of UK residents. In practice, we anticipate a squeeze on UK household incomes, which will constrain domestic spending and demand, and threatens to open up a margin of slack in the UK economy and eventually lead to higher unemployment. So it's not just UK inflation that's been affected by these large external price shocks, but also UK incomes, spending, and potentially employment too. The four nature characters of these shocks that I've described has important implications for monetary policy. It's a famous dictum that monetary policy affects inflation with long and variable lags. While these lags are difficult to predict and likely to vary across time in concert with the broader state of the economy, we typically think that monetary policy actions taken today will have their maximum impact on inflation at a horizon of 18 to 24 months. By implication, monetary policy cannot entirely offset the impact of external price shocks on UK inflation. And attempting to do so may serve to add to rather than contain inflation volatility. As we've seen, as I've just said, higher energy prices feed through to CPI inflation within a matter of months via both direct and indirect effects. If a rise in international oil or gas prices is a genuine shock, in other words, it couldn't have been anticipated, then even an immediate monetary policy response would not be able to offset its initial impact on UK inflation. The offset would only feed through as the lags in policy transmission unwind. As a result, even very active employment of UK monetary policy cannot prevent the emergence of some short-term volatility in UK CPI inflation. And what's more, given the uncertainty surrounding both the lags in monetary policy transmission and the direction and magnitude of further external price shocks, the danger exists that attempts to fine-tune inflation developments using monetary policy become a source of volatility in themselves. Policy actions may turn out to be ill-timed or miscalibrated in the face of these uncertainties. There's thus an inevitable short-term volatility in UK inflation, which monetary policymakers have to live with. And when the shocks that drive short-term volatility are large, as they have been, then the amplitude of the short-term volatility inflation will also be large. This story remains an important part of the explanation for what the UK has experienced of late. Recognizing the impossibility of fine-tuning inflation developments on a month-to-month basis, the MPC has long emphasized its focus on achieving the inflation target over the medium term. This medium-term orientation of monetary policy is crucial if the inflation target is to be met in a sustainable manner, and monetary policy is not to become a source of inflation volatility itself. At present, the desirability of adopting this medium-term orientation is bolstered by the nature of the underlying drivers of UK inflation. The large rises in the prices of international goods and energy not only directly raise UK inflation, but also weigh on domestic incomes and demand through the terms of trade channel. As a result, in taking monetary policy decisions today, the MPC needs to take account not just of the immediate inflationary impact of higher energy prices in the coming months, but also the potential disinflationary impact of higher energy prices through these weakening of incomes and demand at longer horizons. Weighing up these two forces is central to the baseline projections published by the MPC in May, and the framework defines the difficult, narrow path that I mentioned earlier, which the MPC has to navigate over its forthcoming meetings. Further complications for monetary policy stem from tightness in the labour market and the strength of corporate pricing power, at least in some sectors. The tight labour market owes largely to weakness in labour supply rather than the strength of labour demand. UK GDP is still only slightly above pre-pandemic levels, despite unemployment rates falling back to the low levels seen ahead of the lockdowns. Its higher rates of inactivity amongst UK workers following the pandemic, on account of early retirement and a rise in long-term sickness, as well as the impact of Brexit on the flexibility, cost and availability of EU workers, which appear to have weighed on labour supply. So with vacancies and hiring still strong, nominal wage growth in this tight labour market environment has risen to levels above those usually deemed consistent with achieving the inflation target. And in parallel, firms are trying to re-establish their profit margins. As consumer demand weakens, corporate pricing power is becoming more concentrated in the business-to-business sector. Supply chains continue to be disrupted owing to the fallout from the pandemic and the invasion of Ukraine. But for each firm that reports difficulty in obtaining components necessary for production, there's a supplier facing strong demand with significant pricing power in that supply chain and the ability to pass higher costs along the value chain. It's in this context that we see that one way of viewing the interaction between external price shocks and domestic price, wage, and labor cost pressures would be to see the two stories as additive. In that case, UK inflation is high, both because of the direct and indirect impact of higher international energy and good prices, and because of the impetus to domestic inflation imparted by the strength of wage growth and corporate efforts to re-establish profit margins. But an alternative and perhaps more worrying view would characterize the impact of the two drivers of UK inflation as multiplicative. The strength of corporate pricing power, the tightness of the UK labour market, and the real income squeeze on UK households all make it more likely that the impact of higher international goods and energy prices will extend beyond their direct and indirect effects that I've already mentioned and translate into second round effects in wage, cost, and price setting. In other words, UK price setters and wage bargainers will try to offset the impact of higher headline inflation on their real spending power by seeking higher profit margins or higher wages in order to preserve their real incomes. Crucially, this threatens to create more persistent inflation dynamics in the UK, which continue even after the original impetus from external sources has dissipated or even reversed. It's via such second round effects that higher current inflation can become embedded in the inflation process and achieve a self-sustaining momentum all of its own. Such behavior would threaten a more sustained deviation of inflation from target, going beyond the realization of this shorter-term volatility, that inevitable shorter-term volatility that I already mentioned. So to emphasize, because the inflation implications of second round effects are more persistent, they're more relevant to the pursuit of the inflation target over the medium term. But for the same reason, they're more amenable to influence by monetary policy actions that operate through these long and variable lags. So by nature, it's the persistent inflation dynamics will continue even while the lags in monetary policy transmission unwind over time. And the difficulty of timing monetary policy actions precisely that I mentioned is less onerous when addressing these more persistent and thus lower frequency developments in inflation. So these are the reasons why the MPC has tended to place more weight on the evolution of domestic price and wage setting in assessing UK inflation. It's not because it's a domestic component, even though it is, but it's because it's a persistent component of inflation, which matters much more in inflation, in achieving the inflation target sustainably. So having already discussed some of the key considerations governing my assessment of the policy outlook, I'll conclude with a few remarks on MPC communication, centered around the statement published in the aftermath of the June meeting. This represents yet another peeling of a layer off the onion I mentioned. In both the media and among market participants, there's a cottage industry seeking to interpret central bank statements, and I've been part, as Rhys said, of that industry in the past. Those still working there don't need to worry. I'm not about to put them out of business, and I'm certainly not going to pre-announce my MPC vote for August today. But of course, there'll always be attempts to interpret any central bank communication for clues about the policy outlook. That's both inevitable and indeed sought after by policymakers. After all, what would be the point of making statements if you hope they'll be ignored? But I'd caution those interpreting such statements against reading them slowly through the lens of so-called forward guidance about the immediate outlook for interest rate decisions. As I've said in the past, I'm skeptical of forward guidance as a tool for central bank communication and policy, at least when it's understood as providing a definitive view of the short-term interest rate outlook. If you like, what's sometimes called forward guidance with a capital F and a capital G. On my reading of the evidence across jurisdictions, experience of using such forward guidance is at best mixed. On occasion, it started well, but almost uniformly, it's eventually ended in some confusion. At a time when policy rates were stuck at their absorbing effective lower bound, a case for forward guidance could be made on the grounds that it allowed for further monetary easing by flattening the forward interest rate curve when the conventional approach of lowering bank rate was no longer available. But, at least for the present, that case no longer holds, now that rates have risen, now actually quite comfortably, into positive territory. If policy easing were to be required, bank rate could be raised more slowly than currently anticipated, or even reduced if necessary. Forward guidance can also help contain interest rate volatility while policy is uncertain. As central banks were making the difficult transition away from the very accommodative policy settings first established in the face of the global financial crisis and maintained more or less ever since, a case could be made that forward guidance, capital F, capital G, has helped to ease and support that shift. It's on that basis that I, somewhat reluctantly, acquiesced in the further tightening language embodied in MP statements through the turn of the year. But now, asset purchases have ceased, bank rate has risen, the QE asset portfolio is shrinking, and gilt sales are under consideration. The transition from one phase of monetary policy is better established and better understood. As a result, the case for maintaining forward guidance to smooth the transition is, at least in my view, much diminished. So on this basis, the further tightening forward guidance language that's been in place in MPC statements since last November, despite its evolution over the intervening months, has come to outlive its usefulness. So speaking from the collective perspective of the MPC, using forward guidance of that form requires near unanimity across members of the committee if it is to be meaningful. But as the patterns of individual votes on bank rate in recent months has revealed, unanimity about the short-term interest rate outlook no longer exists. We shouldn't be defensive about that. One of the strengths of the MPC setup is its individual accountability and the diversity of view that encourages. At a time when inflation is elevated, monetary policy faces substantial challenges, and uncertainties heightened by geopolitical and epidemiological concerns, it would not only be surprising, but also worrying if all MPC members moved in lockstep. For all the commentary about groupthink on the committee, I see little evidence of that, either in our internal discussions or in our published votes. But trying to shoehorn that necessary and constructive diversity of opinion into a common statement is understandably and probably inevitably confusing. It's certainly hard to encompass the prevailing diversity of opinion into a short and clear statement of forward guidance, capital F, capital G. And if, in that context, attempts at guidance create more confusion rather than more clarity, then surely the time has come to retire them. Taking a more personal point of view, there are several reasons why I supported the move to our new form of communication in June. In particular, the further tightening language previously employed could not be maintained indefinitely, at least not without taking the ultimately indefensible position that the level of interest rates did not matter. More generally, I repeat, such guidance is a trap, attractive at the outset, but difficult to exit from gracefully. Moving to a new form of language, without the capital F, capital G forward guidance, reflects that reality. So where we have ended up is captured in the language on this slide. So to conclude, I'm just going to offer a few observations on this language from my perspective. First, by focusing on the scale, pace, and timing of further changes in bank rate, the statement clearly widens discussion beyond the interest rate decision at the next meeting. In my view, this represents the desirable introduction of greater flexibility into our communication about the policy outlook when compared with the previous language. It thus reflects the uncertainties we face and the likelihood that we will have to take finely balanced decisions over rates, not just in August, but also beyond that, in the front of these two-sided risks to the economic outlook over the next year that I've discussed. Second, by referring to any further increases in bank rate, the introduction of this greater flexibility has not obscured that the next change in bank rate is more likely to be in one direction than another. We're talking about rate increases, not rate decreases. Although I admit at the same time, by saying any increases, we do allow for the possibility of rates remaining on hold, which, at least given some of the votes we've seen from the committee over recent times, is something that couldn't be ruled out. Third, the statement also gives an indication of how the MPC intends to respond to future developments. In line with the argumentation I've already offered, it emphasizes that the MPC will be focused on indications of more persistent inflationary pressures, which, in my view, places emphasis on identifying potential second-round effects in wage and price-setting behavior. This language has helped to clarify how the MPC defines its policy reaction function at present, prioritizing more persistent trends in inflation over the headline spot measure. Fourth, by signaling preparedness to, if necessary, act forcefully in response to indications of greater inflation persistence, the statement reflects my willingness to adopt a faster pace of tightening than implemented thus far in this rate cycle, while simultaneously emphasizing the conditionality of any such change in pace on the flow of new data and analysis. Much remains to be resolved before we vote on our August policy decision, and how I vote on that occasion will be determined by the data that we see over the coming weeks and my interpretation of it. And finally, fifth point, harking back to my opening section of my remarks, the statement places, in red on the slide, a direct and clear emphasis on the MPC's commitment to return inflation to target at its heart. This is something all MPC members agree on, and it's the main message addressees of the statement should extract. As I said earlier, it's also the message I would like all of you here in the room, in the media and financial markets, and among the general public to take from my comments today. Yma Ohid. The MPC is still here, and in spite of everyone and everything, we will return inflation to target. Thank you very much.
Diolch yn fawr am eich araith ddiddorol iawn.
I won't try and respond in kind.
Thank you very much for your interesting speech. I must point out that David Aikman also is Welsh, so we're coming for you. A very interesting speech. I have a question of my own quickly, but before that, maybe people could put their hands up and I can take down some names for questions. Gulchen. Hannah, David. Fascinating. I think the message came through. You're in the price stability business, and I assume that's somewhat reflected in the simplification and just getting back to basics about what you're aiming for and the language we see there. So it seems to be quite a lot about anchoring inflation expectations in some sense. Do you identify that with second-round effects? So second-round effects to me is a somewhat distinct concept. You spoke a lot about cost pass-through, which I think of as second-round effects. I assume you're not simply monitoring wage pressures and cost pressures. What are you looking at in terms of inflation expectations, and how does that fit into these second-round effects, as you call them?
Well, I think I think you identify a pretty key point, and I think it's a key point of focus of the committee. And to be frank, it's a key point of different views within the committee. This diversity of opinion that I've mentioned, and I think people in this room who've worked on looking at monetary policy in emerging markets will probably, back in the day of the 80s and the 90s, stabilization programs, will probably be able to engage in this. I mean, there's one view of the inflation process puts a big emphasis on second round effects being a sort of catch-up. So we see realized inflation, and then wage, cost, price setters are all trying to catch up to restore margins, restore real wages, and so forth. And that's essentially a sort of backward-looking process, because today's spot inflation, which we're trying to cap up with, is a reflection of price developments over the last 12 months. So if that's what's driving behavior, as headline inflation comes off, and as you saw from our forecast, we expect it to peak towards the end of this year and then come off, then you expect that pressure to sort of catch up will diminish, because headline inflation is itself diminishing. So that's sort of a backward-looking form of second round effect. And that doesn't put a big weight on inflation expectations. In fact, it sort of assumes that inflation expectations remain well anchored over the medium term, which is the very heart of the inflation targeting strategy that we have. But there's an inevitable pass through the economic system of this external price shock that works itself also through domestic wage and cost pressures, a kind of pipeline story, if you like. The alternative interpretation of what we're seeing is that those developments in wage, price, and cost behavior, margin behavior, are actually forward-looking. And there is a concern about whether they are becoming de-anchored from the inflation target. And of course, if that's the case, then that would be much more worrying from a monetary policy point of view, because it would suggest that we are moving away from the anchor that the inflation target provides. So I think there's kind of two policy implications of that. The first policy implication, which you've already identified, I think we've seen that in various forms of speeches and other comments from members of the MPC and others over the last few weeks, is that we are emphasizing, rightly in my opinion, and hopefully strongly, I've tried to be strong about it today, is that we will do what is needed in order to bring inflation back to target, in order to stabilize and emphasize the commitment to that as the anchor to the whole system. And I think we are still there. We still believe that we have inflation expectation anchored, and we will monitor this process of the pipeline effects, the passing through, to ensure that what we're seeing is consistent with this more backward-looking view of how second round effects are operating, and is not seeping into this more forward-looking view, which would create concerns about the anchoring over the medium term.
And apart from monitoring, say wages, what else are you particularly focusing on when you're checking for this anchoring?
Right. Well, I mean, wages are important, but they're not the only thing. We are very fortunate in the bank, and thanks to efforts of some of the people in this room, we have a very rich set of information that we collect. We do a number of surveys, both surveys looking into the labour market, into the household sector, but crucially also into the corporate sector. And we're supported in that actually with other surveys that have been done by ONS and others, including private sector surveys. So one of the surveys that I think plays quite a big role in our thinking right now is this decision maker panel survey that the bank has done. And that asks very direct questions to a very broad set of companies about how they see their input costs, the price of what their inputs are, how that's evolving, how they're seeking to price in terms of outputs, and implicitly, as a result, what pricing power they have in trying to reestablish their margins. And I think where we are right now, as I went into perhaps more detail than was required in what I said, is trying to understand how that margin behavior works is pretty key in understanding where we think inflation is going to go. The sort of bigger picture here is, owing to these adverse terms of trade shocks, the squeeze on real incomes and so forth, we are expecting the economy to slow. We're not expecting really to see any growth in the economy over the next year or so. And ultimately, we are expecting, or forecasting at least in the forecast we published in May, to see unemployment rise. I mean, this will create the slack that weighs on the inflationary pressure. Not all of that slack is being created by monetary policy actions. A lot of it is slack that's created as a consequence of the real income squeeze coming from these external shocks. But nonetheless, that slack will itself weigh on the inflationary dynamics. So in that environment, the key question is, we are already seeing evidence of consumer demand in the economy weakening. Consumer surveys have turned down quite aggressively, and as a result, we anticipate seeing consumer-facing businesses seeing less demand, having less pricing power, and their ability to raise prices being diminished. But a sort of key open question in all of this is whether business-facing businesses, so firms within the supply chain, we hear a lot about the disruptions in the supply chain, the difficulties of getting components. And what I was trying to hint at earlier is, for every firm that's saying we have difficulty getting our components, there's a supplier of that components that feels like it's facing strong demand and has a lot of pricing power. And so it's within that business stability, within the supply chain, that we think that this kind of margin cost pressure can emerge. So sort of key question in that context is how quickly and how extensively that diminishing of consumer demand, which is already influencing consumer-facing businesses, work its way back through the supply chain, as hopefully the supply disruptions which are operating in the opposite direction also ease as the pandemic and the impact of the invasions recede.
Interesting. Hanno, you had your hand up earlier. I think there's a microphone coming. There we are.
Can you hear me? Okay. Well, this was very informative. Thanks for giving an interesting overview of the drivers of inflation. One thing you didn't mention in your overview was sort of the role of real interest rates. As you know, right now, especially at the short end of the maturity spectrum, the implied real interest rates are really deeply negative, not just here in the UK, but also in the Eurozone and in the US. And I was wondering if you could comment on what kind of role that plays, if any, in the inflation dynamics, and also how you would judge when these real rates have sort of returned to a level that you think is appropriate.
Do you want me to take a few, or?
We can do whatever you want.
Sure. Gulshan?
Thank you. Gülçin Özkan, King's Business School. I would like to ask about the fiscal side of things. How much do you worry about the potential for public debt burden, given the unprecedented debt to GDP levels, in addition to what might happen to the aggregate output?
You had a question, I believe.
Getting your steps there, sorely, thank you. My question was going to be very similar to Hanno's, actually. So if you took like a naive Taylor rule perspective on where rates should be, you'd be hundreds of basis points north of the current position. So I guess my question in a high-level sense is, like, do you think you're stimulating the economy or contracting the economy with the current stance of policy?
Okay, so those are good questions. I think they're not necessarily very easy questions, but I wasn't expecting to have easy questions. Maybe the easiest answer I can give to a very difficult question is on the fiscal side. So, I mean, it probably won't surprise you that I'm not going to make big statements about fiscal policy. I mean, I wouldn't have done that anyway, but in specific circumstances, I'm even less likely to do it. So I'm not going to make big statements about that. I mean, I think it is key to say that, you know, through QE, the bank and other central banks around the world have become engaged in holding and the issues of public debt in ways that go much more extensive than was the case 20 years ago. But I think it's also important to say, speaking from the perspective of the MPC, that we are making decisions on rates and on our asset portfolio focused exclusively on achieving our objective. So we are going to do what we need to do in order to get inflation back to target, using the tools at our disposal, which are setting bank rate and managing the portfolio of assets that we have as a result of the quantitative easing program. And we're not going to be deflected from that objective, that channel, through fiscal concerns. It's for others sitting in other parts of town to deal with the fiscal issues. So then on the two questions around, I mean, I could couch them in terms of, you know, R star and so forth. R-star famously is a difficult thing to estimate. It's even a difficult thing to know what it is, let alone how to estimate it. And I'm skeptical that we either know enough or agree enough to have that as a useful real-time indicator of monetary policy. So I don't want to sort of engage in a discussion of saying, well, we're a bit above or we're a bit below or so forth and so on. I think that's almost impossible to know in real time. What I will say, though, is that when we look back at this with the benefit of long hindsight and we're looking at it in a historical context, we will see whether we were more or less stimulatory. I think the big picture for me is that we've spent most of the last 15 years in an environment following the global financial crisis where monetary policy was in a very supportive mode, right? So interest rates were floored at the effective lower bound. They were pushed into this absorbing state. And as a result of that, when it came to the need for more easing, we moved into a quantitative easing framework, which was more by force of circumstances rather than desire, because I think there were lots of good reasons not to get involved in fiscal issues indirectly through holding large amounts of public debt. But anyway, we got there, and that was in a world where, in the aftermath of the financial crisis, through the fallout from the Brexit referendum, in the early stages of the pandemic, in the European sovereign crisis, there was downside pressures on activity, there were stresses in the financial system, and above all, there were downside risks to price developments, so below the inflation target. So monetary policy should be easy, was easy, and there was no real trade-off being faced there, right? On all dimensions that you might think about, crucially including the key focus of achieving price stability, but also on supporting activity and supporting the functioning of the financial system, it was all in one direction. I mean, I think what we're seeing now is we're moving to a very different phase of policy. This is what I mean by we're facing two-sided risks. And it's important why I try to emphasize that the nature of the external shocks to the UK economy that we've seen over the last year are trade-off inducing shocks. They've tended to push inflation up directly, but they've also tended to weigh on real income and demand, and so pushing down activity and threatening downside risks to inflation at longer horizons. The MPC's forecast, published in May, has inflation below target at the 3-year horizon, right? That's something which is often missed in the current debate. Now, whether that's a good forecast or a bad forecast, we can debate, but I mean, there's a lot of smart people in the bank who are producing that forecast. So I guess my point is that we're trying to manage our way in a lot of uncertainty and balancing these two-sided risks. And I think what we've been doing is, in this purposeful way, focused on our target, withdrawing that monetary accommodation, making a transition to what should be a normalization of policy, moving to having to move at least to a tighter monetary policy and maybe even a restrictive monetary policy. But there's an element of experimentation in doing that, right? We will know with the benefit of hindsight, considerable hindsight, whether we were above or below R-star. But in real time, we're always going to be saying, do we need to do more in order to contain short-term inflationary pressures and ensure that we get back to target sustainably over the medium term? So that sounds like I'm avoiding your question, but what I think it's trying to do is describe what at least I see we are doing, which is I don't have a concept of there's a Taylor rule number out there or there's an R-star number out there. We need to jump to it. We need to jump above it in order, right? Because I just don't know what that number is. But what I do know is relative to where we've been, we need to be tightening. We have tightened. I think we probably need to tighten further. And the key question now is the pace at which we're going to go from here.
Questions? Questions, please. George? Sorry, there's a mic, sorry, just behind you.
It's a bit of a follow-up to question of risk, but perhaps more from a statistical point of view. Do you think that inflation persistence has increased or decreased compared to previous instances of big shocks? And the second question is, in trying to figure that out, do you see any role for models in putting together all the various factors you have in mind, or do you think we're just in a very uncharted territory and you just need to use judgment instead?
At the back, I can't quite see who it is, so please identify yourself when. Oh, it's Ben. In the middle at the back row. Thank you.
Can you hear me? Ah.
Yep.
I think I'm right that the mortgage stock has become more fixed in the last 5 years. So in the context of your long and variable lags, does that suggest a change in the sort of target horizon for inflation, or does it mean that you're more minded to move in larger increments in the near term? Thank you.
And actually, I have one question myself. I think I read recently, it may have been you making the comment, I think it was certainly coming out of the Bank of England, there was a comment comparing the fact that the bank had started raising earlier and more gradually relative to, say, the Fed later and dramatic. How do you, in your own mind, regardless of whether or not either of those paths is correct, how do you think of the effect of like a slow gradual increase versus a rapid one starting from now when the effects might begin to happen? Because I think I saw that comment, and maybe from a speech of yours.
Yeah. So the questions haven't got easier as we progressed, I have to say, and those are all very good questions, but also I think quite challenging questions. So to George, I think the question you're asking is like at the heart of the policy debate. So what I was trying to say today, and I know this is a policy response to an intellectual question, so I'll try and come to that in a second, but it is about persistence. So for all the reasons were implicit in the speech or explicit in the speech is we can't offset shocks to the price dynamics that pass through within a year, because by the time we've acted, they'll already be out of annual inflation and we'll be influencing the post-shock environment, and maybe we're actually going in the wrong direction there. So there's no kind of easy solution for high level of inflation today saying, well, let's just raise interest rates a lot, because by the time we get to the point where those interest rates are affecting the economy and affecting price developments, maybe we're in a different situation. So, recognizing that and seeing we have to have this calibrated, measured approach seems to me to be important. Now, of course, behind that is the view that the big spike in inflation now is a spike, right? And of course, there's two ways of thinking about that. One way is the way I tried to emphasize in the way I responded to Reece, which is to think through the economics of that. And that's probably the way I would favor, in the sense that we need to understand the behavior of the firms, the behavior of the wage bargainers and so forth that are actually setting prices. And we use the type of information from surveys and so forth. So in that sense. Now, of course, there is a question about, can we model that in a way that gives us definitive answers? I think we are in a different regime. That's my point about this transition. So maybe we need new models. Certainly, models estimated on the evidence of the last 15 years of very accommodative monetary policy may not be so appropriate. Arguably, models estimated on the data of the last 25 or 30 years, an environment where inflation wasn't subject to these big external shocks, at least of the magnitude we are seeing now, maybe that's not. So, people say, well, you have to go back further. But the world of the oil price shock was a very different world in lots of other dimensions. So, I'm telling you your own business here, but, models are difficult things to do in trying to reflect structural changes in the economy. And behind that, there's a kind of question around, is the persistence of inflation something intrinsic to inflation itself? Or is it something kind of more extrinsic and part of the economic behavior as a whole? And I guess the way we are thinking about, at least the way I'm thinking about it, is that we have to think more about the second. Because if it's the second, then that would suggest there's something we can do about it. We can try and stabilize longer term inflation expectations, and we can act on the economy to try and cool off the labor market, if you like, to try and get the right amount of. So that's the way we are thinking about, I think, from a more policy making point of view. If inflation is just intrinsically more persistent, I think there's a case for saying, well, our ability to steer inflation close to target on a day-to-day basis is going to be even more difficult. But the costs of not keeping inflation close to target are just going to be higher. So it's only adding to the reason why focus on price stability and so forth is so important. But I think you're right, and I know you were engaged with some of my colleagues. So I think we do need to try and develop these models. We need to have a scientific approach, and we need to use some of the data I mentioned earlier in my response to David. We need to think about how we can, use that within a modelling framework to produce consistent results that we can evaluate over time. I think the question on mortgages is right. I think as a fact you are correct. There are more fixed mortgages. There's also more scope to remortgage, so I don't think it's necessarily quite so clear in terms of how quickly the transmission takes place. And it also should be emphasized that the fact that there are more fixed mortgages means you've still got a lot of people who are about to come off mortgages they fixed, say, 5 years ago, that are now facing quite a big jump because the interest rate today is much higher than it was 5 years ago. So, the impact of this in terms of making things a little bit more, should we say, lumpy at the individual household level, even though potentially making it smoother at the aggregate level, I think that's something that we have to think carefully about, because we know mortgage debt, and indeed the impact of these real income shocks coming from higher energy prices, they vary a lot across in the cross-section of households, and particular by income. So, the squeeze on household incomes that we are seeing owing to higher energy and goods prices now, that's a squeeze that weighs much more heavily, as I think I said at the beginning of my remarks, much more heavily on lower income households, which maybe are less likely to have mortgages, than it does on higher income households, which are the ones that tend to have mortgages. I mean, equally, the accumulated savings during the lockdown, they tend to accumulate at the better off households. The less well off households haven't accumulated. So when we think about the sort of issue about how pass-through is going to work from monetary policy and from the shock that we're facing and how those two things will interact, I think it's very clear that we have to think carefully about that. But it's not, I think, as simple as saying it'll be faster or slower. I think it's a question of trying to understand the structures and the distributional effects within the household sector. And then, finally, to come to Rhys's point, I mean, I think my answer to that point is a little bit to sort of ask the question, how much do we know? And I think we should be quite humble about how much we know. How much do we have the ability, therefore, to fine-tune the economy with monetary policy actions? I think we should be humble about how much we have to do with that. So the question becomes, do you want to do these maybe smaller but slower, more persistent, more measured approach, which I think I would tend to favor on the grounds that ultimately the interest rates that matter for investment and spending and mortgage-taking decisions in the economy are more likely to be the sort of 2 to 5 year space than in the very short-term space. So if we get a reputation for jerking around bank rate very, very abruptly in the short term in response to all sorts of economic news, then financial markets will say, well, that's just all noise. And they won't pass that through into the 2 to 5 year segment, which is the one that matters for real transmission into the economy. So, I think there's like a general point that central banks have more leverage and more effective transmission of their policies if they're operating in this steady-handed, if you like, lower frequency way. And I think that has implications. Perhaps you're less focused on day-to-day news in the data. You're trying to extract more underlying trends in the data, because once you set policy on a moving path, it's probably going to be more persistent in moving in one direction. And I think that's kind of what we've seen at the Bank of England. And of course, it's not the only way. There is a more activist way. There is making bold moves, but one-off bold moves can also be disturbing in terms of their impact on financial markets. And I think we're yet to see the lasting impact. So, I mean, I do think there is a case for this more steady-handed approach.
Yes, I think I see it's George Selgin at the back. I think we'll just take that one question.
Yes, sir. You alluded to the fact that if the bank could have forecast all these shocks, the real shocks, then it would have taken action to keep the inflation rate on target all along. Some central bankers see merit in seeing through adverse supply shock-based inflation, at least to some extent. But you didn't refer to that as part of the Bank of England's strategy. Could you comment on whether, in fact, it is also part of the strategy? Thank you.
Yeah, that's a good question, and I think that does identify one part which perhaps was missing from what I said this morning. And so the short answer is we do take into account the character of the shock, and our remit given to us by the government, but which is embedded within our framework and our strategy necessarily, because it's the legal framework, if you like, in which we operate. That framework says getting inflation back to target, achieves primacy, price stability is the primary objective, etc. So there's a clear kind of hierarchy here. But it also says that in the face of those disturbances that create the sort of trade-off in the shorter term that I was discussing earlier, higher inflation now, but a weakness in the economy now. I think that's the type of trade-off. Then there can be a case for operating in a more gradual way in order to not create unnecessary volatility in either activity or unemployment in the path back. So that's a story that says, yes, temporary supply shocks that induce these trade-offs, as long as they're not leading to more persistent movements in inflation through the second round effects, which would put the longer-term, medium-term reattention of the inflation target at risk. I mean, there is scope to operate around that. Now, I would not, in current circumstances, overemphasize that as being core. And indeed, one of the messages I was trying to give today is, don't get caught up in thinking about the bank can do a lot to offset, these short-term movements in or shocks coming from the supply side. The core business of the bank, and in an environment we're facing now, where simple, direct, blunt, as I put it, messages are at their heart, the thing I would emphasize is it's the core message of getting inflation back to target. That is the core message and the core driver of our policy decisions. So we're going to do whatever is necessary to achieve that, but in the process of so doing, we are not blind to some of the supply type effects. If I could just say one other thing, if I just have a second on that. I mean, it's also true, of course, that when we talk about supply shocks, we're talking about you might want to look through temporary supply shocks. But if these supply shocks are permanent, if we're living because of geopolitical events or because of climate-related events or whatever, in a world where energy prices, and the UK as a net importer of energy, are permanently higher, other things equal, the UK economy or UK residents are permanently less well off. That's a real shock. That's something that monetary policymakers can't do anything about, right? Because monetary policy, in the end, all it can do is set the nominal environment in which the economy operates. And we're pinning down long-term inflation developments at target. That is our role, that is what we're doing. We can't offset, we can't unwind somehow this permanent real shock to the economy. And I think that's a very important thing to understand about where we are now, is that there is no easy solution in general, in fact, but certainly no easy solution that monetary policy can provide to the type of shocks that we are facing, because they are real shocks that do weigh on UK residents' incomes.
Well, that was a terrific speech and set of answers. Thank you very much. I now also realise that R star is the perfect word for somebody with a Cardiff accent. But thank you very much, and yeah, we'll break and be back here at past if possible. Thank you. Thank you.
And let's go straight into it. So our first speaker will be Alexander Kopitov from the University of Hong Kong. Alex is joining us virtually. So Alex, the floor is yours.
Go directly to the paper, to the model. All right, so the model, in a certain sense, is as simple as it is possible to illustrate what we want. We have a static model with two types of agents. There is a representative household who owns all the firms, supplies, labors, and consumes. And there are firms that produce differentiated goods using labor and intermediate inputs. There are overall N industries or N goods. And we assume that within each industry, there is a representative firm that behaves competitively. At the core of our model, at the core of the paper, is the choice by firms within sectors of production techniques. So what do we mean by production techniques? Well, production technique essentially specifies a set of intermediate inputs to be used, the proportion how to combine different inputs, and how those inputs affect productivity shifter. So more specifically, you can imagine that a firm within each sector has access to a variety of Cobb-Douglas production functions. And these Cobb-Douglas production functions, they differ by these Cobb-Douglas shares, right, alphas. And what the firm can do, it can change the composition of intermediate inputs by changing alphas, essentially. So when doing so, it also affects the productivity of the firm. For example, if you have a car producer and it decides to switch away from using steel and instead using financial services, that might be leading to a significant decline in TFP, right, in this TFP shifter. And that would be captured by the following cost function. Well, in the theory part, we assume a more general function, but that's a convenient one to work with. So essentially what this penalty function says is that there is ideal shares, right? And deviating from them is subject to costs, right? And this cost that depends exactly which sectors you switch to, and potentially it can be quite flexible cost function. So now the question is why firms in the first place do not pick these ideal shares. Well, the reason for that is that there are shocks. There's these TFP shocks, and in particular, if a steel producer becomes less productive or more volatile, then car producer might switch to, for example, buying carbon fibers. Maybe it will cause a decline in TFP, but at the same time, it might be still better because steel is too expensive or its price is too uncertain. So these TFP shocks play a crucial role essentially in our model. And we assume that, as usual, they follow normal distribution with a mean mu and a variance sigma. And these shocks are the only source of randomness in the model. So we assume that firms must make their production techniques decisions before epsilon is realized. But after they make these decisions and epsilon is realized, all other decisions, such as how much labor to hire, how much intermediate inputs to buy, are taken. So the idea here is that adjusting production techniques takes time. That's why you do it before epsilon is realized. One important assumption that we make is that firm within each sector can only adopt one production technique. Essentially, firms cannot set up multiple plants to use all different techniques. We assume it's too costly. So each representative firm has to pick one production technique. Okay, so now let's think what happens after firms have chosen the production technique. So let's solve the model from the end, right? So assume that production techniques are chosen, uncertainty is realized already, epsilon are known. And after that happens, well, first of all, consumer decides about optimal consumption basket to maximize the following CRA utility function, which where rho is the risk aversion. And within this CRA function, we have a Cobb-Douglas aggregator of different consumption goods, where beta captures essentially the importance of a certain consumption good in the consumption basket. What is important here is that household is risk averse. And when firms are going to make their production choice decisions, they will need to take into account that marginal utility of investor is different in different states. In other words, firms will need to take into account stochastic discount factor of the household. And that's exactly how uncertainty is going to play a role in the firm's production technique decision. Now, after firms already made the production decision, so when these techniques have been chosen, firms still need to decide how much labor to hire and how much intermediate inputs to buy. It needs to decide quantities. Essentially, it is done by minimizing the following cost function. And under Cobb-Douglas technology, this cost function takes a familiar form. In particular, cost function tend to be high when prices of intermediate inputs are high, which makes sense. And it also tend to be low when the productivity is high, which also makes sense. Well, in equilibrium, cost is equal to the price, unit cost is equal to the price, to make sure that the firms make zero profits. Now, the most interesting part of the paper is, of course, their decision which techniques to pick. So before uncertainty is realized, at the beginning of the model, firms choose those techniques in expectation of what's going to happen after shocks are realized. So taking all decisions afterwards essentially as given. What it is doing here, well, it is maximizing expected profit, where the profit depends on SDF of the household, the demand for the good of this firm essentially, and price minus unit cost. So essentially, not only the firm here wants to minimize costs, it also wants to take into account how this cost co-move with the demand and with the SDF. So in particular, firms want to have low cost precisely when the marginal utility of the household is high. So it wants essentially insure the household in a certain sense. And that's exactly how uncertainty and risk aversion of the household starts to play a role in the decision. That's basically the model. Just to summarize, at the beginning of the model, firms pick techniques, endogenous networks is formed, then uncertainty is realized, and all other decisions on quantities are made. And afterwards, markets clear and the model is over. So now, having set up the model, let's try to analyze it. And we will start with a simple benchmark of fixed network economy. So in fixed network economy, alpha, the shares, are predetermined. So we are basically in a standard world where production techniques are given. In that case, we show that GDP, or I should be more precise, log GDP, is given by the following expression. So it depends on two things. This first thing, I'm going to talk about this in a second. And the second thing, this is essentially TFP. TFPs of individual sectors affects GDP through the vector of donor weights. So this vector, beta transpose times matrix L, is a vector of donor weights. Donor weights capture the importance of a given sector in the economy. Essentially, it is equal to the sales share in the value added, and it depends on two things. It depends on their beta, that is their essentially consumers' preferences for a given good, and this matrix L. This matrix L is a Leontief inverse. It's a very standard matrix in this input-output literature. So essentially, the donor weight of a sector is high. This sector is important for the overall economy if, first, consumers like this sector, consumers want goods produced by this sector, which is captured by beta, and if the sector is an important supplier to other intermediate good producers, and that is captured by Leontief inverse matrix. Of course, with a fixed network, these donor weights are fixed because alpha is fixed and beta is just a parameter. Now, with a fixed network, we have a very standard result. Essentially, Halton's theorem holds in expectation, though. In particular, we find that an increase in the productivity of a given sector, a positive shock if you want, increases expected GDP linearly and proportionally to the donor weight of the sector, which makes perfect sense, and this is a very standard result. We also can show that an increase in elements of variance-covariance matrix increase variance of output, and donor weights also plays an important role here. So far, this is all standard, and this is already known to the literature. The interesting thing is when we consider flexible networks. In flexible networks, alpha is no longer fixed, it adjusts. And the first thing that we show is that we can characterize alpha by essentially solving Planner's problem. So we show that there is an efficient equilibrium. In particular, the Planner maximizes welfare, which strikes a balance between expected output and the variance of output. And risk aversion here shows how important this variance of output is. It's a very intuitive formulation, very simple formulation. And it's also very nice for us because it allows us to characterize alpha and other outcomes easily. So first of all, we show kind of analogous results to what we've seen for the fixed network, but for a flexible network. We show that an increase in the productivity of a given sector, so if sector does better, it's definitely welfare improving. And coefficient of proportionality here is a donor weight. So notice here that full derivative takes into account network adjustment, and partial derivatives assumes that the network is fixed. So essentially, the total impact on welfare of increasing UI is equal to the impact of the same shock on expected GDP, assuming that the network is fixed. And this is equal to the donor weight. Similarly, we show that the increase in volatility or correlations actually are welfare decreasing. And again, donor weights here play important roles. So role of shocks here is quite intuitive. High mu is good, high volatility is bad. Now, the important difference of a flexible network economy is, of course, that alpha production techniques, the shapes of network structure, is endogenous. And that's why donor weights are also endogenous. And what we show is that as sector becomes more productive, its mu-i increases, or less volatile, so its sigma ii goes down, the donor weight of the sector increases. So essentially, a sector that becomes more productive and less volatile becomes a more important sector in the economy. Now, so that is in fact effects on the welfare, effects on the donor weights, but frequently we also care about the impact of shocks on the moments of GDP. And here, we can decompose the impact of shocks, for example, on change in BUI, in two channels. So first, there is a direct channel, assuming that the network is fixed. But then there is additional network adjustment term, and that term is responsible for the failing of Halton's theorem in this flexible network case. And what we're going to show, what I'm going to show you in a second, is that this network adjustment term can be negative and can in fact overwhelm this direct impact. So in order to show that, I'm going to consider a very simple case, a very simple network with just 5 firms. There is firms 1, 2, and 3 that produce final goods, and firms 5 and 4, they are substitutes and they produce intermediate inputs, but they are, say, not used by consumer in the final consumption. So what are the difference between firms 5 and 4? Firm 5 is safe but less productive. Firms 4 is riskier but more productive. What I'm going to do, I'm going to conduct 2 comparative statics exercises. First, I'm going to increase productivity of a safer unproductive sector 5, and then I'm going to increase volatility of a riskier sector. So what these graphs show you is the response of expected output, variance of output, and welfare when we increase productivity of a safer but unproductive sector 5 for fixed network in red and for flexible network in blue. So if we increase productivity of sector 5, well, in the fixed network case, GDP increase linearly. Coefficient of proportionality is a Dommer weight, which is fixed. Variance doesn't change, welfare increases. That is standard. Now, if the network is flexible, things are more interesting. First, as you increase productivity of sector 5, other firms start to rely more on this sector as a supplier. But this sector initially is still less productive than sector 4, which may lead to a decline in expected output. Still, firms want to switch to this supplier because it is less volatile, which reduces volatility of output. And that overall leads to a higher increase in welfare than in fixed network case. Similarly, if we increase the volatility of a risky sector 4, in the fixed network case, it's not going to affect expected output. It's going to raise variance and going to reduce welfare. But in the flexible network case, firms are going to switch away from this more volatile sector to a safer but less productive sector 5, which is going to reduce expected output, but also can reduce volatility, because remember, we're switching away from a volatile sector. Overall, an increase in uncertainty is definitely welfare reducing, but this reduction is mitigated by endogenous network adjustment. So that's exactly illustration of how well-known Halton's result can be violated in our environment. In the remaining couple of minutes, I will briefly talk about quantitative part of the paper. So we calibrate the model to the sectoral US data, post-war US data for 37 sectors. In particular, we estimate parameters such as risk aversion and kappas. Kappas is a cost of deviating from ideal shares. Essentially, it captures how easy it is for different sectors adjust their shares. And what we target the full time series of sectoral shares and the process for consumption growth. Well, as a result of our calibration, we find that the risk aversion is 4.27. So I'm from a finance department, so I think this is very small risk aversion, but even for macro people, it is not that high. That's what our estimation gives us. And we also can back out TFP implied by our model, and also their uncertainty measure implied by our model. And what we show here is that uncertainty tends to be high. It's in red in this graph. In recessions, particularly in Great Recession, and TFP tends to be low in recession, which makes sense. And we then conduct 2 counterfactuals. First, we fix networks and do not allow it to adjust. And we show that flexibility of network is actually important. Unconditionally allow network to adjust, increase aggregate welfare by 2.1%. While if we ignore uncertainty when making decisions, unconditionally, that is not very important for welfare, because overall uncertainty is quite low on average. But conditionally, uncertainty is important, particularly in high uncertainty episodes like Great Recession. Ignoring the role of uncertainty can lead to sizable declines in welfare of like almost 0.4%, as you can see here. Well, I guess I'm running out of time, so let me just briefly conclude. We believe that this is the first paper to study the impact of uncertainty on the shape of production network and through that channel on the macroeconomy. We think that going forward, this framework can be used for different applications. And one simple application that I think everybody has in mind is the global supply chains, whose risk, whose uncertainty become very obvious in recent years. We think that using our framework can be helpful to think about those questions. With that, I'm going to conclude. I'm really looking forward for the discussions, and I'm sorry that I wasn't able to come to London in person. Thank you. So,
Matteo Bizzarri from the University of Naples.
Okay.
You have 10 minutes, Matteo.
Okay, let me share the screen so Alex can see the slides. Okay, so, okay. Great. Okay, so first of all, thank you to the organizers for the wonderful conference and for the opportunity to discuss this very interesting and cutting-edge paper. And so I'll briefly summarize what are the main points, in my opinion, and then offer some comments. And so I think that the title sums up pretty well what's going on. So this is the contribution of this paper. The main thing for me is a tractable model of endogenous production networks with uncertain productivities, with uncertainty. And that's, I think, quite an achievement because, having also worked on this, getting tractable models of endogenous production networks is pretty complicated. And I think this setting can also be quite portable and amenable to further research. And how do they achieve that? With using standard building blocks that are by now standard of the Cobb-Douglas technology for firms and Cobb-Douglas utility for the consumer, which allows to have essentially linear or log linear equations for output and prices. And this joined with productivities which are stochastic and with this form of, does this work? Okay. That has a constant AI term and a log normal component. And this joined with the Cobb-Douglas allows to have GDP and marginal costs that have a log normal distribution, and this simplifies a lot the optimizations. And the key novelties are the network, which is endogenous in the form of input intensities, the coefficients of the Cobb-Douglas, that are chosen by firms before production decisions, which this involves both the extensive margin, so if to source from a firm or not in the first place, and also how much to rely on a supplier. And the key is that the household is risk averse with a CRRA functional form, and the firms will also use the discount factor of the household in evaluating profits in different states of the world. And this means that both planners and firms have linear quadratic objective functions, trading off productivity and variance of inputs, and this builds for a very tractable optimization that leads to linear expressions that is quite clean and makes the analysis quite tractable. Okay, so what are the key theory results? So an equilibrium exists and is efficient. So here a version of Holton theorem holds. I should have put the global welfare there after this discussion. And of course, after the discussion, it does not hold if you take the derivative without the network being fixed. And another point Alex did not talk about during the presentation is that there are clean comparative statistics when input intensities are complements, the form that the marginal increase in productivity of an increasing intensity for input J is increasing in the intensity of input K. In this case, you can get also clean comparative statistics results on the impact of an increase in average and increase in the correlation between the shocks on the equilibrium shares. And then the quantitative exercise, they do a quantification on the 37 sector input-output network, and especially they look at two counterfactuals. One of what happens in this model with respect to a counterfactual where firms are not allowed to choose the input shares, so with an exogenous network, finding that the endogenous adjustment makes the network more productive but also more volatile. And the other one is with respect to risk neutrality, with what happens if essentially you kill the effect on uncertainty, and risk aversion leads to a lower expected GDP, because of course firms trade off some productivity for safety, but also lower variance, because that's what firms are aiming for. Okay, so this is the summary of what are main points, for my opinion. Then let me offer some comments. So first of all, about the result on equilibrium efficiency, I find this very interesting, because as for a theorist, which I am, because it's not obvious, it was not obvious for me ex ante, because there are clear forces toward efficiency here, in the sense that in the model there are no wedges, no markups, firms are price takers. The choice of inputs does not directly change what others can do. No, it's not that my choosing an input means you can't increase that intensity. And indeed, without uncertainty, the efficiency is a special case of the Asanoran as a result. But on the other hand, I'm very, very interested by the fact that you get efficiency also with uncertainty, because in words with uncertainty, and we know that from the financial literature, for example, we expect, at least I would expect, there to be externalities in the connections game. Why? Because in the financial literature has highlighted that when firms or banks in that case connect to others in the network, they do not necessarily take into account what is the effect of this additional connection on the aggregate variance. Okay? And so there are at least two effects. That is, connections can facilitate diffusion of shocks and volatility, or connections can facilitate risk diversification. And depending on the model, these kind of effects can balance each other out or not. And I'm very curious to understand a bit more why we reach efficiency here. So is this a general thing, or this somehow comes out of the Cobb-Douglas normal combination of the models? So this is a knife-edge case. So I would be very curious if to understand more about this. You can, I guess, answer that this is for another paper, but that will, I think, be an interesting thing. And instead, on the quantitative section, I guess my main comment is that essentially you estimate your technology function, the way the technology, the productivity depends on the input shares, essentially identifying it from variations on the input shares in the network, the alphas. And of course, there are different ways. This is a very clean and reasonable. It's reasonable to expect that these input shares vary because they change the productivity, and firms endogenously choose them. But there are other models that would generate a variation there. So, and the simplest one, that's conceptually, is departures from Cobb-Douglas. If you depart from Cobb-Douglas technology and have a constant elasticity, then input shares change depending on prices and also change depending on shocks. Another one could be that in data you explored, which is kind of a long time, there could be variations in the reorganization of firm-to-firm links. Some sectors become there are more firms, some sectors there are less firms. So I guess to interpret, especially your estimates of the technology function, I guess it would be interesting to understand a bit more how you can disentangle the variation that comes from really the choice of firms whether to supply or not from these different channels. Another point is that the results you have kind of imply an empirical trade-off between productivity and uncertainty, because you find that allowing firms to reorganize the network really have firms that change their decisions from where to supply from firms that are more productive but more risky to others. And so I was wondering, I'm not an empirical person myself, so maybe I'm missing something obvious, but is this well known, or maybe itself this is a new result you can try to think, to explore further, because I find it kind of interesting. It's not ex ante obvious that more productive sectors or firms are also more volatile, at least to me. I mean, an easy explanation could be the newer technologies made for more productive firms that are also more risky or volatile. That's just an idea I throw there. And also, in the exercise you do about, with respect to the risk-neutral counterfactual, you find that in the risk-neutral counterfactual, you have that the expected GDP is lower. So with risk aversion, the expected GDP is lower, but the expected variance is lower, again, because firms trade off some productivity for some safety. But then you also find that realized GDP in the data was higher than with risk aversion. And so I was thinking, like, of course, the realized can only be higher or lower than the expected. So that might be just the end of the story and nothing more to say. But an easy explanation one could have for the realized GDP to be higher is that when firms take these production decisions, they also have private or more specific information about their suppliers or the firms they want to connect or not to. which are not necessarily reflected in aggregate data. Okay, so I was wondering if you can comment a bit on this and try to understand what what implications this consideration could have on your results. And then last point is that was a bit puzzled, maybe I'm missing something on the way you estimate the first best shares. So these alpha zeros are the shares firms would choose without a network, without any other consideration, just optimizing productivity. Because you calibrate them, if I understand well, on the time averages of the observed shares in the data. But the thing is, in equilibrium, believing to your model, the observed shares are the optimal trade-off between reaching the alpha zeros and minimizing costs and variance, which crucially depend on the network. And so moreover, there is a drift in the productivity process that you estimate, right? And so it's not totally clear to me that the average that you observe in the data should really allow you to identify the alpha zeros, because even the average should somehow take into account of the average network and the average trade-off the firms have between choosing the alpha zero and minimizing cost and variance. So I don't know, maybe another way could be using the first order conditions in the first place to estimate the alpha zeros, right, which I understand that can generate computational complexities which are non-trivial. Okay, so in conclusion, I think it's very interesting framework because it's quite tractable and portable, no? Because it's in a sense a simple addition to the standard Cobb-Douglas framework, but it buys a lot because it can allow to introduce both the uncertainty and the endogenous production network, and I think it can be used for many subsequent analyses to answer to many questions. And well, the quantitative results point to sizable effects, which is good. So it means we are onto something here. And I want to just point out some papers, recent papers that would be probably interesting to compare to and discuss. That also deal with the trade-offs between uncertainty, productivity, and in an endogenous network setting. One is this theory paper by Elliott, Golub, and Leduc, recently published in AER, that is kind of different, has a perfect complement rather than Cobb-Douglas framework, but also studies problems of a network formation and disruptions, also studying the trade-off between productivity and the risk, the disruption risk of the equilibrium network. And another recent paper by Michel Gassiv that studies, again, a model with endogenous network and how that affects monetary policy. So also there is an issue of diffusion of productivity and monetary policy shocks in a new Keynesian model with the endogenous network. So I think it would be interesting to understand better the relationship between these two papers. And I think I'm done, essentially. Okay, thank you.
Thank you very much. Okay, can I propose that, Alexander, maybe you take a minute or two to respond to those comments you've just received? Then we'll take Q&A with the audience.
Sure. First of all, can you hear me?
Yeah, loud and clear.
Perfect. First of all, thanks, Matteo, for the discussion. It's a really thoughtful discussion, and many things I definitely agree with. So let me reply on some of your comments, not probably all of them. So first is the comment on efficiency. It's true that welfare theorems do not usually assume perfect information, but I don't think that uncertainty necessarily implies inefficiency. I think in their finance applications, for example, inefficiency arises when we have, say, asymmetric information, or we have some other issues. For example, many papers in the financial network literature thinks about externalities due to bailouts, and that affects how firms connect. I think in our case, markets are essentially complete. Information is, there is uncertainty, but information is the same for all firms, and that's why I guess we find efficiency. Of course, I cannot, claim that this is true for any production function because we haven't tried that. But my conjecture would be that this is not because of Cobb-Douglas and normality. But again, this is just a conjecture. So a comment about their departure from a Cobb-Douglas, I think it's a very good one. One advantage of using Cobb-Douglas is, first of all, it is really tractable. I think without that, it's impossible to have a tractable model. But also, I think an alternative that is frequently used in the literature, CES production technology. They also have their certain limitations. For example, they cannot have zeros. You will always use all possible elements in some positive quantities, while we can allow for switching off some elements in the network. And plus, because we have flexible, in principle, adjustment cost function, this A function with depends on kappas, I think we can also handle very different types of substitutability and complementarity. So related to the comment about why the expected output is lower but realized is higher, well, our interpretation is that, well, the firms were afraid of some uncertain sectors, some uncertain firms, and they switch away from them in expectation that was, in a way, bad for expected output. But then this risk realized, and ultimately they become the winners. Of course, this is just interpretation through the lens of our model. And as a theorist, I always believe that my model describes the reality perfectly. But I definitely agree that there might be other channels, and in particular, private channel information, especially if we think about firm-to-firm networks, is very important. Related, the final thing that I'm going to say is about their ideal shares, what we call ideal shares. I agree with you that is in principle, it's better to estimate them. Unfortunately, we already have to estimate a very large set of kappas, this adjustment costs, and it already takes a while to estimate the model. But actually, we are now revising the paper, and that's something that we are planning to do. We're going to try to add maybe not the entire vector of ideal shares, but at least some version of that. So that point is well taken. And we're definitely going to discuss the papers that you cited. So thank you for pointing them out. Yeah, and I'm happy to answer any questions from the audience as well.
Who's got a question? Okay, there's a few over here. We'll start with Michael, then Gulchan.
Super interesting paper. I was just wondering if the motivation is the uncertainty, why did you not consider including something like inventories in the model? Because they seem like a more direct, high-frequency way that firms deal with supply chain disruption. And if you speak to firms nowadays, you'll hear them talk about moving from just-in-time to just-in-case in terms of their inventory behavior. So, I mean, I'm trying to understand whether we should think about your model as one about the high frequency or one about lower frequency, say, structural shifts in the global supply chain environment.
Before you answer, let's take another one. So, Gulchan.
Okay.
There's a way of treating that concentration, sectoral concentration, as an additional source of risk. I'm particularly thinking in terms of global supply chains, and the observed weight, sectoral weights, might be the outcome of the productivity differences at the sectoral level. But if you think about it in terms of the global supply chains, the reliance on certain sectors and countries is clearly a big source of risk. China in earlier days of the pandemic and reliance on Russian energy today are good examples.
Thank you. And is there one more? I wasn't sure I missed one. No. Why don't you take those two, Alexander?
Okay. So first, related to their, inventories and other things that we do not really model. And basically, I think the interpretation that we have in mind that we are talking more about relatively lower frequency adjustments related to changes in the production techniques. So we're not sure that, we should calibrate the model on the annual frequency as we do. We also thought about maybe we should take a more, lower frequency approach, because we think this is probably when our mechanism is going to be more relevant. So I guess that's how I can reply on that. And we didn't really think too much about inventories, something that we should think about. So related to the sectoral concentration, I didn't get the first part of the question because I think the sound wasn't best. But as far as I understand, the question was whether we can account for, in a certain sense, imperfect competition. Well, the way how we can do it relatively easily, I think, is we can allow for markups, for some kind of wedges, and this is something that paper in the literature do. I think modeling your side a little bit more detailed, might be a little bit hard to keep the model tractable. We definitely, I think we can allow for markups exogenously and study how they affect the shape of networks and the efficiency results.
Wonderful. Okay, I think we'll leave that there. Thank you very much indeed, both of you, for an excellent talk. And let's have John and Gabor come to the front.
Good morning. It's a great pleasure to be here. Thank you very much indeed for selecting our paper. This is actually based on two papers, both with Nobu Kiyotaki and Shenqing Zhang. Firms raise funds against the value of the investment project. Two stylized facts, the first of which is probably true, and the second one which may not be true. Cash flow-based debt is usually limited to 3 to 4.5 years worth of earnings before interest, tax, depreciation, and amortization. So on the sort of debt side of things, it would appear that financiers have a short horizon. The people putting money in only look at the first 3 to 4.5 years on average worth of cash flow. On the equity side, this is more controversial. It seems that there is one school of thought which says that analysts, players in stock markets, are preoccupied by early returns. So that last point is something which we're still working on. In fact, the whole research project is not yet written up, and I do apologize to Gabor for having to work with an unwritten paper here. Well, one of the papers is written in draft form, and the other one is not even that stage. And that's the second paper is the one I'm going to be talking about now, just to make his life really difficult. Anyhow, the second stylized fact, it may be untrue. Let me warn you about that. So the question behind the research project is, why might it be the case that financiers' horizons are short-term, even when the project underlying is longer term? And secondly, what impact might this have on growth and business cycles? And the approach we're going to take I'm going to take in today's talk is one of thinking in terms of key workers who are essential not only for constructing a project and a plant, but also maintaining it. And that's you'll see, central to the analysis. And that these key workers' human capital is inalienable. That is to say, they cannot pre-commit up front to work for a certain ex-post remuneration. And there I'm borrowing from a paper I wrote with Oliver Hart a long time ago. Here's the model. It's a discrete time model, and at the time of investment, date naught, the construction requires a group of key workers. Let's say there are N of them. N doesn't have to be large. There may be 1 or 2. The technology is that if you combine goods and what I call a building, land, you create a plant. And the initial productivity of that plant is 1, normalized to be. The everything's measured in terms of goods, a single good. And the price of the building in those two inputs, Q, is assuming for simplicity, no depreciation, it will be simply the discounted value of the rental price of the building out in the in the marketplace. So if F were the rental price and R is the gross interest rate, then the price of the building, Q, would be F over R minus 1. Now, the next equation is central both to the thinking behind all this and also to the macro model that we embed this within. That the scale of investment, it's a constant returns to scale project, is a key ratio, the ratio of how much net worth the investing team, that's, if you like, N times the net worth of each of them on the top line, can afford. And the price per unit of investment, the gross cost of investment is X plus the price of the building, which we've decided is Q. So X plus Q is the gross unit cost. But they will wish to expand the scale of investment as much as possible, assuming it's got a strictly greater return than R. And to do that, they will raise as much funding as they can, let's call it B, per unit of investment. So the denominator there is all important. I wanted to call this paper the denominator after Arnold Schwarzenegger, but my colleagues wouldn't let me. The denominator is central to, please put that central in your thinking. You've got a cost, X plus Q, and an ability to raise funds, B. And the given constant returns, strict profitability, they will want to make B as big as possible, and the way to do that per unit is to sell the plant. The one thing they can't sell is themselves. That's the inalienability of human capital. But they sell everything else to financiers. So this is a sort of a conglomerate of debt and equity that we have in mind. In fact, we don't need to open that particular box. So a saver buys the plant. The technology, or the dynamic unfolding of technology, is as follows, that at each future date, T, suppose you wake up that morning with the productivity Z, where Z is always bounded by 1, let's say. Well, that generates AZ goods. So that's the whole point of this project, to generate that flow. That flow, we assume, goes straight into the pocket of the owner. So it's not a whole ex post hold-up problem here. It's not even as if the engineer's skill is needed to create that AZ. So you might ask, well, what's the role of the engineers? The answer is to maintain productivity for the next date, T plus 1. And the technology goes as follows, that Z T plus 1 is high, I call it Z prime, where if you look at the algebra here, Z prime is a weighted average of the current productivity Z and 1. So kind of God is good. If everyone works, pulls on the rope, productivity through this AR1 process gravitates back up to the maximum if it happens to be below the maximum this morning. On the other hand, if one of the engineers fails to work, all of those N of them, then ZT plus 1 will be a scaled back version of Z prime. And that's what we call Z hat. If fewer work, well, all hell breaks loose, the whole thing falls apart. Now, this is an example of what I think is known as an Austrian technology coming out of the Austrian school headed by Bohm-Bawerk in the late 19th century, where the input of these guys, the key workers, is indirect. It's a roundabout technology in the sense that they cause productivity, but once the productivity is in place, the output flows automatically. So the input, the human capital affects the evolution of productivity rather than direct production of output. Because they cannot make promises about their labor supply up front, the determination of their remuneration, I call them wages, but don't be pleased, think in terms of, let's say, blue-collar workers, that there may be a lot of workers behind the scenes who are engaged in producing the AZ, and they're being paid in a spot labor market. The crucial people are these key workers, and their remuneration is negotiated each period. So it's this idea that up front, if I'm one of these key workers and you're a financier, at date naught I would come to you and say, please lend me as much as you're willing to. And then you know, and I know, that ex post at each of those following dates, I will do my best to screw as much out of you as I can get. Now, my ex-ante self is in conflict with my ex-post self, because ex-ante I would like to promise to be a good fellow and work at a cheap wage. Of course, ex-post I can't resist the temptation to be as greedy as I can. So that's right at the heart of things. Here's a little diagram for you. So if the current state of productivity is Z below 1, let's say, in equilibrium, let me give the game away here, in equilibrium Z will be equal to 1 all the time. But if off the equilibrium path we happen to wake up this morning with the productivity of Z less than 1, then, as I say, if all N workers, I call them engineers, these key workers, if all N engineers work, think of them as scientists or key software engineers or even the chief executive officer. Anyway, they're people who really are important to the firm. If they all pull on the rope, then Z goes up to Z prime. If, on the other hand, one of them doesn't, it drops down to Z hat. And the gap between Z prime and Z hat is obviously then the marginal engineer's contribution to maintenance. There's a lower threshold, Z lower bar, below which you won't go, even if N-1 work. You would if 2 people failed to show up, but if only one failed to show up, you would just stick there in Z hat, Z lower bar, I should say. And if all work, as I say, God is good, and the technology pushes you slowly back up to 1. 1 is a ceiling, so if all folks work, then you stay there, and if 1 doesn't work, then you drop down to Z hat, which is less than 1. Now B, remember from that denominator, is all important because it'll determine the scale of investment. And B is the owner, that's say you, your discounted value of a unit of plant, discounting using your rate of interest, capital R, so 1 over R times V of 1, where V of Z is given by this Bellman-like formula, where V of Z is V is measured at 8 o'clock in the morning. So at 8 o'clock in the morning, your value of a unit of plant of current productivity Z would be this morning's output, AZ, plus, well, you have a choice of liquidating. After all, you are the owner. So you could sell the land or the building and turn it back into sort of second usage. Or you carry on, in which case you have to pay W of Z. Let me introduce W of Z to you. W of Z is the remuneration per engineer. There are N of us, so you have to pay minus N times W of Z labor costs. And then you walk into tomorrow with a productivity Z prime. Now, the negotiation is, let us a take it or leave it arrangement where each engineer places his or her demand on the table and you have to say yes or no to it. But of course there's a ceiling, there's a threshold to how much as an individual, one of these N guys, engineers, how much I can demand, because you could always say, well, no, and just work with the other N-1 of them, of us. So the wage in that world of take it or leave it offering, but nonetheless a kind of pseudo competition across the N engineers, will be given by the difference between your valuation, discounted PDV, of Z prime, which is what happens in equilibrium, and Z hat, which is what would happen if you turned me down. So there's a subtle, I don't know whether it is subtle, but anyway, there is a somewhat subtle interaction here between the V function, which is you're the owner, discounted value of this product, and the W function, which is my period by period wage, because they feed into each other. Clearly, the amount you pay me in W will be knocked off your V, so that's one direction. But at the same time, my ability to sort of squeeze the pips out of you is limited by my demand, W, which in equilibrium you will accept. That is limited by your V. So the V determines the W and the W determines the V. Proposition, we don't have uniqueness here actually, but within the class of all polynomials, which seems to be pretty darn general, it turns out that in the particular technology that I've told you about, the V function is affine. So it's a constant plus a slope, nu is it, times Z, meaning therefore that W of Z is given by this formula here, and V of Z is given by this formula. I don't have time to go through this algebra to you. Suffice it to say that I'm in the process here of calculating this fixed point between V and W. And at the end of this algebra, it turns out that this slope of Z on your PDV, your capital V, has short-termism built into it. And the intuition behind it, well, maybe I should, before I show you anything else, the intuition behind it is that at every date, ex post date, little t greater than 1, I have a bite of your cherry. Not too big a bite, otherwise you'll say no to me. But what am I contributing to your cherry? I'm contributing productivity, which has long-run consequences for you. So what day is it today? Today is Wednesday. Okay, so suppose we start the project on Wednesday. That's date 0. And on Thursday, date 1, I come back to you and ask for money, W. That, when you're saying yes or no to me, you're thinking, well, what's the implication of you not accepting it? Well, that would cause productivity to drop from Thursday onwards, but that has a dynamic consequence. So in effect, I can not only take a bite out of, I'm effectively taking a bite out of Friday's flow cherry, Saturday's flow cherry, Sundays. And then on Friday, I can come back again and take another bite, this time out of Saturday's flow cherries, Sundays and Mondays. So you notice that the more future it is, let's say next Sunday, the more opportunities I've had to bite into that cherry. Therefore, what's left of the cherry for you drops as we look into the future horizon. That's the intuition of short-termism, that when you buy a plant, on the face of it, you're the proud owner of it, but you know the reality is that these key workers will come back endlessly biting at it, but crucially, the bites they take are forward-looking bites. So therefore, the more forward-looking, the further into the future we look, the less of the cherry which is actually yours. You know all that up front, and therefore your attitude to investment and funding me is short-term. So that's the intuition behind all this. Now, how long have I got?
About 5 minutes.
Okay. In that case, I'm not going to go through this algebra with you. I would like to emphasize this green line. This green line is meant to capture what I just said. That, the area below the green line is your correct perception about how much of the A, which is the top line there, you will get as a function of the horizon. So the more you look into the future, the less of the fraction of that A will be yours. Why? Because there's been more opportunities for me to bite the cherry. One thing you might ask, a really good question, would be, well, come next, I don't know, next Saturday, you might say, well, actually, what's left of the cherry, the Sunday cherry, the Monday cherry, the Tuesday cherry of next week is so low, you think to yourself, that you might as well liquidate on Saturday. After all, you're the owner, why not liquidate? Well, the answer is this Saturday, the world will look just like it does tomorrow, insofar as the bites of the cherry that I've taken between now and Saturday will be sunk labor costs as far as you're concerned. So you're not on some sort of slippery slope where eventually you fall off and liquidate. Or to put it in terms of this diagram, at date tau here, it's the same green line. The shaded area are the wages that you've paid to me in the interval between 0 and tau, which are sunk, and therefore your marginal choice about whether to liquidate never changes. You never want to liquidate, even though on the face of it up front you might think, well, since that green line is asymptotic to 0, then surely there must come a point when it crosses F. F, remember, is the opportunity cost, the flow opportunity cost of the building. Now, while I'm on that subject, okay, so this is my intuition for it, and I don't know whether you like it or not, but while I'm on that subject, when you look forward at date naught and think of the area under the green line as your sequence of what you will effectively, you, the owner, will effectively get, and it's dropping down to 0, and it crosses F at some point, beyond, let's say that point is Saturday. Beyond Saturday, it would appear that, well, it's not, it would appear, it's true that beyond Saturday, in opportunity cost terms, it's costing you more, in today's terms, from Saturday onwards, it's costing you more to keep the building going than you're getting out of it. So you're getting a negative return from Saturday onwards. Of course, that's compensated from the fact you're going to get a positive return between now and Saturday. So the owner's share, net of the cost of the building, has a positive component, the grey area, and a negative component. Now, the provocative implication of that is that if long-run interest rates fall, what I call little b, which is my borrowing capacity, may go up. I'm so sorry. Let me get this absolutely straight. Can I use what's written here at the second? How does a persistent fall in the interest rates affect the net funding capacity? So remember, in the denominator, there is x plus q minus b. So looking at b minus q, the net funding capacity, which is this area, but the area is made up of a positive component, the grey, and the red negative component. When interest rates fall, b minus q can fall. So low long-run interest rates can actually inhibit investment. Now that's weird, because you normally think, well, anything to do with lowering interest rates is always good news for borrowers. But what's happening here, let me absolutely get this across if nothing else. What's happening here is that, yes, B goes up when interest rates fall. It always does. You know, I can always borrow more if interest rates are lower in the future. But cost, Q, may go up more. So an example of this would be the housing market. And a young person on the housing market, you know, is it good news in London, as a 20-year-old, that interest rates have dropped? Because they may be going up. Again, we've heard Hugh Pill tell us they are, but or they might. Anyway, is it a good idea? Is it a good thing that interest rates, long-run interest rates, fall? Well, on the one hand, it is, because I can borrow more. If I'm this, well, I'm not young, but if I'm this putative youngster trying to get onto the housing market, the amount I can borrow goes up because interest rates have fallen. Good. But then I look at the cost of the houses, the price of houses, and I discover they've gone up more than the amount I can borrow. So actually, for young people who are putting their precious net worth into the business of buying a house, young people may prefer to live in a world of higher long-run interest rates than lower long-run interest rates. So there's a dark side to lower interest rates. We embed what I've just told you into a macro model, but here's at date 5 in these diagrams, the interest rate, let's say, fell from 2.5% to 1.5% permanently. Initially, investment spikes because there's a net worth transference that's coming out of the paper that Nobu and I wrote on, called Credit Cycles. Output spikes, starts to rise. Consumption rises, so it's all good news. I mean, think in terms of Japan in the early 80s, 90s, I should say, when interest rates fell. I mean, this project was in large part stimulated by the Japanese experience over the last 30 years. So interest rates fell in Japan. The value of the royal palace in Tokyo was greater than the value of California or something utterly bizarre. The property prices were absolutely astronomical. Everybody felt great about it. But what people were doing is investing in buildings rather than in productive net worth. And that sowed the seeds of longer run stagnation. Another example might be the southern European countries after they joined the euro, that interest rates suddenly, real interest rates was perceived to be lower and were going to stay low for a while. There was a property boom, but actually in terms of underlying investment, it fell. So look at the position of these graphs of investment and consumption and output. They all, in the longer run, asymptote to a trajectory which is less steep. In other words, growth is inhibited by low interest rates. Thank you.
Thank you very much indeed. Okay, so the discussant is Gabor Pinter from the Bank of England. So interesting.
Thanks very much. I'd like to thank the organizers for putting together such an excellent program and inviting me to discuss this paper. This is not just one paper, as John said. This is, these are two papers, which is part of the recent agenda of the genius of Kiyotaki-Mura and Shengjing. It's been a privilege to discuss this paper, but also as quite a challenge, given that the second paper hasn't really been written yet. So my comments are going to be more general on the agenda, and some of the comments will be specific to the first paper. So as an overview, this agenda is a theoretical analysis basically into two main questions. Firstly, why do firms borrow mainly against short-term revenues that finance long-term projects? And the second question, can a fall in the long-term interest rate generate reduction in investment in growth as opposed to an expansion? My first reactions, it's a wonderfully rich paper or set of papers with new testable predictions for the empirical, macro, growth, and firm dynamics literatures. And it's a really nice framework to think about in a macro context about maturity, or more precisely about horizons of credit arrangements. I'm going to try to summarize the model on one slide, which is quite a challenge. I'm going to try to extract the heart of the mechanism, and I will probably oversimplify, but basically the key inputs into this model is a constant returns to scale production function, Y, which is generated by a common aggregate productivity parameter, and Z, which is the endogenous component of productivity, and what I like to think of as a productivity function, so that Z evolves as a function of previous productivity, as well as how much effort or human capital these engineers putting into the productivity. And these engineers will be compensated by the wage that they're going to get from the firm, or the cherry that they're going to get from the firm's revenues. And two main objects in this model, which I find quite illuminating, are these two endogenous objects, the wage and the borrowing capacity that the firm can extract. And this is, as we are used to in Kiyotaki-Mura type of models, it has a very nice geometric sort of infinite series expression, and I'm going to highlight in colors the sort of key objects which are responsible for most of the horizon effects. So as you will see, the wage that the engineer extracts from the firm is going to be sort of a positive function of the future components of the effort or human capital that it adds to the company. In turn, the borrowing capacity, these horizon effects turn the other way. So the longer term components of the borrowing capacity feature these eta or sort of human capital component of the engineer negatively. That's why the more distant we go into the future, the more of the cherry will be going in relative terms to the engineer, and less of the revenue the firm can use in order to borrow. So in order to to make this point a little bit more clearly, if we simplify this, assume a constant returns to scale in that productivity function up there. So if theta and eta sums up to 1, you can write the infinite geometric sum in a very simple term. So the borrowing capacity will be just a ratio of the common productivity parameter divided by the interest rate minus theta. If you compare that to the cost of investment, which does not feature the theta parameter in the denominator, then you will see that if there is a reduction in the interest rate, the borrowing capacity might go up by less than Q, the cost of investment. So that's the sort of partial derivative that sort of makes the point that John tried to make, which is that investment can actually end up going down because the borrowing capacity, even though it increases when interest rate goes down, but it increases by less than the cost of investment. Now, that theta is going to be a key object, and as an empiricist, or those who'd like to test the kind of implications of the model, they need to figure out a way of identifying or detecting these low theta firms. So firms that are full of scientists, if you will, full of engineers, and that's going to be the empirical challenge, because the theta will be driving lots of these effects. So after the model summary, let me just give you or make 2 comments. This is a very nice novel mechanism which combines various elements from the human capital, endogenous growth, and finance literatures. The intuition I gave you was based on the first paper, which featured competitive labor markets. In the second paper, John didn't really have time to go into that further. It does feature imperfect labor markets. So there is bilateral negotiation between the firm and the engineer. And it wasn't clear to me, so one comment or one question, does the treatment of the labor market provide fundamentally new insights compared to paper 1? And my thinking was that it could if the engineer's human capital is specific to the firm. So those, let's say, scientists working for Amazon, they develop some Amazon-specific human capital. So if Amazon does liquidate, those engineers go somewhere else. There is an aggregate sort of externality that can arise from the loss of human capital. Could this generate a knock-on effect and further stifle investment and growth? In paper 2, it doesn't, because the firm never goes, Amazon never goes bankrupt, so there's no liquidation, whereas in paper 1 there is liquidation. So, but there could be these additional effects. So I would just like to understand how the different treatment of labor markets between paper 1 and paper 2 would fundamentally change the implications. And there was this other sort of idea or question I had in my mind. Could low theta firms, so these kind of Amazon type firms, can have endogenously higher productivity, or more precisely, higher growth? So how can one think about firms, actual firms like Amazon, who for many years did not have any revenues, right? So if anything, didn't have any income. If anything, they had negative income. And as John mentioned, one of the stylized facts was that motivated the paper is that firms would borrow against short-term revenues. So these companies that are full of engineers and scientists nevertheless seems to have no positive revenues, net income in the short run, but they're still growing and the balance sheet is growing. So how do I think about these corporate phenomena through the lens of the model? That was sort of a second question. And perhaps the answer could lie in linking the theta endogenously to the productivity or the growth of the company. In terms of, in the remaining 3 minutes, I'm going to try to talk about some empirical predictions. So key prediction of the model, that a decline in the interest rate could be less expansionary for firms, for these low theta firms, firms with lots of engineers and human capital. So now the $1 million question, how can we detect these low theta firms in the data? So I would propose 3 approaches. If you go to firm level data, you can observe R&D. So low theta firms could be those firms who have lots of research and development relative to profits. Approach number 2, those firms that have a lot of intangible capital. And approach number 3, which I did explore in the remaining slides, is ultimately this paper is about key workers. And one approach one can take is that key workers could be proxied by the managers of the firm. They are the ones who are driving lots of the productivity and development in that firm. So what I'm using now, I'm just going to go to the firm level data. I can actually observe wages of firm directors in the data. I can observe to some extent in the UK R&D, not as well as in the US, but now I need some sort of shock as well to the long run interest rate. So here I'm just taking a bivariate VAR with 1-year bonds and 15-year bond yields, and I'm going to extract sort of an orthogonalized shock which drives, so that long rate shock is the second shock, orthogonalized shock in the VAR, which predominantly drives the long run interest rates based on this forecast error variance decomposition. I'm going to take that sort of extracted shock to the long run interest rate, and I'm going to go to a firm level regression where I'm kind of interested, I'm asking the question, how would the firm's investment change in response to a shock to that long run interest rate, depending on whether the firm is a low theta firm or high theta firm, proxied by my measure of R&D in the first case. In the second case, I'm thinking of low theta firms as those firms whereby directors' wages are larger as a fraction of total remuneration, larger than the median. So it's going to be a simple putting firms into two buckets based on the relative share that goes to these directors or key workers. And there is some sort of two takeaways from this, is that if you have a reduction in the interest rate, which is roughly 100 basis points reduction over the accounting period of the firm, so the last 12 months, then you have an expansion of total assets, which, like 3 years after the shock, amounts to about 2% in asset growth. But that asset growth is lower for those firms whereby the share of directors' wages compared to the total wage that is paid out in the company is lower. Equally, if I look at those firms that have a large R&D, negative to operating profits, the asset growth is about 2.5% after 3 years after the shock, relative to those small R&D firms that experience a half percentage point higher asset growth. But then again, I lose a lot of data here because R&D is not reported for SME companies, so it's only a handful of those are listed, quoted companies in the UK, whereas director wages is much better reported. And I can also...
Could I just, I'm very excited listening to all this. This is the paper we should have written, by the way. Are you saying it goes the right way? That low theta firms are more vulnerable to drops in interest rates?
Yeah, so here, lower theta firms expand less, and that difference is statistically significant. Here the difference is not significant, but if I show you the third one, which is not a long-run interest rate shock, because term structure people might argue with my VAR method. So here I'm just using a high-frequency monetary policy shock. So reduction, surprise reduction in the interest rate doesn't even expand asset growth of the low theta firms, whereas in the first row, these sort of high theta firms, to the extent that it's well measured by the relative share of directors' wages, significantly expands. But given I'm out of time, let me just, and that it's a very insightful and important paper at the intersection of macro and finance. I would just like to understand the second paper's relative contribution, but the whole agenda have lots of predictions that are testable in firm level data sets. So thank you.
Thank you very much. So, John, would you like to respond to the comments?
Well, the most important thing I want to say is that was the most brilliant discussion I've ever seen, let alone had the privilege of receiving on my own paper. So thank you so much, Gabor. As I say, it's the paper we should have written if we'd known what we were doing empirically, which we don't. The only comment I want to make is that what's the relationship or connection between what's the value added in the second paper, the one where workers are locked in? The model I presented to you was the second paper where these key workers were permanently locked into the firm. What really caused us to write that paper or to think about the formal model was because in the first paper we assumed that there was a completely competitive ex post market. So it's like in that first paper there was think of Silicon Valley where these key software or hardware engineers can effortlessly float between all the companies. Now, we weren't sure whether these intriguing, what we found intriguing results were being driven by that fact. And we wanted to double check that in a world where there's lock-in, so as you put it, an Amazon scientist is got Amazon-specific skills. Would the results transfer over, would the theory and predictions transfer over? And they do. So in other words, it's not the question of is this market ex post competitive or not is not central. There are two schools of thought. The traditional corporate finance view of all these things is somehow, yes, there's a great deal of lock-in when people go to banks or the equity markets to raise funds. The people putting the money in, you know that if I'm the person borrowing, then I'm going to be in it for the long haul, and we're going to be in some sort of dynamic relationship with each other. That's a classic corporate finance take on things. Perhaps a more modern, Silicon Valley view of life is that actually, no, I'm not locked in with you, and you're not locked in with me, and that there are lots of people like me and lots of firms like you ex post, and and we can then jump to the opposite extreme where wages are determined competitively. It turns out that both extremes deliver the same predictions. But let me say again, I'm utterly full of admiration by Gabor. Thank you very much indeed, Gabor.
Thank you. We have a couple of minutes for if there are any questions. So, Tim, go ahead. Sorry, if you could pop down.
I'm hoping most of your questions are going to be directed at Gabor. Could you come up, please?
You have to go up.
Yeah, so I mean, in this world, it's pretty great to be an engineer, right? So I would expect there to be a lot of kind of, the engineering schools would be full of students going in to become engineers. So, I mean, I guess it's fixed in there, but that would reduce the bargaining power, I guess, of engineers over time.
That's true.
And then the second was...
hold on a second. It would supply more engineers to the economy. If you forgive me being sort of autobiographical, literally, the paper one, what you said is true. Paper two, it wouldn't be true, because yes, it may be at the extensive margin there are more engineers coming in, but my bargaining power is not impinged from that. So the fact, in a way, that's why we wrote paper two. We wanted to double check whether these were driven by sort of extensive margin, price theoretic, wage theoretic considerations, or whether they were being driven by internal bargaining. And it turns out that it's the internal bargaining which is central. So I don't want to agree with you when it comes to paper two, if I can put it like that.
The second comment is also, I mean, what I think you'll hear is, why don't we offer stock options? You only want to offer stock options and then align it to...
That's a great question, and we're very happy with that. So this W doesn't have to be, dollar bills. It could be intriguing, forward-looking stock options. But actually, that's orthogonal to the key idea that I'll keep coming back and asking for more stock options tomorrow. It's the repetitive biting at the cherry which is at the heart of all this. The nature of the remuneration W, the timing and the sophistication of the contract is of secondary importance. What really matters, it's all to do with PDVs. What really matters is the fact that I can endlessly come back and, using your example, ask for more stock options each day.
Any more? We are a little behind time, so I think let's draw that to a close. Thank you very much, both of you. Okay, now if I could welcome the third paper. So we have Joris Thielens from the National Bank of Belgium, and Jaseba, if you could also come to the front.
All right, where's the mic? Is there a mic? Okay, perfect, sorry. So first of all, thanks for the conference organizers for including this paper on the program, and thanks for Joseba for accepting the invitation to discuss this paper. This is joint work with Hans and Tarek, both at KU Leuven. I'm at the National Bank of Belgium, so the usual disclaimer applies. So the title of this project is Asset Overhang and Technological Change. And in a nutshell, the purpose of this paper is to understand why investors finance new technologies when these new technologies disrupt or hurt the firms that are in their legacy portfolio. So to fix ideas and conceptually clarify what we have in mind, we have in mind this setup where we have an investor that has an investment in a particular firm, which has a particular default probability and has some collateral pledged to the investor. And in comes this new firm that imposes a negative spillover on this firm because of the technology that it brings in. So think of this as Uber that is hurting these old school taxi cab operators, or Airbnb that is stealing away business from the hotel sector. So in the paper has a large empirical application where we're going to focus on climate change technologies. So you can also think of this as a green firm, in which case this could be Tesla that is stealing away business from the dirty legacy car makers, or devaluing the collateral that they have pledged to their banks. What we call asset overhang is the reduced incentive of this investor to finance this new technology because of the negative spillover that it generates. And we're going to connect this to the economy's capacity to innovate and diffuse these new technologies. Right. There is a little bit of theory in the paper where we study this notion of asset overhang theoretically and highlight the conditions under which it leads to rationing of new technologies. And we're going to flush out a few predictions. The first one is just the legacy effect, very simple. In a standalone context, if I'm an investor, I prefer not to lend to these disruptive technologies because they hurt my legacy portfolio. But in a competitive setting, we have this market structure effect where we need to take into account distribution of this asset overhang in the economy. And it's the case that if there are investors that are very happy to finance these new disruptive technologies, it's going to stimulate essentially the entire pool of eligible investors to finance this technology. So in the empirical application, we're going to study whether green Belgian firms, and green means engaged in developing new technologies or diffusing them, whether they get rationed by banks in the market for corporate credit. So it's an interesting application. Why? First of all, it's known that new green technologies, they potentially hurt firms that rely on dirty technologies. We'll also have a large part in the paper that has a say about this as well. All banks in the Belgian economy, they lend to dirty firms to varying degrees. And it's an important question also because, I mean, the topic of climate finance is very pressing and important, and especially in the case of Belgium, which is a very bank-based economy. In terms of empirics, the key finding is on top, where we see that bank lending policies in Belgium, they've really tried to protect their legacy portfolio by rationing these innovators and diffusers of green technologies, both in product spaces, product markets, and technology spaces, and I'll have a little bit more to say about that, where they hold large stakes, right? But it's also true that some banks are really engaged in stimulating these technologies, and they trigger lending from all banks in the system. Third, at the end of the day, a lot of these disruptive green firms, they end up matching with a bank. We ask the question, which bank are they matching with? It turns out it's the bank that they least threaten portfolio-wise. And then in the years afterwards, year-on-year variation in bank credit growth still seems to be triggered, or to some extent driven by this asset overhang problem. So as I said, we have a little bit of theory in there, very standard Thomson-Tirol model, where we have this firm that is turning to this investor for finance, and this firm can basically do two things. Either it behaves diligently, in which case the success probability of the project is large and the NPV of the project is positive, or it can shirk, take a laissez-faire attitude, in which case the probability of success is low and the NPV is negative. And the investor knows this, so he sets up this contract in a smart way, such that it's incentive compatible, meaning that it incentivizes the firm to behave diligently, and that it's rational. So it still makes sense for this firm to start up this project, right? If you work through the algebra in the paper, then you can see that you can write the investor's profit as a function of A, which is the amount of cash that the firm brings in. And you see that there is this rationing zone where the firm is unable to raise funds, and basically the project dies on the drawing board. This is a very standard setup. What we do now is we change two things. We first assume that this investor has a legacy portfolio and that this new firm imposes a negative spillover on this firm one. So this could be an increase in the probability of default of this guy, or, and that's the baseline story that we have in the paper, it devalues the collateral that this guy has pledged with his investor, right? So the problem that this investor now faces is, okay, this contract is sunk, cast in stone, cannot be changed. So this investor is going to demand compensation, and is going to demand compensation from this green firm. And again, if you work through the algebra, what you see is that the rationing zone increases. So if this technology is very, very disruptive and this delta C is very large, you can see that this rationing zone increases and this project just does not fly. This is a monopoly setting. If we look at a competitive setting with multiple investors, what becomes important is the distribution of the legacy portfolio that each investor in the economy has that is at risk. So suppose you have this investor here that has invested in this particular firm. Could be that this firm is not rivaling with this new novel green firm, or the collateral that it has pledged is completely insensitive to the entry of this green firm, right? What we show in the paper, again, if you work through the algebra, is what matters for rationing is the legacy position at risk that is the smallest among all investors. And the intuition is quite simple. Irrespective of what investor invests in this disruptive technology, all investors will suffer the losses. And of course, all these investors know this, so they are going to align their rationing barrier with this particular investor that has the lowest legacy position at risk. In this way, they have an expectation, some gain in them for them as well. So we have two predictions. One is what we call the legacy effect. So the more I threaten my eligible investors, the less likely they're willing to invest in me. But if there is an investor with a very low asset overhang problem, he is going to be more willing to lend and is going to trigger lending from all investors in the economy. So do climate change technologies in Belgium suffer from this asset overhang problem? Or in other words, do Belgian banks, in order to protect their dirty portfolio, ration green firms? We're going to answer this question particularly in two steps. In the first step, we're going to measure these green externalities. It's a large detour in the paper. I'm sure that Joseba will agree. But we think it's important because if you really want to connect bank lending policies as a function of their legacy portfolio, you really need to understand how much you are threatened by this particular firm that is coming up to you to ask for funding. Right? We're going to bring in three pieces of measurement. First of all, we're going to identify the green firms because they generate the spillovers and they're going to be rationed. We're going to introduce these notions of product market and technology markets because this is where the green firms and the brown firms meet and where these spillovers materialize. And then finally, we're going to focus on two or consider two potential economic impacts on the dirty firms, their performance and the value of the collateral that they have. And when we combine this, we can isolate this measure of the credit portfolio of an individual bank that is exposed to an individual green firm. And this is something that we're going to connect to the lending decision, so the extensive margin. Does this disruptive firm get bank access? We're going to talk about matching. Who is he going to match with if he gets credit? And then some, if there is time, but probably not, there are some insights in the intensive margin as well. So how do we identify these green firms? So we have green innovators. Let me use this. Green innovators and green diffusers. So green innovators, these are guys that invent new green stuff, like a new way of harnessing energy from ocean tides, for example. We're going to identify them from PADStat. So PADStat is a database that documents all applications, patent applications that firms apply for. And we're going to focus on firms that file for a patent that embodies a climate change mitigation technology. The list exists, it's produced by the OECD, so this is a dedicated taxonomy for exactly this. Green diffusers, these are guys that buy and sell green stuff that they do not invent themselves, right? Think of a bakery that is putting solar panels on his roof, or selling his bread in biodegradable plastic bags and so on. And this is taken from a structural survey that we have at the bank. We're going to unpack this one level deeper. So green innovators come in two flavors: product innovators and process innovators. Product innovators, think of Tesla, so guys that produce new green stuff that they bring to the market. Process innovators, these guys develop new environmental ways of producing things. Think of this as AB InBev, a large beer producer in Belgium, that has developed this new way of producing beer that requires less water, for example. And we use text mining routines to flesh these two things out. Diffusers also come in two flavors, like very symmetric to this part. So green providers, they sell green stuff, and green adopters, they buy green stuff. Again, these are sub-questions from a survey. So we're taking a very granular stand on this, but this is important because all these different green activities that generate different spillovers. So if you really want to take a comprehensive stand on this, you need to go this deep. So we know who the green firms are. We next try to understand how close these green firms are to the brown firms. So we're going to draw on this econ literature that has produced these proximity measures to tease out how close firms are, for example, in the product space. And this is based on the portfolio overlap of customers. And the technology space, this is based on the supplier portfolio overlap. So this PIJT and TIJT, these range between 0 and 1, 0 meaning you're doing completely different things, 1 meaning you're doing exactly the same things. And we calibrate this on 2 decades of B2B transactions. So at the bank, we have this super large data set which documents all bilateral trade between two firms. And I mean, it's not on the paper, but we're doing some casual inspection of these things, and it turns out that it works relatively well. Like you would expect, for example, British Airways and the Eurostar to compete on transport across the channel, so that they're close in the product space. It's true, but they're different in terms of technology space because British Airways uses airplanes, Eurostar uses trains. So, I mean, we're doing some casual inspections and these things seem to work quite well. So we know who the green firms are, we know how close they are to the brown firms. Next we ask the question, okay, what could be the potential impact on these brown firms? We look at the performance impact, year-on-year sales, year-on-year changes in corporate sales and household sales. In the paper, when we zoom in on the brown firms that also have bank credit, we also look at the PDs of these firms and also the provisions that banks are booking on these dirty credit lines. Pledgeability, so we're looking at the value of the assets that these guys have. We have 2 relatively noisy metrics. Excessive write-downs, this is what firms are required to do if the market value of their assets is like super below their book value, which happens in the case of technological obsolescence. And loss at sales, like when I liquidate my assets in secondary markets. And again, I mean, in the paper, when we focus on brown firms that are bank borrowers, we actually have access to the value of collateral that these guys have pledged. So we have a better view there on what is going on. So I'm not going to talk on how we pool all these ingredients in an econometric framework. I'm just going to talk about the type of results that we're going to generate from this. So, for example, one thing that we find is that green product innovation hurts the dirty firms that are in its product space. So think of this as Tesla that is hurting the performance of dirty car makers. This is not new. There is a larger innovation literature on exactly this. We're just pinning this down for a more niche application, such as green technology. Green process innovation is also driving down the performance of brown firms. Why? Well, green process innovation means that these firms, they're more cost effective, and it's an advantage that they can leverage in the product market, right? So we can do this for all types of green activities. But what we learn from this is by having this table and the presence of the different spillovers, we can really identify for each individual green firms, by the very nature of its green activity, the set of brown firms that is going to negatively affect. In Belgium, we have the corporate credit register, which documents all bank firm credit exposure. So we also know exactly what banks these dirty firms are borrowing from. So we know the exposure of each individual bank in the Belgian economy to each individual green firm in the economy. So it's the share of the credit portfolio that is at risk, and we're going to call this theta. These thetas, they're super, super small, which makes a lot of sense. An individual green firm does not threaten the entire portfolio of banks. Also important, these thetas, they don't have to be positive for green firms. It could very well be that a green firm is not hurting any brown firm in the economy because it's just doing so vastly different things that it's not close to any of the dirty firms. It could also be that it hurts a lot of dirty firms, but none of these dirty firms are actually bank borrowers, right? So anyway, these thetas is something that we're going to connect to the decision whether banks lend yes or no. So we have this rationing setup where on the left-hand side we have this dummy indicator whether this firm I is a bank borrower, yes or no. The first covariate is what we call the legacy effect, and it's the median portfolio exposure in the banking sector vis-a-vis green firm I. And we're going to suspect that beta 1 is negative, because the more you threaten the banking sector, the less likely they're going to lend to you. The second covariate, market structure, it's the minimum exposure among all banks. And we're going to conjecture that beta 2 is negative, because if there is a bank which has a very low exposure, all banks are going to align with this bank and it's going to increase the probability that you get credit. Z is going to control for a lot of things, including credit demand. Do you have access to the bond market, to the equity markets, and all these kinds of things. And we basically find evidence in favor of both of these effects in the data. For example, for innovators, we see that disruptive green innovators, they're about 4.4 percentage points less likely to end up borrowing from a bank. A lot of this is undone by this market structure effect. So these things, they tend to balance out. But there are, of course, cases where you have a disruptive green innovator, in which case the legacy effect tells us he's going to get rationed, but he's going to threaten all banks in the economy, in which case this is not offset. So these are really technologies that are being rationed a lot. The effects are economically less important for diffusion. Makes a lot of sense because diffusion is a less disruptive activity than actually the innovation part. We've been having a go at this table a lot, like teasing out some heterogeneity, and two things are important to mention. The first one is it's mostly larger firms where these effects play. And the reason is probably that these larger firms, just by the very nature of the scale of their activities, they're more threatening, so they get rationed more. But there is also probably an information component there because larger firms demand for more credit, so this probably ends up, or this credit application ends up higher up in the banking hierarchy where this is scrutinized a little bit more. What's also important is not necessarily the short-term credit positions that are at risk. It's more the long-term credit positions at risk. And it also makes a lot of sense because these short-term things, they mature in like a year or two, and at that point, even if the risk materializes, it does probably not affect the bank balance sheet anymore. So at the end of the day, we do see that a lot of green disruptive firms end up matching with a particular bank. So we tease this out in this matching framework. So we have borrower IBT. 2 minutes? Okay. Let me skip these last two results and let me just go to the policy implications. I guess this is more interesting. So first of all, in terms of policy implication, what we think is that as a policymaker, if you're really interested in stimulating financing of disruptive technologies, you should really be in favor of having these new institutions in the economy. Because these new investors, they're legacy free, they have no balance sheet that they want to protect. So they're willing to lend to these disruptive technologies. And in the same path, they're going to force this on other investors in the economy as well. And in the context of climate change, this is not just a theoretical notion. You have examples where this is happening. For example, the UK Green Investment Bank, the New York Green Bank, And these guys, they have a dedicated mandate to finance these disruptive green technologies, right? Let me end with this part here. So we're pitching the paper, or at least the application of the paper, as a climate finance problem, but we think that it's much more broader than this. What we need for this asset overhang problem is two ingredients. You need a negative spillover, and you need a pool of investors that are negatively exposed to this. We can think of other applications. For example, niche technologies like artificial intelligence and so on. In this case, the pool of eligible investors is actually relatively small, and they require like dedicated knowledge to screen these projects, but this dedicated knowledge is typically built up by having experience in this technology before, so they probably also have a legacy portfolio that they're trying to protect. So it's interesting to think about this in the context of these more narrow disruptive technologies. Let me not conclude. Let me ask Joseba to conclude, because I'm sure that he has a nice discussion ahead of us.
Thank you very much indeed. So, the discussant is Joseba Martinez, London Business School.
All right, so thank you so much for inviting me. It's great to be here, and it was great to read this paper. Okay, so yours, obviously he can't because he's the author, so he can't brag too much, so I'm going to do the bragging for him. Okay, so like in a deep sense, this might be the most important paper you see, you know, like today, this year, like ever maybe, okay, because this is a paper about financing technology and how holdups in the financing of those technologies might impede diffusion. Okay, so if you think climate change is a big problem, and if you think the solution to climate change is technology, then you really care about this problem. Okay, so in general, the question is, you know, might this network of links between banks, incumbent firms, and these kind of disruptive innovators impede the efficient financing of disruptive technologies? Okay, so in general, as I say, that's an important question, not just for green applications, but you know, we think growth comes from technological diffusion. So truism, technology diffuses kind of slowly, and there's many reasons why that's the case. What this paper says is, you know, one reason why that may be the case is that because of inefficiencies of the financial sector, that diffusion might happen inefficiently, slowly. So in some sense, this paper is not about green technology at all. It's a much bigger problem than that. But understandably, these authors are going to focus on green stuff. Partly that's because we really care about green technology. Partly is because they have fantastic data that really lets them get to this problem. Okay, in general, it's hard to get cross-sectional data on which technologies firms are adopting, which firms are adopting technologies. These authors have this fantastic stuff which tells them which firms in Belgium are adopting specifically green technologies. Okay, so it's a really important question. And a very big one, okay? And I think the authors have done an admirable job of you know, at least taking a bite out of this cherry, to use John's analogy. Okay, so I'll just talk a little bit about the theory, I'll talk a little bit about the empirics, and then I'll offer some thoughts as I go along. Okay, so the theory is kind of very simple. It's based on Holmstrom and Thoreau, and what they add is, you know, there's this informational problem, there's this moral hazard problem, and on top of it, if I lend to a firm, it might mean that imposes a cost. Okay, so the authors want to think of that cost as coming from some kind of negative effect on my existing portfolio. Okay, but really, like in a very simple sense, this is just I lend to someone, and that lending obviously brings me benefits. Okay, I get to keep some of the rents from that project, but also it imposes some cost on some other part of my portfolio. Okay, so in principle, this could take many forms. The authors are going to think of it as a kind of an externality arising from lending to some disruptive firm. And the asset overhang problem, what that is a new project, a new technology might not get financed if the cost from lending to that project from somewhere else in my portfolio is so large that it overwhelms the benefits of financing it. Okay, so it's a very simple idea. Now, this could be, you know, I'm lending to some industry, some firms of that industry, there's a competitor entering, I don't want to finance a competitor. It could be something with technology. Okay, this has many different applications. The one they have in mind here is something to do with financing disruptive technology. Okay, so in the model, it's very stark. Okay, so in some sense in the model, it's bad to lend. Okay, objectively, if I lend to these firms, I'm destroying some value somewhere else in the economy. Okay, I guess that's not really what we have in mind with financing green technology. We have in mind that there's these positive externalities. We have in mind that the reason that some assets are worth so much is because we don't price them correctly. We don't have a carbon tax or something. Okay, so the model is very stark and it kind of misses some of these dynamics. It's hard to say in the model what it is the planner would want. Okay, because the model doesn't have all these bells and whistles that we think might be important. So why might it be important to add these bells and whistles or think more broadly about the theory here? Of course, the authors want to get the policy recommendations, and once you make that step, then there's all these other things to consider. Okay, so one question, I'm going to return to this later. It's not so obvious what the efficient rate at which we want to get these new innovators in and phase out those kind of brown industries. What's the rate at which we want that to happen? On the one hand, of course, we want it to happen tomorrow because we're in a rush to fix climate change. On the other hand, we know that that would imply, say, a drop in consumption, a drop in employment, stranded assets, okay, lots of other challenges. Okay, so I think the problem here, this kind of hold-up problem that the authors highlight is real, it's true. What's less obvious is what's the rate at which we kind of want to undo that in the economy through policy. I'll skip this because yours kind of talked a little bit about the theory, but it's clean, it's simple, it really gets you thinking about the ideas, and I think if that's not the purpose of theory, then what is? Okay, so the second key idea in the theory is that the market structure is going to matter a lot for the severity of this asset overhang problem. So let's consider two extremes. The first is a monopolist investor. Okay, so if I'm the monopolist investor and I've lent to some firm, then obviously if lending to a second firm is going to hurt me, I'm going to fully internalize that cost. Okay, so if I'm lending to all the firms in a sector and a competitor wants to come in, it's clearly much less likely that I finance the competitor because that's going to, say, lower the rents that I'm earning from these incumbent firms. The second extreme would be, let's say that there's completely free entry into lending markets. Then the disruptive firm has a good project. Okay, these green ideas are great. You're always going to be able to find a lender that doesn't internalize that loss. Okay, and so the authors are going to consider some kind of gradations between these two extremes, a monopolist investor and kind of free entry. And depending on how severe you think barriers to entry in the finance sector are, you think this problem is more or less severe. Okay, so again, to me at least, it's not obvious that we want these disruptive technologies to spread through completely. Okay, so would the planner want, say, like a Ford or a BP to go bankrupt because there's so much competition? Or even worse, maybe, would we want them to become zombie firms that kind of hang on to this dirty capital just because they can? Maybe more broadly, if let's say we want to finance this green technology to come in really quickly and depreciate the assets of a BP or a Ford, do we also then want to do something to encourage those firms to exit quickly and redistribute that capital? Okay, so in isolation, I think these policies might even do more harm than good. Okay, so and I guess I would push the authors to think more generally about that stuff. I suppose also in the model you might think it's not so obvious to me that even if I am really exposed to a firm that I would choose not to lend to it, not to lend to a competitor. Okay, so if I know someone else is going to lend to that competitor, do I anyway want to lend? Okay, so if there was some kind of strategic interaction between these firms, the equilibrium might look much more complicated. Okay, and again, these are things that this very simple theory doesn't quite capture. Okay, so just food for thought for the authors. Okay, so let me turn to the empirical analysis. Okay, so I've said here very rich data and empirical results. Okay, so this is the understatement of the century. Okay, so they have credit registry data. I'm going to miss something. Okay, but they have patent data, credit registry data, B2B transactions, firm level data, and firm level data that includes these technology adoptions. Okay, and they're going to put all of these data sets together into this incredibly rich empirical analysis. Okay, so yeah, the amount of work that's gone into this paper is truly mind-boggling. Okay, so it's really worth. So I didn't know about this Belgian data, and it's super interesting. Okay, so let me just give you an example of the kind of specifications that they're going to run. Okay, these are kind of firm-level regressions. Okay, so yours explained this very well. This is intended as a kind of a first pass to show that these externalities exist. That it's the case that if I'm an incumbent firm and some green firm enters, that has some kind of that harms me somehow if I'm that firm. Okay, so what do those specifications look like? So this Y is some outcome, let's call it sales. Okay, what these Ds here are, that's a firm coming in, that firm D is exposed to, and there's two measures of exposure. One is this product space, that means the firm kind of competes with me and customers, and one is this technology space, we have similar inputs. Okay, so as these exposures increase, that should have some effect on outcomes, the theory says. Okay, and indeed, the most robust finding in this part is that entry by green firms into the product space of brown firms is correlated with lower sales. Okay, so if I'm an incumbent, a new firm comes in that's close to me in some kind of product space sense, my sales go down. Okay, so great. The problem is, of course, that's not a very demanding test of this theory, okay, because we'd be, as economists, I guess we'd be kind of horrified if it's the case that competitors come in and sales don't go out a lot, controlling for kind of growth in markets and so on. Okay, so one point where I would really push the authors is they have this great data, and it's an incredibly important question, is to really try and crunch down the analysis to really isolate, to really make this a more demanding test of their theory. Okay, so in some sense, it's not so surprising that as firms enter, my sales go down. Okay. The other thing I would say is that, maybe one thing that would be more persuasive if it's a case that they can document this not just for green innovators, but for any kind of entry. Okay, again, I think that would be interesting, and I think it would be interesting to see how much worse is a problem for green innovation than, say, for just any kind of entry. Okay, great. So let me skip this. So I'll just finish on this slide. So the next stage is the next kind of demanding stage, a more demanding test of the theory, is to see if this kind of redlining stuff happens. This rationing happens. Okay, so this is like a probability that a borrower that's green gets financing. And what these measures are here, again, yours did a great job here, these are measures of exposure. Okay, so how exposed, this is like a sum of how exposed banks are through their exposure to competitors to this borrower IT. Okay, and again, they're going to find evidence that it's true, okay, that these coefficients are negative. This coefficient are negative. When banks are more exposed, borrowers seem to get more ration. And of course, the challenge here is that we kind of know that these firms are going to be somehow special. Okay, they're probably small, they're probably risky. This is a moment in which there's a lot of technology coming in this space. I have no idea who the winners is going to be. In some sense, regardless of the theory, I would expect those borrowers to be rationed. Maybe I would expect those borrowers not to go to banks at all. I would expect them to get financed only through, I don't know, private equity or something. It sounds like the private equity industry in Belgium is maybe not like a behemoth, okay? But nonetheless, it's a limitation, of course, that we can only observe bank and firm links here. So one thing that I think would be super informative, just to kind of set the reader's mind at ease, is just a simple kind of cross-tabulation. How different are these green innovators from firms? I kind of assume that they'd be smaller firms. Turns out that they actually may be much larger. Okay, and maybe what's going on there is these large firms maybe don't need bank financing, or maybe InBev doesn't borrow from banks in Belgium, maybe it borrows on the bond markets in the US or something like that. Okay, so in general, it'd be great to have more information on what the data looks like. Okay, and again, I've said here what's special about green innovation. Again, it'd be great to see this for all kinds of innovation. We've talked about this offline, and it's a big challenge, okay? And a great virtue of this paper is that they can really isolate this green innovation stuff, which is fantastic. Okay, so this is a really important paper, a truly monumental effort to get at this question, which which we all care about very deeply. Okay, and so I really commend the authors, and I recommend the paper a lot. Where I would give some caution, advice and caution, is around the policy recommendations. Okay, it's not obvious to me that we want, it's obvious to me that there are some trade-offs here that we really need to think through carefully before kind of running to policy recommendations. Okay, and so read the paper, absolutely, both because you'll learn a lot, but also because, it's very inspiring, like it'll give you a lot of ideas for stuff that you might want to think about. Okay, thank you.
Thank you very much. We're a little bit tight on time. Joris, would you like to do a quick response to that, and recognizing you continue the discussion over lunch? But
yeah, I'll be brief. I'll be brief because I'm standing between you guys and lunch. Excellent discussion. So we've been presenting this at quite some places over the last few weeks and months. And typically we had finance or empirical banking people discussing this, and I really have the impression that you are pushing on different buttons, so it's very nice to have a different view on this paper. So let me answer two of the broader comments, let's say, that are in the paper. The first one is why climate change? Why not consider like more broader innovation? It's a good comment. I mean, the only answer to this is there are some technical I mean, even if we have great data at the bank, there are some limitations to the data we have. So in particular, so POTSTAT, for those who have worked with this, POTSTAT does not identify firms with VAT and identifiers that we can simply bring into the Belgian data. So they only have like names, and in Belgium you have French, Dutch, and German. So this is like a horror to match this to our data. So there is a practical issue there. Also, when measuring diffusion, we're relying on this survey, so diffusion of green technology. We do not have this counterpart for plain vanilla innovation. Second of all, what about positive externalities? It's a good point. What would a social planner want? It's a good point. We haven't really thought this through in the context of the model. In the empirics, we've done a little bit of teasing at that. It's not in the paper, but what we find is that green innovation also has positive externalities. I mean, so in our paper, the notion of technology space and being close to each other in a technology space relies on similar inputs. The literature typically has a different notion of a technology space, and it's based on patenting, like how close are these patents to one another in terms of technology. So when we measure it in that way, we also see that there are positive externalities. But in the empirics, I mean, if anything, this will work against us, so that's why we're not really pushing on that button. But it's definitely worth maybe tracing this a little bit further in terms of the theory. There's a lot of minor stuff, but I guess we'll talk over lunch. So let me stop here.
Do we have any, are there any audience questions? Recognizing we can also do those over lunch. I think everyone is probably hungry at this stage. So
I agree.
Thank you guys for a fantastic session. I'm afraid we have taken a bite out of your lunch time. We need to start again at 1:30, so enjoy a lovely lunch, and we'll see you in a little while. That was great discussion.
Afternoon, everyone, and welcome to the session on central bank digital currencies. My name's Jumana Salihin. I'm Chief Economist Europe for Vanguard Asset Management. I'm delighted today to have a very well-known panel of people. So sitting to my right is John Cunliffe, Deputy Governor Financial Stability at the Bank of England. We've got Cecilia Skingsley, First Deputy Governor Monetary Policy at the Sveriges Riksbank. We've got George Selgin, Senior Fellow and Director Emeritus from the Center for Macro and Financial Alternatives at the Cato Institute. And we've got Raphael Auer from the BIS Innovation Hub, Head of the European Systems Center. And of course, Cecilia will be joining the BIS later this year, but today she's speaking in her capacity as a central banker. So welcome everyone, and we're really looking forward to your comments today. Just to let people know, the structure that I'm going to follow today is we're going to kick off, dive right in to questions to the panel, and we're going to do that for about 40 minutes, and after that we're leaving 30 minutes for questions from you guys. So there'll be plenty of time for audience participation. So I want to kick off with a really important question, and Cecilia, I would like to start with you. And my question really is, why are so many countries in the world trying to build a central bank digital currency? In the language of the recent House of Lords Economics Affairs Committee report in the UK, to what problem is a CBDC trying to answer?
Okay, so thank you very much, Jumana, and good afternoon to you all. It's a pleasure to be here. So central banks, as you mentioned, central banks across the world is looking into this, somewhat for different reasons, but the reasons all rhyme. And the common denominator here is the digitization of societies, which takes a number of different shows itself in a number of different ways. And for central banks, I think this has opened up quite a fundamental issue around what is money, how do you provide money that is safe and efficient and provide us a stable store of value, how do you keep payments being safe and efficient and inclusive. Going back to the House of Lords, let me try to give you sort of an elevator pitch of why I think this is an important part. In a future where cash no longer works as an easy access to a store of value and a payment method, CBDC is really nothing else than the next technical version of central bank money, making sure that there is integrity in the monetary system and that we maintain the sort of general trust in it, and it's protected for all time. And this takes quite a bit of forward looking. You have to think about what it looks like in the future where cash no longer works, and then think about what you need to do today to manage that future. I don't know how forward looking the House of Lords is, but I hope that they will at least take that kind of stance in their next report on the subject.
Thank you very much. So George, do you agree it's the decline of cash looking into the future?
Well, not exactly. The decline in the use of cash, of course, is a result of the availability of other substitutes. It doesn't happen simply because people have no choice. In Sweden, it's happened quite a lot because they have good substitutes for cash already, presumably. There's no risk that cash will disappear on its own and people won't be able to use it unless central banks actually stop making it available. So I don't think that the fact that cash is going out of use, or looks like it's tending to go out of use, itself provides a motivation for other currencies as opposed to being a response to the availability of other means of payment. That doesn't mean that I don't think there might be some advantages to digital currency, as a substitute for cash, and that it doesn't mean I don't think it's worth exploring the possibilities for such currency. But then I would add, and I suppose I'll say more about this later, but I think that any innovations that central banks might achieve in this area could be better achieved and implemented by the private sector if it were allowed to do so, if it were allowed to have access to the central bank settlement and other facilities, and of course if it were properly regulated to keep it safe.
Thank you, thank you. So, you know, a little bit of a difference of view there. So, John, I wondered if you could help the audience to understand the distinction between a retail central bank digital currency and a wholesale central bank digital currency.
Well, thanks, and thanks for the opportunity to speak. The bad news is I'm recovering from a bout of COVID, and I may cough as I go through this. The good news is I've been testing negative for 3 days now, so you're all completely okay. Well, the tests are pretty accurate most of the time, anyway. So that's fine. And look, I heard what Cecilia said about the House of Lords, and she can say that, and I couldn't possibly comment. But just to address your question. So the simple difference is a retail CBDC is for use by households, ordinary people, for their everyday transactions in the way they use cash. So think of it as a digital form of cash, although cash is an asset issued by the central bank as a bearer instrument, and I think it's very unlikely that any of us would issue a retail CBDC as a bearer instrument. It would probably be some form of account-based instrument. Wholesale CBDC is really for the financial sector, for the economic transactions between the financial sector. So that's the high-level definition. But behind it, actually, I think there are some interesting questions about motivation, and this may just get into some of the things that have just been discussed. So in shorthand, I think, and everyone sees different motivations, and I won't go into the geopolitical ones, but I mean, two of the big motivations, potential motivations for a CBDC, and you know, people can argue about this, is one is as cash disappears, and it disappears because it's no longer fully functional money. You just can't use it in everyday transactions in the way that you used to. So as the use of cash goes down, basically public money, state-issued money in the hands of the citizen disappears. And one argument for a retail CBDC is it puts that safe asset back in the hands of the public, and that will serve a purpose in underpinning confidence in money, and that will serve a purpose in underpinning uniformity of money, because any citizen can take their commercial bank money or their private stable coin and be required to convert it into the digital central bank money in the same way that you convert your bank account money into state money every time you go to the ATM and withdraw cash. Now, we can argue about whether we actually need something in the hands of the public to anchor confidence in money and to create uniformity, but that's one set of arguments. The other set of arguments are more on the kind of benefits side, which is as the economy becomes more digital, if we can tokenize in some way, I use that word, central bank money, cash for people, it can be built into digital functionality. Think smart money, think programmable money. People can actually take the transfer of value, which is what you do when you pay for something, and integrate it into an algorithm so that it's automated, and then it just becomes part of your digital life, part of your social media. The money is fully integrated. And I think we're going that way. The question is whether it should be a publicly provided asset that can do that, or a privately provided asset. If I think about wholesale CBDC, the simple answer is we provide electronic money for the banking system already. The banks have, in the UK's case, accounts at the Bank of England. They exchange their claims on the Bank of England across our real-time gross settlement system. So they don't need a digital central bank asset. They already have that. We have that, and that is basically the backbone of the payment system in advanced economies. So that argument isn't strong, but the argument around functionality, being able to tokenize, being able to have instantaneous transfer, instantaneous safe transfer of value, that's a very powerful argument in wholesale, because you can not only tokenize the settlement asset, otherwise known as money, the value you transfer, you can transfer the thing you're buying. So this could be payment versus payment in a foreign exchange transaction, but this could also be delivery versus payment if you're buying equities, if you're buying bonds, if you're buying a house. Okay, basically the whole thing can be automated, and you don't have to have an intermediary to ensure that the person who pays the money gets the asset and the person who sells the asset gets the money at the same time. All of that can be integrated into the algorithm. You know, the fashionable word for that is DeFi. But basically, it is creating, if you like, the settlement transfer within an algorithm that takes out all of the intermediaries and reduces costs. And I think there the advantages are really around efficiency, cost, and actually developing new sorts of service. So my own view is there is a powerful argument for both of these things. There are many routes to Rome, and the route that most central banks are thinking about for the retail side is not that we would produce the asset, produce the rails on which the payment happens, and interface with the public. It's that we would produce the asset and the rails, but the interface with the public would actually be done by private sector payment providers, could be banks and the like, who would have the customer accounts and who would be able to integrate our tokenized central bank money into their digital applications. I think there are other models. One model is that we allow the private sector to do the tokenization and provide their own money, but we back it one for one with central bank money, which is the synthetic money I think you were, central bank currency you were talking about. And on the wholesale side, you know, central banks could provide the rails and the assets as they do now, but there are some private sector solutions now where actually the tokenization and the transfer is done by the private sector, and you just synchronize with the real-time gross settlement system and move it across. So where you put that cursor between the public and the private sector in both retail and wholesale, I think those are decisions that people will take on basis of security, efficiency, and the like. But at the moment, all of those things, I think, are being looked at in the sector.
Thank you. So let's just, I just wanted to get a show of hands from the audience, because I think, you know, when we talk about CBDC, retail CBDC, John's just told us very, very different from wholesale. But how many people, if CBDC was offered, would like to have that in their digital wallets? Let's see. There's a lot of people there, or okay, so that's a few. And how many would say, actually, I don't know yet, or no? Yeah. So it almost seems balanced with I would say a 30% sitting on the fence right now, waiting for more evidence.
Do you mind if I just interrupt?
No, please.
So the iPhone came out in 2005. How many people wanted one immediately? Sorry, for those of you that can remember 2005. Okay. If I'd have told you then that the only way you could travel was to have your health records, your airline tickets, your personal locator form on a phone, because you otherwise couldn't travel, and that you could book an Uber or whatever with an iPhone, would more people have wanted it? I mean, the point I'm making is asking people, do they want something that doesn't yet exist and for which the functionality hasn't been developed, is a question where most people, it's difficult to imagine.
Sure. It's difficult to imagine. I guess I was just thinking, you know, we know that in the private sector, people are very much into certain forms of digital currency. Yeah. So just wondering if the thoughts are out there. But at this point, I'm going to move on to get some evidence. So, Raphael, you've done quite a lot of work at the BIS on evidence from around the globe on central bank digital currency, range of design options being considered. Could you tell us a bit about those and what we have learned so far from those pilots?
Thanks for the question. Thanks for having me here, and everybody, thanks in the audience for being here. Let me start by saying I'm going to be speaking on my own account and not on behalf of the BIS. But what I do with my BIS colleagues is stock take really all CBDC approaches that are out there. We really scan all publicized projects. We get in touch with the experts at the central bank to really understand what is it specifically that this central bank is pursuing. And we have a database that we've just updated for the occasion of this conference. It's on the BIS webpage as I'm speaking. And there are now 68 retail CBDC projects around the world, and 28 wholesale CBDC projects. There are some very famous pilots, the e-krona one, or the EU one in China that has attracted over 200 million users already. And there are 4 live CBDCs, the Bahamas Sand Dollars, the DCC eCash, the Nigerian eNaira, and the newest one, the Central Bank of Jamaica's JAMDEX. We should be aware that sort of these are impressive numbers and they continue to grow impressively, but in all but these 4 jurisdictions that have issued CBDC, these are really conceptual approaches. So they could be technological approaches or they could be purely paper-based reports that inform the public how a CBDC could look like, right? Because it's like with the iPhone, we're talking about something that in most jurisdictions doesn't exist, and we need to kickstart the dialogue, this big dialogue, and inform it so that it can, result in a good consideration of the benefits and the negative sides of issuance. And with this disclaimer, let me still give you some trends of what we see. The first trend is that the vast majority of CBDC trials are those that involve a substantial role for the private sector. So basically, we could be talking about designs where the central bank, as it does today, really only operates the wholesale side and the retail sector connects with offering all customer-facing business. The second trend is that in terms of coexistence, and this is the strongest trend, there is not a single report that says that CBDC would be a substitute to cash. All argue that there are certain instances, online purchases, where physical cash cannot be used, and we need to find a digital complement to it. But there will be coexistence of physical cash and CBDC, even if CBDC were to be issued. In terms of technologies, early CBDC trials focused on blockchain-inspired, cryptocurrency-inspired technology, but that has shifted over time. It's not swung to the other extreme, but it's much more balanced now, and central banks are considering designs that are based on traditional centralized infrastructure, as you would use when you use your iPhone, right? There's a lot of resiliency in these systems, so data is distributed across the globe, but it's really a hierarchical infrastructure where there's one focal node that sort of coordinates everything, and it's not a DLT where you have different entities that don't trust each other. And last, and I think this is also very important, is that the international focus has really come into the fore. Also as part of the G20 initiative to bring down the cost of cross-border payments. And we have 2 panelists that are very center pieces in that global effort. And so these are sort of the 4 major trends in CBDC issuance. And I want to close by giving sort of one takeaway, and it relates very much to sort of this debate that we have on what is it actually good for. And I want to make one specific example in the context of a number of projects that the BIS Innovation Hub has been running on MCBDC arrangements. So those are arrangements between several central banks that facilitate cross-border payments from one CBDC to another. And I think sort of all these experiments, they show this is technologically feasible. This may bring certain efficiencies, but it comes with a set of government issues on how to design them conceptually, how to operationalize them, and how to operate them together. And the most striking point is about access. So these trials, they involve a jurisdiction that is domiciled in one country getting short-term access in another country, to the CBDC of another country, which makes it easier for them to minimize settlement risks or manage their liquidity in foreign currencies. And now the key point is this. We could do these things in traditional account-based systems. It would just be very cumbersome because every night we would need to, right, for example, in Jura, This is it's a project between Switzerland and France. This is given on an intraday basis, but every night it's netted. And you could, right? You could have somebody who goes through all the accounts of non-resident institutions and nets them each evening, but it would be very cumbersome. It also comes with question of, if my jurisdiction holds foreign CBDC, what is sort of the information I get about this as a central bank? And it comes with a big discussion about how we can arrange the government of this system. And so these MCBDC experiments, they combine all this, right? They are a technology to automatically net at the end of the day. They're operationally simpler than doing that in the traditional account-based system. They come with a new discussion on, well, if I give your institutions or access to my CBDC on an intraday basis, you know, what is our common approach? What are our common standards? And it's clean slate. And they come in a platform where we can agree on the automatic information exchange. So all of this, right? Small, technologically enabled changes to policy discussions that we could have had a long time ago, but that we can have now because we have clean slate technology and because we have systems that can make certain things operational in an easy manner. And I think sort of that's what we need to focus on, not these big discussions, how would an all-encompassing CBDC change the monetary and financial system, but the specific niche cases and where do we see the specific benefits.
Thanks, Raphael. If I could just ask a follow-up question. It sounds like, you know, a lot of efficiency, costs are down, transparency, those are the really good things. Is there anything that we're learning kind of on the negative side?
Well, yes, we have released a report on these 4 experiments, and we're not shy on the negative side, which is that, you know, increasing integration comes with increasing need for coordination, and historically it has been very difficult to coordinate. I want to remind about this, you know, ISO 20022 standard that is supposed to harmonize payment messages around the world, and true to its name, it took about 22 years to be implemented, and it's still not there 100%. So, you know, this is why you have to be to admit that this coordination is very difficult, because, you know, there are legacy systems, there are legacy interests, and they will determine the next steps, and you really have to coordinate from the get-go to sort of overcome them.
Thank you. So you made a good point there on, you know, it's not just about the monetary and financial system, but I do want to move on to the impacts on the monetary and financial systems. So, Cecilia, this one is for you, that some commentators have highlighted the risk that the introduction of a CBDC might lead to a disintermediation of the banking system in normal times, or if not that, at least in times of crisis, there could be a heightened risk in systemic terms of, say, bank runs during times of stress. Should we worry about these risks?
So that's one of the most kind of recurring question. And if I had not left my mobile phone outside the stage there, I would have taken it here and waved with it and pointed out to you all that I have all the access to my current bank accounts in my 2 Swedish banks at the tip of my finger. And I could make my own personal run from one bank to another as we sit here, but I can also exit the Swedish banking system, not into cash, obviously, but I can go for a very close substitute to central bank money, which is a mutual fund that invests in treasury bills. My point with this is that we already live today in a world where we can all run left, right, and center. And I think the interesting question is how much, if any, additional risk would the introduction of a CBDC be to the sort of run risk? So that's one observation. My second observation on this is that it's not exactly a sort of human right for universal banks to preserve the current funding model that they use. sometimes when you hear bankers talk about this, they say, well, you know, this is the way we fund ourselves, and we need a deposit base, and you can't introduce things that sort of threaten us. But if you look around in the banking system across the globe and from an historical perspective, there are many different versions and business models and funding models of banks, and they sort of move over time. And the banks are already now sort of competing for deposits, if I may call that, from e-money providers, from other versions of other players in the ecosystem. So we're already living in this system. And the disintermediation, if I may call it that, is already kind of happening. If the CBDC introduction, it's not in our interest for central banks to cause financial instability. I mean, most of all, after all, have financial stability departments within our organization. It kind of says something. We don't want to harm, but it doesn't mean that we are preserving the current banking models at all costs. We are in this to provide the public goods, and that means that if we do this, we're going to kind of do it gradually, or we can put in frictions. But I think it's a bit overblown, this argument against CBDC that, oh, it will cause a lot of run issues. All of this can actually be handled, and that's also been the conclusion of a number of governors, 7 central bank governors who've been looking into this. Yes, it could add possible changes, but it can be handled.
Yeah, thank you. So some of those trends are already there. And so it's not something that maybe we should be worrying about, and not even in times of stress.
We should be always concerned, but be watchful. But there are ways to handle this, both in a kind of preventive version but also in a more turbulent time. That's my opinion.
Do you agree?
I'm afraid I don't agree with Cecilia again. And I'm going up against all 7 of those governors when I make these remarks. First of all, if I take money out of my bank and put it into a money market fund, I don't withdraw reserves from the banking system. And in that respect, there's no disintermediation. The risk with central bank digital currency is a risk. The disintermediation risk is a risk that by withdrawing funds from conventional banks and money market funds, for that matter, and putting them in central bank digital currency, you're withdrawing reserves from the banking system, and this can have an adverse effect. The problem is that central bank digital currencies could pay a rate of interest that is actually above the rates that are paid by ordinary banks, and not because they're more efficient. Let me give you an example. In the United States, many of the proponents of Federal Reserve digital currency have been recommending that the Federal Reserve would pay the full interest rate on reserves, which is their equivalent of your bank rate, to the holders of these deposits. No bank can afford to pay that rate. It has to deduct its intermediation costs. It ends up paying a much lower rate. I don't say that banks pay as much as they should. There's monopoly power and all that. Nevertheless, you don't have the problem that digital currency pays more than other bank-supplied substitutes for official money. Now, this is a very real danger. In principle, in theory, the central bank could change the rate or adjust the rate it pays on central bank digital currency to make sure no disintermediation takes place. In practice, though, that rate can end up being a plaything of politics. And I'm going to give you a historical example, and it should give you pause. Before the Great Depression, and for some time afterwards, we had a postal savings system in the United States, and the interest rate on those savings accounts, postal savings accounts, was set bureaucratically. Now, until the Depression, it was not a terribly attractive rate. So banks didn't have any problem competing with the postal savings system. In the Depression, rates fell generally, as I'm sure you all know, but not the postal savings rate. And everyone who could was maxing out on those postal savings accounts and disintermediating from the banks, which was at a time when this was the last thing anybody wanted. Fortunately, there were caps on total postal savings accounts, maximum amounts per depositor. And it was only for that reason that the existence of those accounts and the rates paid on them didn't result in a still more massive disintermediation crisis. So one has to think of the politics here, not just not just a scheme of optimal interest rates that could be designed to preclude disintermediation, but the reality that these rates are likely to be informed by political considerations. And then the risk of disintermediation should be, it becomes a very real risk that central bankers should worry about. So I think that there is a danger here. I should also say, if you have a privately supplied, and I don't mean just privately administered, but privately supplied digital currencies, say with 100% backing of settlement reserves, or what we call master account balances in the United States, you wouldn't have the same problem, because then again, the private digital currency providers would not be able to pass on, even if they earned it, full interest on reserves. They would deduct their own operating expenses. And I should add, just in case it isn't clear, the problem here is that central banks earn huge monopoly rents. Now they're earning a little less than, or a lot less than they usually do, but there's still there's a lot of fluff there. And they do cross-subsidize their services. They have the tremendous capacity to do that. So even if they're earning less on their portfolio, as is the case now, they can continue to pay interest on reserves that is not a reflection of their portfolio earnings at the time. And ordinary banks cannot do that. So there's a lot to think about here. It's not a problem to be easily brushed aside, in my opinion.
Thank you. So one, no, we shouldn't worry about disintermediation. One, yes, we should. John?
Paid-up member of the Central Banking Trade Union, so this won't come as a surprise. And I think there are some jurisdictionally specific issues here. I don't know if there's anybody French in the audience, but I seem to remember the Livret A in France. You have government-administered savings rates at certain banks. So if governments want to interfere with savings rates, they have plenty of ways they can do that. It's a societal choice, a political choice. Clearly in the US, the cursor has been put in a different place. And I just say, by the way, yeah, the Bank of England's profits on QE and the like go back to HM Treasury, and the seigniorage that backs the note issue goes back to US Treasury.
After your costs, though.
Pardon? After the cost of producing the banknotes. After the cost of producing the banknotes.
We have to return.
Well, many things are different across the Atlantic, I think, to other jurisdictions. I just wanted to make a number of quick points. First, just to endorse Cecilia's point, the balance between cash and commercial bank money has been changing in our economy frequently over the last couple of 100 years. When I grew up, most payments were in cash, most people were paid in cash, central bank money, and actually commercial bank money was much more limited. So this is not some sort of new thing. This is a balance that shifts backwards and forwards, and banks will have to adjust their business models. And I very much agree, it's not our job to defend particular business models. And I think in terms of credit creation, that is not something CBDC would do. So the credit creation aspect of this, banks issuing liquid liabilities against illiquid assets, I think would carry on. What we're talking about is when they create those liquid liabilities and they then leave the banking system, which is what happens when you take some of your money out of a bank in an ATM. That's exactly what happens. When those liquid assets of the banking system don't get redeposited in the banking system, but in a CBDC or a stablecoin, and actually a reserve-backed stablecoin would mean exactly the same thing. When that happens, okay, can the banks actually pull the money back into the banking system, which is what they need to do. And we published a paper about this time last year on some of the aspects of digital money, which looked as an experiment to see, well, what is the size of the, how many sort of bank liabilities would go out of the banking system? How many people would take their money out of the banking system, put it into a CBDC? And then what would that do? Because the banks would have to pull that money back into the banking system by paying higher rates. One of the big problems with a CBDC, of course, and with a stable coin, whether it's reserve backed or backed with high quality assets, is we don't know the customer demand for it. This goes back to the iPhone. So half of the critics of CBDC will tell us that it will pull all of the money out of the banking system, and the other half will tell us there is no use case because the public don't need it, and it will pull out none of the money. And actually, it's quite difficult to say, well, what should we test? So the best proxy we could find was to assume that 20% of the sight deposits in the banking system moved out of the banking system and into a CBDC, into central bank reserves. We chose that number because that's the amount of uninsured deposits in the banking system. So people might think that the central bank is safer, therefore, I'll take out my uninsured deposits and the like. We also did some behavioral surveys on what people valued, safety and convenience, which pointed us as a cross-reference to the same number. This was all published last week. And then we ran a model, general equilibrium model, to work out, well, if that leaves the banking system, it's got to be pulled back. How much extra would the banking system have to pay? Because they'd have to pull it back for the wholesale markets. And what would it do to the cost of credit and the cost of intermediation? Numbers we came up with and the different assumptions range of between 20 to 80 basis points on the cost of borrowing if the money went out of the banking system and then had to be pulled back in again by banks attracting it. Now, there are lots of assumptions in the model, and you can run different assumptions. We can assume it's 100%, in which case I think it's a much bigger issue. We can assume it's 0. We have to be careful, and as we don't know the behavioral response, whether people will want lots of CBDC or little, I think most of us are thinking, were we to introduce one, in the initial years, we would introduce one with transitional limits until we got a much better idea of how it will be done. But the idea that somehow if we do this, we will destroy the banking system, I think, as Cecilia said, is much overblown. And just on the question of runs and what could happen in a flight to safety, I mean, just as a general principle, and this is a personal view, I think if you're dealing, if you have a problem with a failing bank, do you actually deal with the problem in the failing bank, or do you deal with the problem by preventing people to running to something safer? It kind of feels counterintuitive to say to people, we will block your access to safe assets so that you can't leave unsafe ones. Because that effectively is what we will be saying. We will be saying, we don't say to people, you can't hold more than a certain amount of cash because that's safer than a bank. Okay? If you have a problem at a failing bank, and Cecilia is right, we saw actually with a bank in the UK, internet rumour that it was in trouble. It took about 10 minutes for the internet run to start on that bank about 3 years ago. So it's an incremental problem, not a new one. But if you have a problem at a bank, you have to deal with that problem in the end in the banking system. You have to deal with it with the liquidity. You have to deal with it with the access to central bank reserves. And if necessary, you have to deal with it with a moratorium, with resolution, with a gate. But there's something quite weird for me in saying, you know what, we don't want to give people access to something safe in times of crisis because we want to lock them into something unsafe. If you want to lock them into something unsafe, do it directly by acting on the banking system. And I think we've somehow got ourselves into almost a perverse backwards way of looking at this problem. So frictionless access to CBDC will probably make bank runs easier. It'll take out some of the costs. We see a lot of that at the moment. It may be a bigger attraction. But if we're going to address that problem, we have to address that problem in the way we deal with failing banks, not, I think, by blocking citizens' access to digital cash.
Thank you. Thanks. So quite a lot of views there, a lot of things to worry about, and some uncertainty there as to behavior and how things will pan out. Let me move now to monetary transmission mechanism. Raphael, if I can start with you here. How do you expect the introduction of CBDC to affect the transmission of mechanism of monetary policy? Is there any implication for our staff, for instance?
Thanks. I think that's an important question for this audience here, where we have a lot of academics who write on these issues. And I think there is sort of when I look at the academic literature and then I look at the policy discussions, there is a divide. And the divide is that, no, let's walk through the channels theoretically. I can, with a CBDC, I can apply a negative rate that I can apply to cash. I can change that rate. So not only can I break through the zero lower bound, but I can also apply monetary transmission directly. And then there is a debate on, you know, how risky the funding base of the private sector becomes. So that is right. Those are the theoretical channels, and we see a lot of papers on that. But when I then sort of go back to the policy discussions, they're of very different natures. They start, and I think that's the sort of the quintessential argument has been made in this group of 7 central banks and BIS report on the core principles of CBDC issuance if an advanced economy were to issue one. And 2 of these core principles are coexistence with cash and do no harm to the commercial banking system. And there is a number of policy instruments that we can think about that can make this happen. We've talked about caps now with really caps. So for example, for the digital euro, 3,000 euros has been mentioned as a cap. They cannot be hard, right? Because then that would result in a broken payment system where some accounts are at the maximum and they cannot accept incoming payments. That can't work. But the ECB's Ulrich Binsal has come up with a very good proposal for a tiered one, where you have a cap and above that a very negative interest rate applies that will economically push funds back into the system. Or, and that is already adapted in the Bahamas Sand Dollar, every CBDC account has a linked commercial bank account. And if an incoming payment goes over the cap, which is I think $2,000, that automatically goes back to the commercial bank. So you can only hold $2,000 in CBDC. And all of these, you know, approaches have in the backdrop, we want to save payment vehicles that you could use in times of, you know, illiquidity or financial turmoil to do your retail payments. But we do not need a large safe store of value, right, that will disintermediate banks. So that is the policy debate. And if I now tie this back to these academic arguments, I think, yes, these theoretical arguments are there, but if I have a CBDC that coexists with cash, then the zero lower bound is still there, right? If I have a CBDC that sort of limits or, you know, has strong economic incentives to limit the overall outstanding amount, then the systemic implications will be small. And last, if the systemic implications are small to begin with, then also the sort of the flight into the CBDC is very contained. So that's why I think sort of we really need to sort of, you know, see these arguments of what could happen in the context of where central banks want to land. And then I see these effects as very contained.
Cecilia, would you like to comment on this question?
Well, so on what sort of monetary policy consequences from introducing?
Yeah, will it affect the monetary transmission mechanism in any way, either improve it or make it worse?
So hard to say, depend on design. Our starting point, when we started to look into this 6-7 years ago at the Riksbank, it was never about kind of improving kind of monetary policy toolbox. And just to go back to your comments, George, on kind of the risk for kind of overreaching political influence, central banks kind of growing out of proportion. You have a very important point there. Really, we don't. That's not the road we must take. Definitely not. So and one of the most important projects right now, when it comes to the e-krona in Sweden, is actually the politicians looking into this. What is the need? How can we kind of frame that? What would be the suitable legislation? Because this is not something that the central banks should just pop out introducing without a very disciplined conversation. So thank you for bringing that up. So our starting point, as I said, has never been about the monetary policy. We see it as a kind of as part of our objective, providing or kind of supporting rather a safe and efficient payment system. But introducing it, we have to kind of be mindful about the aspects. And for example, if it would affect the R-star, meaning the long-term trend kind of level, where the policy rate is neither expansionary nor contractionary, we are always, when we have been struggling with too low inflation for too long, feels like a long time ago now, but we did that for a number of years. We of course are more interested in a high R-star rather than low R-star, and if you are successful, which we hope to be, in increasing the efficiency in payments, well then all other things equal, the productivity in the economy would rise, and that would be good for the R-star. If we fail, then it's the opposite. But as I said, it's not a primarily monetary policy issue. We don't have a transmission problem in the Swedish economy, so that's why we sort of see this as very separate issues.
Thank you. I'm conscious that we are moving into audience Q&A time, so I'm going to ask a couple of quick-fire questions. So if you could just answer them in 1 or 2 sentences, please. First of all, are we likely to see CBDCs being rolled out in earnest in advanced economies over the next 3 years? John, starting with you and just moving down.
I think it's unlikely that you will see a full CBDC in operation in the next 3 years in advanced economies. Most of us think it's 4 or 5 years at least to develop one, test it, trial it. Remember, if you do a CBDC, it can't be like Terra or Luna. You know, it's got to work on day one, and it's got to keep working. We have reputations.
So China surprised us all. So I wouldn't be surprised if we get a bit surprised. But on the whole, I agree with John that probably a bit longer than 3 years. But I think we will see some pilots in advanced stages trying out kind of in a limited version within 3 years.
George.
Yes, I agree with Sir John also, having seen how long it's taken to roll out FedNow. And I think this could be much more complicated, even if it's just account-based. So I don't know if it'll happen in the United States, by the way, but I suppose it's probably going to happen in some advanced country in the next 5 years. The only difference I would add is I'm tempted to add an alas to that.
So I don't think that in an advanced industrialized economy over the next 3 years we could get a retail CBDC. We will see increasing experimentation on wholesale, maybe going into sort of production-ish stages. It could happen within 3 years, but I wouldn't be certain about it either.
Thanks. And then my last question, again, quick fire. Raphael, maybe starting with you, so we move backwards this way. Given that this is a conference and we've got a lot of young researchers here, what questions would you like to see researchers focus on with respect to CBDCs? What are the big open issues?
Well, I think, and we have a piece out at the annual economic review on this that really lines out sort of what the academic literature covers and where there are gaps from a policy perspective. And these are also, you know, gaps that sort of central banks should look at an operational level. I think it's really cybersecurity, very much related, offline resilience and privacy. That would be one important aspect. And then another important aspect is open systems. You know, in the end, if CBDC is sort of small from a systemic perspective, but has still important impact on market structure, it's via competitive channels. So how can you get that? How can you design an open platform that doesn't mandate technology, but that still creates an open and competitive ecosystem? So I think those would be the two things, and I'm happy to say that sort of at the Innovation Hub, we're already looking into these and that's really a coincidence, in the London and the Stockholm centers of our hub.
Well, my heart's desire would be to see central bankers spend more time researching digital currency, but not just central bank digital currency, and exploring the possibilities for private retail digital currencies and how they could be managed and regulated to serve the same purposes and perhaps others, and to do so safely. Particularly, I think they should be considering the likely extent of ongoing future financial innovation to be expected, on the one hand, from a system in which they directly compete with private sector firms, and on the other, from one where they leave the field open to those private firms without directly competing with them?
Okay, so most research we've seen have been kind of central bank and current financial system centric. So trying to look from the other perspective, using perhaps experimental economics, think about how to build and launch infrastructures that that kind of support innovations. And this is not any kind of market. This is in a market with strong network and economies of scales. So it kind of takes it's a bit demanding to look into what sort of infrastructure and rule book should you build in order to kind of bring out all the good bits that we want: safety, stability, inclusion, but also where the public sector doesn't play a bigger role than that is necessary.
So I think the area that's underdeveloped is behavioural. How people think about money, how they use money, different functions, what things make them use money and what money in certain forms rather than other forms, just to give us some idea of how this product, whether it's a private stablecoin or whether it's a CBDC, how this product would change the way transactions, the way people store their value, what they do. And actually we learn from some of the technology projects is it takes sometimes a very small change. Just the ability to use your watch, not your phone, and certainly not your debit card, unless you're very old-fashioned, to buy your cup of coffee, just can induce very large changes in behavior. And we don't really understand the way taking away little frictions can lead to big tipping points. So something in that area I think would just be very valuable as we explore this.
Great, thank you. So we're now open for questions, and what I'm going to do is I'm going to ask people to state their question, 2 or 3 questions at a time. So let's start here at the front. Just 1 second, wait for the mic to come to you, and then we'll go at the back over there. So start here.
Hello, my name is Kamal Shumba. I'm a reporter from CoinDesk, which is a crypto publication. And I have a few questions. So the first one is, so this is for the BIS. So what infrastructure would the BIS encourage to ensure there's interoperability between nations' CBDCs in the future? Because you mentioned a bit about that, Cecilia, at a conference. And then the next one is, so for John, you mentioned when we can sort of expect to see a CBDC in general, but just curious to know, like, when could we see like a UK CBDC, and like how long will that project take? And another one for the BIS. So essentially, what is the BIS doing next in terms of CBDCs for Cecilia and Raphael? Thanks.
Thank you very much for those questions. So one at the back there.
My name is Marcus Miller, and I have a question which I guess is really for Raphael Auer on the issue of the competition between the private and the public sector. Which hasn't been discussed yet. In a recent talk, Hyun Shin argued that there are, for cash, there are positive network externalities, but that's not true for private providers of stablecoin, for example, who actually make money when there's congestion or a shortage of the product. And in his view, this seemed to suggest that the private sector, unlike what I think George Selgin was arguing, would not be the optimal provider of the kind of new cash. So this is not a political question, it's an economic question. I wonder what the panel thinks about that.
Thanks very much. So I don't know, John, do you want to go first, or Raphael?
The UK question. So we've said that we can't see wouldn't expect to see a CBDC introduced in the UK before the second half of this decade. So that goes back to my 4-5 years timetable. We will, with the Treasury, because as Cecilia said, this is a political issue. So the Bank of England, the Treasury, will produce a consultation document by the end of the year on CBDC model, wonder what the next steps should be, and that'll come out by the end of the year. But I couldn't see one being implemented, operational in the UK, certainly until the second half of this decade.
Let me answer the specific question on congestion by Hyun. I happen to know sort of what paper he had in mind, and I think sort of there is a confusion here. He was speaking about the limited throughput of blockchains and the economics behind it. This has nothing to say about, you know, a bank-operated payment rail or something. It's really about the fact that any cryptocurrency has, you know, it's distributed, needs to be stored in many places, and it also needs to generate some income for sort of the miners that update the blockchain. And the only mechanism you have is that you make these blocks small so that there are capacity constraints, there are curves, and then people start to bid up fees. And that's sort of the mechanism via which cryptocurrencies generate income for the miners that make the blockchain secure. But that leads to sort of an overall rather limited capacity, right, in the order of magnitude of a few 100,000 transactions per day for Bitcoin, for example. So, but it is not an argument that relates to any sort of a centralized database run by a private firm. It's a specific argument to certain blockchains.
Certain blockchains is an important qualifier. That argument applies only to proof of work type arrangements like Bitcoin. The stable coins that are likely to the US dollar or British pound stable coins that would likely be alternatives to central bank digital currency wouldn't pose any of these problems. I suppose if somebody tried to design one like that, it would run into some stiff competition, and that would be that. But the externalities that come from currency itself apply to any currency that shares the same network that is compatible with the main currency of account. So what you want to encourage that with the private sector is to allow this compatibility to be as complete as possible, which means providing settlement accounts and letting them be integrated with the legacy payment system. And that's perfectly possible, and indeed it makes it easier to require private coins to be backed with high quality liquid assets and keep an eye on that backing.
Thanks. There were a couple of questions down here as well. 2 questions down here.
Hi, Tim Jackson, University of Liverpool. So CBDC would likely generate seigniorage, just as cash does, and it would. I'm guessing most of the proposals for CBDC would be used to hold bonds, government bonds. So I guess, should we think of this as a good thing? We kind of the government or the central bank is earning seigniorage, we can then transfer to government, or is this a bad thing? I mean, how much of that does the effect of the fact that the central bank will be holding bonds in the long run because there is a demand for CBDCs and therefore they'll be holding a whole lot of stuff? How does that affect? What do you think about that, I guess?
Then there's one right at the front. Put your hands up if you have a question.
Thanks for a great discussion. My question was going to be about the regulation of private stablecoins. This was a theme in Nellie Lang's talk yesterday as well. I'd be interested in the panel's views, particularly if it's a horizon of 5 years plus before we see a CBDC potentially. There's going to be plenty of scope for innovation from the private sector. What do we need to see on the macroprudential regulation side?
Okay, so seigniorage being a good or a bad thing, well, in the same way as the Bank of England is sort of recycling its earnings back to the Treasury, it works the same for most central banks. And it's true that it is after cost, but we are always, as central bankers, at least in my impression, mindful that you mustn't let the costs run away, because then you will get some difficult questions from your masters in your parliament, so you have to restrain that yourself. I think, Dave, you touched upon this issue of regulation of stable coins. There is a flurry of different work groups looking into this, but this takes time. This takes a lot of time, actually. So let me just point out one thing. the global financial crisis, it was pretty clear what needed to be mended then in terms of regulations and supervision. Does anybody know how many years it took from the actual crisis until the last part of that regulation is being fully implemented?
12.
I'll give you the answer. It's 25 years. It's quarter of a century. So, you know, it takes time. A number of countries needs to come together, and it gets further delayed by a flurry of lobbyists and then domestic vested interests. So don't over-believe what regulation can do, because it's usually a lot of troubles could have happened in the meantime.
So on the centerage point, the only point I'd add is, what's your counterfactual? Is your counterfactual a payment through a credit card company that is costing 140 basis points for a small merchant in the UK and probably closer to 400 basis points in the US. So you look at why some of the payment companies are the most valuable companies in the world, and you get some idea of the rents that can be charged through payment systems. It's truly astronomical. On the question of regulation of stablecoin, 2 points. One, the international committee that I chair, the CPMI, has issued consultation or will issue a final on how the international standards for systemic payment systems, think of it as the equivalent for payment systems of the Basel standards for banking, how they should be applied to stablecoin. And that includes what should the backing assets be, what's the redemption, what's the claim, how do you ensure that if a stablecoin is being used as money in payments at a systemic level, it's safe. I hope we'll put out the finalized guidance on that before the summer break. So internationally, Cecilia said it's slow work, but we've started on that. That will be for single currency stablecoins. There'll be more coming on multi-currency. For the UK, well, I know I would have said yesterday. Can I say it today? I think I can. So for the UK, the Treasury have said that they want to introduce legislation on creating the regulatory system for stablecoins, private stablecoins used in the UK. And I think they were aiming to do that before the summer break. I mean, it may get a bit delayed by some events that have happened recently. But the consultation has been out there, the response is out there, and that will give the Bank of England the power to regulate systemic stablecoins, and the Financial Conduct Authority non-systemic. The Financial Policy Committee of the Bank of England has said very clearly that we don't think that you have to be a bank to issue a stablecoin. And we've also said that the only two backing models we can envisage as safe are backing with very high quality liquid assets or backing with central bank reserves. So we actually are thinking very strongly about central bank reserves and how does that work? Not as an alternative to CBDC, because I think we believe in a mixed ecosystem and different forms of money as we have at the moment. And if that legislation proceeds on that timetable, sometime around the end of this year, we'll put out a consultation on the regulation of stablecoin used in the UK at a systemic level, because we're interested in systemic. And I think, David, that goes to your macro question. But actually, the expectation that the Financial Policy Committee set now 3 years ago is the guiding light, which is if you're used as money at systemic level, then you have to offer people the same level of robustness as commercial bank money or central bank money. And you may have to get there in a different way, but people have to have the same confidence in its stability and value, creditworthiness, as they have if they're using central bank or commercial bank money. And that'll be the test for us.
Thank you. Do you want to make a quick point?
Do I have time?
Yeah.
I'll be quick, because I first of all, I think the approach to regulation, as Sir John described, is very sensible. I think the main thing is that private stablecoin issuers, of course, first of all, they should be safe. And that means that if they're not banks, they have to have very strong reserves. I don't see any other way that's going to be practical. And but I also think it's very important that the arrangements, the regulations be such as allow non-banks to take part, because they're the pioneers in this area. And banks, many of them, frankly, are not interested in competing. So I think that those are the main ingredients. You want competition, you want rivalry, and you want safety. And so I hope we do something like what you're promoting.
Thank you. So final round of questions. So please put your hand up if you've got a question. One here.
Can you hear me? I wanted to ask about the numeraire. So if cash is disappearing and if CBDC doesn't come in, then what is the numeraire? I'm a bit lost. I'd love you to talk about that.
Question from the top.
Hi, Varun Paul. You talked about CBDCs being some years away. You talked about interoperability, but you also said we might build, so John, you said might build account-based rather than token-based, and Raphael, you said there are still some projects building on traditional architecture. So how do you square those two things? Are we building for the future that is interoperable, or are central banks building a technology that in 5 years' time will have been innovated by the private sector?
I think this is, what is the numeraire? That is such an important question that we don't think about enough. What anchors our thinking about what money means to us? And it's a, it's a question, it's very abstract, right? But it's very important because when you think about what you do in your life, right? You have a job and the primary purpose is to get that many units of that numeraire because you can relate to these units and it will give you, this consumption stream. And with cash, it's a physical incarnation, and it makes sort of this abstract concept much more tangible. And that's, if you think about the history of central banking, the standardization of cash has been a major building blocks, right, in their history. And that's why also sort of, right, central bankers really think that this could be an important function of CBDC, just to anchor our understanding of what 1 unit of a pound means in the consumer's mind. And that is, it sounds a bit abstract, but it's really important when you think about how just knowing this yardstick, what does 1 pound mean to me? And where do I allocate my expenses? When do I decide to work or not? Or for what job do I go? All of that, imagine how difficult it would be if you had to weigh it in loaves of bread and iPhones and so on. So I think this is, it's a quintessential question. And even if it won't be paper-based, it will still be sort of a central bank digital standard that could come in a certain visualization and in a certain access format. And it would pertain some of these criteria as much as you can.
This is what I research. So what I'd say is there is a school of thought that says the public does not need to hold a central bank asset to have confidence in the numeraire. Central banks do their job of maintaining the value of the currency, okay, a bit challenged at the moment, but we're doing our best, then people will have confidence in that numeraire, so long as the private sector banking system is required to transact in the numeraire, i.e. settle across the books of the central bank, they will then use the numeraire and it will go down. There's another school of thought that says, actually, there's something about the symbolism of holding the safest asset, the state asset, that underpins some of that confidence, which is the point you're making. And if people eventually realize that they can't hold the numeraire in its purest form, then in a crisis or whatever, you could get a loss of confidence in money. And there's really no way of knowing kind of how that functions behaviorally and psychologically, which is one of the reasons why I think it's a kind of area about how people think about money and what's important that really matters. But look, you have dollarization at the moment, and if people lose confidence in what is behind money, the institutions of the state that are behind money, then you'll get digital dollarization. People will leave the currency and go to another currency. But I think there is a question about how close do the individuals in society need to be to central bank money to have confidence in the monetary system as a whole, and that's a motivation. So.
I mean, this, of course, goes back to Adam Smith, who believed that it was desirable that the public should be made to continue to hold some species, silver coin, even as banks in Scotland were capable of completely substituting their IOUs at that time. They were very good at it. But he thought that there should be limits on the size of banknotes, no small ones, so that some coin would remain in circulation.
Very quickly to the question of the gentleman up there. So, without going too much into the details of account-based, token-based, DLT, not DLT, I think the job here is to build infrastructure that is agile enough to kind of move with time. If you look at any kind of transport system, electricity, telecommunication, RTGS systems in central bankings, that's what we do, really. We kind of evolve and rebuild over time.
So I did say it was the final round, but there's one more question here. If anybody else wants to put their hand up, this is really your last chance.
Anna Stavpova, National Bank of Ukraine. And I have a question, how you can assess the situation regarding the implementation of financial monitoring that prevents money laundering through cryptocurrency in terms of the issue of update sanctioned list of Russian citizenship? Thank you.
Just pass. Take that one quickly.
Thank you. I have a question, or two questions. So currency is older than the Bank of England. It's even older than the Riksbank. It hasn't really been updated since then. The use of it is pretty much the same software version, if you will. And now we're talking about really the biggest software update. And it's that you can transact currency far between. That's the huge thing. So the first question is, why do we need to build more updates into it, such as, do we need to pay interest on currency? Do we need to monitor what's going on with the currency? So why are we complicating it at this time? It is. The second question is, and it's, because it's interesting to compare Sweden and the US, where Sweden has seen currency come down dramatically, while the US has seen it go up significantly. Mainly the $100 bills that you don't see, but it's 85% of all the bills. So I studied in both Sweden and the US. Interesting thing in the US is it's really costly to be poor. If you have less than $1,500 in your bank account, it costs you $10 per month. So it's maybe that sector of the economy and the importance of that for central banks to step in and create one currency for everyone.
Thank you. So very quickly, who wants to go?
So very quickly, there is a lot of difference between George's country, which is more of a continent really than a country, and mine. But be mindful, it's too crude just to look at the money, the value in circulation, which I'm sure goes up in most countries actually, goes down. You have to look at what people are actually doing with their money, and I'm pretty sure that also in the US, digital payments are kind of skyrocketing versus cash payments. And I think a lot of central banks came to me when we were starting this project. Why are you doing this? Because they were seeing their currency circulation going up. When they looked at the payments in their society, I think that goes for the United Kingdom, for example, they came to the conclusion they were just a couple of years behind Sweden. And once people have changed behavior, they don't go back. And I have to say, the last thing I say, George, you said in your first intervention that cash will not stop to be accessible in the United States. I think if we sit here in 10 years' time, you will find that also dollar cash will have stopped being accepted as a payment method in great many parts of the US. Future waits for no one, not even American citizens.
Yeah, I've been wanting to agree with Cecilia all night. I do agree people could get cash, but they would have trouble using it. and I think that's right at some point in the future. I want to take advantage of the gentleman's question, the first question about banknotes and all that, to say that I think we should consider how long it's been since we've had an update on currency. And I think it's, I know I might have to get ready to run, but I think it's a consequence of the fact that it has for practically a century and more in some places been monopolized by central banks, and they don't have the incentive to innovate. This is controversial, but I think if it had been left to private sector banks, they would have moved out of paper a long time ago. You know, it's like the post office and stamps. So now we've had non-bank firms that have intervened and created this new sort of currency and inspired central banks to get on board. But I think that all of this speaks to the importance of having an industry where there's ongoing competition, so we can update continuously to whatever the best technologies for payment happen to be.
We're actually out of time, but 30 seconds.
Now, I'm confused. Do you want us to evolve the future of money or not?
Yeah. Yes. Yeah. But I want the private sector to be playing the leading role.
Okay.
John.
First of all, technology and money has been changing remorselessly for the last 150 years, and we've had huge political debates about it every about 100 years and the like. So I don't sort of believe. Well, if you think about money as used in payments, and I just think about what's happened in my lifetime, certainly it's a very different world to the one I grew up in. On the Ukraine question, I think a number of jurisdictions have issued strong guidance to the exchanges, the on-ramps and the off-ramps, for Bitcoin and others, about the importance of sanctions and the fact that you're digital and crypto doesn't mean that sanctions don't apply. Of course, the underlying problem is the anonymity with which people are able to transact through certain cryptocurrencies. The evidence that one can amass is that this has not been a material route for getting through sanctions, in part because something that can lose 70% of its value in a week is probably not a very good way of moving assets around the system. But probably some has gone on, and this just to me underlines the need to bring these technologies into regulation so we can get the benefits of them and the benefits of competition, because I do believe in competition in money and payments, without some of the social harms that can come from the sort of thing we see. But
Thank you very much for your questions, and a massive thank you to the panel for their time. Thank you.
The mic's on, so it's a great pleasure to welcome Raghuram Rajan. Raghu is the Catherine Duzak Miller Distinguished Service Professor of Finance at Chicago Booth. Of course, between 2013 and 2016, he was governor of the Reserve Bank of India. And a decade prior to that, he was chief economist at the IMF. So, Raghu, it's an absolute pleasure to welcome you to our conference and sharing your insights with us. The way we're going to run this, I think, is I want to leave plenty of time for all the great questions we'll get from the audience. So we'll do about 30 minutes chats between the two of us, and then we'll have 30 minutes for questions. So kind of store up your difficult questions. I'm sure there are many at this juncture right now. Perhaps we could start, I think it's the inevitable place we need to start, with the rise in inflation, and I'd just be interested in your thoughts on this. So, what do you see happening to inflation rates in the US, UK, Euro area over the next year or so? And I'm particularly interested, looking slightly beyond that, are you more concerned about risks of prolonged continued overheating, or do you think we might find ourselves back in a world of, deflationary concerns being the main concern?
Obviously, it's a great and pressing question. I mean, clearly, some of it depends on things outside the central bank. Mr. Putin, for example, what he does on energy, whether he continues some of the inflationary pressures that we already see, certainly for headline. But I think the BIS had a very good characterization of thinking about where we are. We're coming from a low inflation regime where, any price movement doesn't necessarily stick. There are relative price adjustments. You don't see an overall movement in inflation to a high inflation regime where, price movements get sort of augmented by the whole, and you see it doesn't stabilize on its own, and central banks have to take a much more active role. It seems a little bit to me like moving from a developed country to an emerging market. You've got to do a lot more as a central bank in containing inflation, certainly relative to the last so many years. So in that situation, I think central banks have limited time to prevent the equilibrium sort of from moving to one which is used to higher inflation, and then you get the wage price inflation spiral because every element of inflation has to be corrected for through higher wages. I think central bankers recognize this. That's why so many of them have front-loaded movements. But of course, it's also a difficult time because there are so many aspects which are largely supply side. You want to worry about them because they feed into the overall inflationary environment and may get entrenched into expectations. But you also want to be careful because the economy is not doing that well. And so you don't want to create a really strong recession. So when you mention these three areas, I think they're in different sort of situations. US, I think the Fed has moved, perhaps a little later than we would say in hindsight was appropriate. But it has moved, and it has said that it's very firmly concerned about inflation. When you look at wages, 5% nominal increases, still not keeping pace with inflation. And in the US, we don't have the kind of institutionalized wage structures. AFL-CIO is much less powerful than it used to be. And so one would think that it's going to be harder for the wage price spiral to take off. And perhaps the Fed will keep us still in more closer to that first low inflation equilibrium rather than the second. So to your question, so long as we don't see further supply shocks, which give more momentum to inflation, I suspect it has a fairly good chance of succeeding over 2 years, bringing things back to somewhere nearer normal. I think in the euro area, we still see a chunk of the inflation right now being energy. and that's going to come off with base effects. It's now they have a more institutionalized wage setting process. We've already seen the German unions asking for higher wage increases. But if the ECB can do enough, perhaps they can still maintain reasonable sort of balance between growth and inflation. They bring inflation down, and they don't have a deep recession. The UK is the tough part, right? I think what we're seeing is certainly the lagged effects, in part lagged effects of Brexit, both on the labor market side, with a very tight labor market, partly, I would guess, for the same reasons as the US, very limited immigration over the last few years creates pressures, perhaps more in the UK than in the US, because the US, it has been immigration at the lower end, which has largely been cut off. But in the UK, it may be more general across the board. And of course, the growth effects of Brexit, which had to show up at some point and are starting to show up at probably the worst time. So with all that, I think the growth-inflation trade-off is harder. I can understand the Bank of England's dilemma. Again, with the benefit of hindsight, perhaps being more forceful up front about raising rates and trying to, limit inflationary expectations. Of course, again, the UK, as we've seen with the rail strikes, has a more institutionalized wage bargaining system than the US. And that may make it harder for the UK to bring inflation under control. Now, longer term for the US, if it does bring inflation under control, I do worry we're back in the pre-pandemic, using Larry Summers' terminology, secular stagnation, because I don't see where the new growth is going to come from that wasn't there at that time. Right? I mean, we had 6 trillion of stimulus, but the central bank is going to react to that, and we're going to come back to relatively modest growth. And the 6 trillion hasn't been used to create the structural reforms or to create the investment that would necessarily, maybe 500 billion for investment, but that's small change relative to what's been spent. And so, in terms of sustained growth, I think we're still need to worry about whether TFP is going to grow or not. And again, there we've seen some changes in work habits. Maybe that adds to TFP, but by and large, there's headwinds, deglobalization, the fact that immigration, there's probably going to be more resistance to it going forward. The labor force is going to grow older, and TFP maybe on the service side more of it, but again. It's going to be miraculous if it just pops up by a huge amount. So broadly, I don't see that we're going to have rollicking real growth. R-star is going to pop up a lot. And I think the best we can hope for is, moderation again. We will like the times before the pandemic. We'll grow to like the past. I think that's going to be, unfortunately, the future.
Interesting. Maybe we can sense a fiscal policy. So, one of the legacies of the pandemic and even the global financial crisis before that is, all of these events are happening against the backdrop of very high public debt levels. You've written about the impact of QE in shortening the effective maturity of public debt in the hands of the private sector. Are you concerned that, with this world of rising interest rates, this could create debt sustainability issues for some countries? Could we even have a fiscal crisis? How should we think about these issues?
Well, one of the nice things about high unanticipated inflation is it reduces your public debt level, right? So I think that's the silver lining of this. It's going to create some room. Of course, going forward, there's a question of how that new debt is going to be priced, and whether you have an inflation premium embedded in it, and therefore are you going to pay higher real rates, what it does to public debt sustainability going forward, and how quickly that repricing takes place, which is where the maturity of the debt comes in. And clearly, shorter maturity debt has 2 problems. One, it's harder to inflate away, and second, it has to be repriced much more quickly. And so some of the higher interest rates, including higher real interest compensation that investors demand, will start showing up earlier. But I think the fiscal front, I do worry, about, certainly in the US, what form spending took in the last few rounds of pandemic stimulus. I can understand why the first round was, we don't know what's happening, let's just spend it freely. The second and the third round, I think, has seriously limited fiscal space for the stuff that the US needs to do. And I said it then. I said, I agreed with Larry Summers' view that the spending was going to be inflationary, but I worried as much that the spending was reducing fiscal room for the things the US needed in order to create higher sustainable growth going forward, including investment in people, but also investment in the infrastructure, as well as in climate change. And my worry is, we used the period when all the economists were telling us, interest rates are really low, go out and spend. We spent it, but not necessarily in the best way possible for the future. And I don't know if, how we can bring this back. It seems, let me put it this way, it seems like in the same way as monetary policy has moved to an emerging market kind of situation, fiscal policy behaved like an emerging market. Spend freely because that's the only way you get consensus amongst the very diverging parties within the country. The political parties don't agree except on one thing, spend. And therefore, you need goodies for each side. You want benefits for the business people, we want benefits for the poor people. And so let's agree, we'll spend on both. We won't make choices. And as a result, we spend our way into a fiscal problem. We aren't there yet. The inflation will help us resolve it, but going forward, unless we get consensus, political consensus, unless we start trusting the experts again a little bit, I worry about the future.
And the euro area? Would you like to say anything about that? I'm sure we'll get questions in the Q&A on this.
On the fiscal side or on the fragmentation side?
I think I mean more on the fragmentation side, yeah.
I mean, clearly it's a huge issue. And, my friend Axel Weber was saying forcefully, I don't know whether he wants it repeated, but once again, it's up to the central banks to fix the problem, when in fact it should be on the side of the, the fiscal authorities. I do worry if we don't have, the appropriate reforms in Italy, as well as some kind of a political, a reasonable political outcome post-Draghi. Anticipating all that, whether the markets are going to test the ECB. Of course, we don't know what the anti-fragmentation tool will be, but as we can see the markets testing, Mr. Kuroda in Japan, I have no doubt that this view that central banks can spend a limitless amount of money, well, to some extent, but you need there to be a sense that the problem is fixable. If there is a sense that this is going to break down, markets are going to be very quick to test. And so what is the level of support the ECB is going to give? I like the fact they've left it a little up in the air. What does fragmentation truly mean? Well, if it goes beyond what is reasonable, if yields pop up beyond what is reasonable, we will bring it back. Now, I think they'll have to be very clever about defining that reasonable, because anytime they draw a line in the sand, it will be tested.
That's interesting. That's a segue to financial stability questions more broadly. There's a few things I'd be really interested in your views on. So one is, I guess on the risks side, do you see this kind of prospect of maybe quite steep increases in interest rates, possibly leading to financial stability concerns, either in advanced economies or emerging markets? Are there particular pockets of vulnerability that you're concerned about?
Well, let's start with the interventions in COVID, right? You can see this was a big shock, and you can see the bankruptcy numbers. They look really healthy, right? Far fewer firms went bankrupt in the US, and I think that's true also of Europe. So what happened? Either there wasn't a problem, which doesn't seem to be the case, or there are a number of firms which have loaded up on debt, which they probably will not be able to service as times get more difficult. So I would combine it with the fact that, yes, times are going to get more difficult with higher interest rates, with the economies slowing because of supply shocks, but also because of the higher interest rates. In those difficult times, we're going to have to confront higher levels of debt. And so almost surely there's going to be more distress. The question is that going to be manageable? Is that going to be more problematic? Of course, that depends on how you've lent to those entities. If it's short-term floating rate debt, it's going to be more problematic. Now, clearly a lot of corporations that could borrow longer term did so. They understood this was money that was cheap right now, let's make the best use of it. But there are some firms that couldn't get any other money than short-term, maybe even collateralized debt. So they've exhausted their collateral, they've got short-term debt, they're the ones that are going to face up to it soon. How big that is, it's hard to tell because there's been a fair amount of lending in there. I think the other question is, does this spread? And that depends on the identity of the lender. I think the consensus is that the banks haven't gotten into it in a big way, that much of the froth has come from the non-banks. And there, the real question is, who are these non-banks? We've seen some of them in the crypto area go, belly up. Not all of them have lent to the real sector, but some of them have. But I think the bigger question is some of this private lending that has taken place. Have these been done by leveraged institutions? And how much due diligence have they applied? How well diversified are they? How much capital they have? All the same questions we asked of the banks. Shadow banking system is the big question now.
Before we go there, I want to ask you about banks, actually. Take you back to I think this is still a debate that's, you hear a lot about, have we actually fixed the problem of bank resilience, from the last crisis? And I think there's two views that seem so distinct that it's hard to kind of make progress in the debate from my perspective. So one is, this is not an issue anymore. We do really strict bank stress tests. They've got much more capital than they had pre-global financial crisis. Look elsewhere. The other view, a lot of economists take the view that we should have much higher bank equity requirements. Where do you stand on that kind of quite fundamental debate?
I guess it goes back to the question of what you think a bank is, right? What is a bank? And I would say the defining characteristic of a bank comes from the liability side, essentially short-term demandable claims. And, if you have short-term demandable claims, the argument always is, why don't you invest in short-term liquid assets, and then there are no problems for the system. But then you're not really creating liquidity. And liquidity creation means some level of liquidity risk, longer-term investments. Then the question is, why do you finance with short-term demandable claims? And this is where people like Martin Hellwig, Anant Admati said, why not just increase the capital ratio? Now, some of us, Doug Diamond and I, for example, say, look, the problem is financing long-term basically creates a very high cost of capital base for the banks. Don't keep reciting Modigliani Miller again and again. It doesn't apply in this case. There are different problems that violate the assumptions of Modigliani Miller in this situation. And so short-term demandable claims may be a better way of financing for the banks. And that allows them to do the maturity transformation, but also exposes them to risk. So yes, there's a trade-off. You cannot have infinite capital, but you cannot have zero capital. There's an optimal level of capital requirement. And we're struggling to find what that is. If you set it too high, it makes them unprofitable. You set it too low, it makes them overly risky. How do we find the balance? And Basel 2, 3, 4 are all struggling to find that balance. Are we there yet? We'll find out over time. I do think that drawing banks away from some of the valuable activities they provide will be problematic. We shouldn't over-regulate what they do on the asset side. By all means, regulate capital, make sure they have sufficient capital, but allow them also to perform contingent risk bearing, which is a very important function. In a sense, the ability to intervene at the right times. If you take that out, now some of the arguments are they've been doing that right during in recent times. I think that should be encouraged. That banks have to be part of the answer, and we can't just pull them back from risk taking.
Liquidity provision.
Liquidity provision of various kinds. You just have to make sure they understand that they are providing that liquidity, they're on the hook for it, and they don't over-provide it and run down the price of providing that and basically create problems for themselves, which also happens.
Coming back to non-banks then, so I guess what's quite striking is we keep having the same vulnerabilities showing up again and again in the non-bank space, it seems to me. Money market funds in the US, issues around liquidity transformation in investment funds were highlighted 8-9 years ago, yet very little is actually done on the policy front on this. I'd just be interested in your views on, where's the starting point and how optimistic are you we can actually address some of these vulnerabilities that keep showing up?
Well, any kind of liquidity transformation can be profitable, but also involves a fair amount of risk, right? Risk return, you're getting paid for it. And ideally what you'd like to do is, take the risk, get paid for it, and hope that the authorities come out to bail you out at the right time. I mean, that's certainly what the money market funds are doing. Yeah. They have a direct line. In times of trouble, the authorities come to help them, and they've gotten used to that. But the other side of it is the political economy. John, in the previous panel, was talking about the political economy of regulation. Part of the problem is when the entity you're regulating is part of a big group, the amount of lobbying power that group can exercise, right? This is particularly problematic with innovation. When the innovation is small, that's the best time to regulate, but you don't know anything about what to regulate and how to regulate, right? I have in mind, of course, the crypto markets. We didn't know early on what to regulate and how to regulate. By the time you find out, it's really big, and they have a ton of lobbyists they can buy to prevent regulation from happening. So there is a real question of how do you achieve optimal regulation in this kind of environment? By the time you know what to do, it's too late. So do you regulate extensively upfront, but then you never find out what to do because it doesn't grow? So how do you match this? I think from a regulatory perspective. So, I thought after we woke up to the fact that people were doing all sorts of stuff with subprime, and it wasn't what we knew they were doing, we'd move faster to regulate cryptos. But of course, what do we do? Yeah. And now it's a 3 trillion down to 1 trillion. And now we're saying, well, we should regulate. Maybe the experience of 3 down to 1 is enough to overcome some of the lobby groups which said, don't even touch us. We're so profitable that you're the old school. You don't understand. We're not taking any risk.
Interesting. All right, I want to finish with 2 quite general questions. So one is interested in your views on the enduring lessons for public economic policy from the pandemic. I guess I'm thinking particularly whether there are lessons on the fiscal side, but you can take that wherever you'd like to take it.
Well, I'm not sure I know what the lessons are. I do worry that a lot of the money we spent went in ways that in hindsight we will regret. And we will see more and more studies. We've already seen some studies saying money that went in through the front door in the Paycheck Protection Program went out through the back door to pay the banks. That's why bank loan losses are much lower than we thought they would be. Was that a good use of money? Did you want to recapitalize the banks by funding the small and medium enterprises? I don't know. And I think that one aspect that has been highlighted is we need to prepare for more emergencies and how to funnel money directly into households and also know who we're funneling to. Much better targeting, because we simply cannot afford the blanket everybody gets. I mean, why did people on Social Security, and I'm in that, nearing that age where I'm going to receive Social Security, they didn't lose a job. Why did they have to get the same fiscal transfer as the head of a family of 4 who just lost a job? It seems like we can do better targeting. Well, initially we couldn't because we didn't know, but we didn't spend any time, trying to figure out more. At least now we should try and figure out who's who and what's what. And of course, there is going to be privacy concerns. Should the government know who's getting what income? But if you want to make transfers, and we have the capacity to make transfers in a much more targeted way, can we figure out, so that next time, and emergencies are going to increase in number, obviously, if we don't tackle climate change. And they are going to be the kind of emergencies where you want direct transfers to people, or you've just had a catastrophe and you have a house in Miami. Let's make some transfers.
Takes us back to CBDC, perhaps. Last question from me is, we've got a number of young researchers in the audience. So what would your advice be to people on the research side? Where would you like to see people focusing especially these days?
I would say the immediate answer is don't listen to anything I say. Whenever you hear older people talking about research they wish they wish you would do, either it is stuff they don't think worth working on themselves, or it is stuff related to their research that they hope that you will expand and make their research much more interesting, right? So take everything I say with enormous amounts of salt. I think there's so many interesting things that have come up in the last few years that are certainly worth working on. And we just talked about one big issue. What is a fiscal monetary interaction, right? We just saw $6 trillion being spent by the US Congress in generating a recovery. And we're going to see some of that recovery being killed by the central bank raising interest rates, maybe in proportion to the amount that was spent. Is this the best form of monetary fiscal coordination we can think of, or are there better? Now, obviously oversimplifying, there are lots of shocks which have happened which neither the monetary authority nor the fiscal authority, nobody anticipated the war. So yes, but are there better ways of coordination? What should they be? How do we think about that? That's certainly one of the important issues. I see an increasing number of papers on digital currencies, on cryptos. All the issues we heard talk about in the previous panel. I think going to be very interesting. I mean, one of the immediate areas, if I was to throw out something, is certainly, when we look at some of these new digital organizations or institutions, how successful have they been? Have they really captured information in a much better way? For example, in lending, we will go through a cycle. We didn't go through much of a cycle during the pandemic because of the enormous amounts of money, but maybe we go through more of a cycle in combating inflation. How many of them survived? What did they do that was different? Or is it that they just made loans in good times, and it looked like it was a whole new technology, but it didn't survive the bad times? I don't know the answer to that. I do worry that we have perhaps overestimated the value of new information that they've brought to bear, but I certainly may be wrong, and maybe there are a lot of these companies that come through the downturn, smelling like roses. They've really figured out the individual and what makes them tick, and so there's tremendous amounts of work that can be done. Last point. I think the issue of liquidity, that's my favorite. And so I'm telling you that I have a vested interest, but I think we understand too little what liquidity really is and what happens when it vanishes. We certainly have a belief when central banks reduce their balance sheets, you're trading one high-quality asset, long-term government bonds, for another high-quality asset, central bank reserves. Other than some maturity transformation, it shouldn't make much of a difference. I suspect it could make more of a difference, and we have to see what happens as central banks shrink their balance sheet.
Yeah, live experiments on that question.
Absolutely.
All right, I'm sure we're going to have lots of questions. So why don't we take like 2 or 3, and then we can have another round. So who wants to go first? All right, I see Gulchin. I also see Devika. Don't know your name, but you can go third.
Thank you. Gülçin Özkan, King's Business School. I would like to ask about emerging markets you alluded to earlier. If we go back to the aftermath of global financial crisis, which was obviously a high point for emerging economies with the flooring of interest rates in advanced economies, capital flowing back. And more importantly, these economies had already learned the lessons from their own crisis experience, put their house in order, including the macroprudential policy. We are in a very different point now, particularly with the direction of interest rates in advanced economies. What do you think the prospects for emerging markets are going forward?
It's a great question. I think obviously it differs, right? Emerging markets is a label we use, but you have Turkey on one side, and you have South Korea on the other with the same label, and they're in different situations. I think the question, in some sense, is have they learned how to put their own house in order, more or less? And many of them have moved towards monetary regimes which are more traditional inflation targeting regimes. Many of them have moved in advance of the industrial countries, anticipating, especially in Latin America, take the Brazilian central bank or the Mexican central bank. And so I think they have some difference from the past. But you can see that, certainly India's experience has been portfolio outflows over the last 8 to 10 months. 30 billion, 35 billion have already flown out. Could more flow out? Possibly. And so they have to adjust for that. Many of them have built up reserves during calm times, precisely for this eventuality. The question is, are they willing to let the exchange rate depreciate appropriately and use reserves in modest amounts, or are they going to get stuck in sort of corners in this. On the credit side, I think many of them have banking systems that have been reasonably well supervised. They don't have this overhang of bad loans waiting to be hit by the shocks emanating from the industrial countries. So I would hope that, and many of them don't have the high debt levels that the industrial countries have. So in relative terms, they look better than the past. But I think you correctly point out, this is a different order of magnitude than the global financial crisis. There they were reducing interest rates. They were pushing the flow of capital to the emerging markets. Now we see interest rates going up, the flow of capital going to go the other way. We will see if these systems can stand the stress. Almost surely, not all of them will be able to stand the stress. We've already seen Sri Lanka. I don't know what's going to happen in Turkey, but those are the kinds of questions.
Let's go to Davika next. I saw her hand second.
Hi, my name is Devika. I'm the climate risk analyst at Tata Consultancy Services. You've mentioned climate change at least 2 or 3 times in the last half an hour. So you obviously also strongly affirm to the fact that it's very important. My question is, what are your thoughts on climate risk and its impact to the economy? And secondly, how can central banks help incorporate climate risk into their decision-making agenda?
Okay. This is where I'm going to be controversial a little, hopefully not too much. I certainly think climate risk is very important. But I think putting the burden of fixing it on either corporations or central banks is going to get us suboptimal answers, because those aren't the right entities to fix it. You can give instructions to central banks, but it has to be something determined at the political level. Central banks are unelected. They're not the entities to make choices on this. You can see that even in the US, because there's so much fracture between the Republicans and the Democrats on how important climate change is, for the central bank or officials who are appointed to central bank to talk about which direction they're going to go invites trouble. And I would say limit central banks to the activities they can barely do, which is control inflation and financial stability. And much of the rest has to be, on instructions from the political authorities. Thou shalt not invest in bonds other than these. These are the green bonds you can invest in. That is something the authorities should tell the central banks rather than them, the political authorities, rather than the central bank deciding. Similarly for companies, to leave the entire issue of how much you want to emit to companies, it seems that the political authority is ceding responsibility. Now, the reality is the political authority cannot come together. And so we're sort of saying somebody has to do something. But I think again and again, we see when somebody who's not really the right entity to decide does something, it creates more problems down the line. So I would put the responsibility back to the authorities. Why don't you tell us what emissions we should be doing, and we'll try and stay within that, or you do even better. But for you to say it's the corporations that have to do it and let them figure out, it creates all sorts of problems. For example, if the corporations decide, which corporation is going to decide? Can they form a cartel which decides that, oh, we're going to squeeze all the small guys out by fixing this level of emission, which is impossible for them to reach? Can we squeeze the poor country producers out by saying we will not allow their products in unless they meet this standard? There are lots of inequities, lots of problems that emerge when you leave it to them. I would rather, we focus much more on the global agreement as well as on within country. Here are the things we need to do with the urgency that this needs. And that's the last point I'll say. Having these peripheral entities do it gives you a sense that there's movement, that we are going there. But we're not. We're giving the cosmetics of going there. We really need much stronger action. I mean, we saw the IPCC say we don't have much time before we're inevitably beyond 1.5 degrees additional centigrade. So given that, I do think we need a global agreement sooner rather than later, and that has to be decentralized down to the governments and further down to every entity in the country. But it cannot, I don't think voluntary works in this situation.
I think I saw Jahangir next. So Swarali is just below you.
Thanks. Bit of a horrible question, but I think you asked for it, in that you talked about the challenges that the UK face. Would love to hear, because I hear there's a job opening potentially coming up in the UK. What would you do, the 3 economic policies that you'd have to get UK back on track?
So I'm going to start by saying I'm not competent to answer that question. I don't know. I don't know enough to really answer. If I were to do a study of the possible issues that confront the UK, I mean, look, I can mention what I read, and certainly the issue of, why UK productivity is low seems part of the question that we need to ask and need to fix, and maybe there are easier fixes rather than harder fixes. I presume there's no going back on Brexit. That's a done deal, and it's not going to be reversed. But I would find, all the promises about keeping the UK as part of the global economy and ensuring trade is actually enhanced rather than diminished. I would look at trade and services, and since the UK is strong in that, I would look for ways of expanding global trade and services, but be prepared to do a bunch of, I give you this and you give me that. It seems as if, thinking anew, what are the unexplored areas where we can get growth if, in fact, we are in this new equilibrium is very important. I'm not saying anything new here. I'm just trying to say these are the places I would explore. And certainly, I may not want blanket, that was Brexit. I don't want blanket immigration from Europe. But I would find ways of keeping the tap open for immigrant pools to come in, both to ensure that the labor market is well supplied, but also to benefit from talent from outside. So, those are some of the things that I would do. Some of them are being done. Some of them, I think, could be done. I certainly think globally we need a dialogue on services, especially now that services are so much more tradable than they used to be. We've learned how to trade services during the pandemic. I think that is one of the silver linings. And let's try and expand. 70% of GDP in industrial countries is services. If we can do them more effectively, more efficiently, including by wholesale trade. And trade in services, as you know, is disrupted by things like licensing requirements and this and that. Can we find ways to, in a sense, make that trade more free by figuring out how to diminish the barriers created by this? I think these are things where the UK certainly has an interest in playing a global role.
Marcus Miller.
I have a question about inflation and real wage resistance. In the oil shock of 73-74, Dennis Sargon of LSE came up with an error correction model where the bargaining equilibrium essentially went for a certain real wage. And in reaction to some external shock, which reduced that, the model predicted there'd be a rise in the natural rate of unemployment or a fall in the natural level of employment until this was accommodated by the bargaining equilibrium. So my question would be, do you accept that kind of analysis? And if so, what sort of policies are going to bring people to adjust in the way that may be necessary? And would, for example, the fact that services are much less unionized than manufacturing offer some hope in that direction? Or is it up to the central bank to teach the economy some tough lessons?
I mean, it's a great question. Do I accept the broad principles? Yes. It seems as if that's a reasonable economic model. There are issues of fairness. There are issues of feasibility. I think fairness. Nobody would question that. Trying to reduce real wages is certainly something that is going to impinge on certain parts of the population, perhaps more so in certain parts than others. And there's a redistribution question which arises if you think of a country as an insurance system which is meant to deal with some of this. So let's put that aside, and whether you can get redistribution which is not efficiency impeding, but which makes up for some of these differentials. I think the feasibility issue is as important. That is, and this is Michael earlier. This is his comment, which I thought was very insightful. That reducing real wages after a time of real wage increases, which is what he argues happened in the 70s, is easier than reducing real wages at a time of fairly stagnant real wages for a long time. And so in the current environment, how do you effect that real wage reduction when there's very little credibility about the redistribution mechanisms which make it up to you in other ways? And it comes on top of having a decade of fairly limited real wage growth, maybe decades of real wage growth. And that creates a real political economy problem, right? Because people are now don't think the system sort of works, and there's no surplus built in the past that you can afford to give up. You're at your corner. And you're eating into, you've been making adjustments for the last decade and you're barely surviving. And now you're being asked to eat into even that. It is a recipe for industrial strife. And so I would say it's really important to work on the other aspect. How can we absorb the shock as a country and make the other adjustments that ensure that the people we're asking to bear the brunt of the shock are willing to do it?
A few more. I can see Jumana to start with, and then.
Thanks a lot for your comments. So my question was more about inflating away debt. I wondered if you could say a bit more on the advantages and disadvantages. And the reason I'm asking the question, the motivation really is, 30 to 40 years ago, it was actually quite a fashionable thing to do, inflate away public debt, inflate away private debt, in particular mortgage debt, something my parents used to talk about. But then it became really unfashionable. In the inflation targeting era, it was like you never asked that question because it was like, no, we're going to have low and stable inflation. So I wondered if you could say a little bit more about where we are now.
Yeah. It works, right? If people don't expect you to do it. So you have to continuously surprise the investor and say, look, you expected 5% inflation, here's 7. And therefore you've got, a free ride because they didn't demand appropriate interest rates. Of course, the problem with this is you can keep doing it, eventually they wise up, and then the question is, do they build in additional sort of for the potential surprises, and then it can get into a very bad situation where your interest rates, nominal interest rates, and your real interest rates are both higher than they would otherwise be. This question for the students here. We sort of think that the public sort of anticipates all this, and interest rates embed, likely inflation. But certainly, at least in India, I found that it was very hard for me to convince people that they were better off when inflation came down and interest rates came down, so they were earning a higher real interest rate. They preferred earning a negative real interest rate at higher levels of deposit interest than earning a positive real interest rate at low. I don't know if this is a more general thing, but I got a huge amount of flack when we brought down inflation in India from people who said, I was earning 9% earlier, now I'm earning 6%. This is terrible. And I had to sort of try and do the math to tell them, look, you actually can buy more. But put that aside. I mean, I think these surprises can work. If you've got a lot of long-term debt, which has been negotiated at a very low interest rate, anticipating low inflation. And I think that's what we're doing right now. Now, that said, I mean, to David's earlier comment, it's not as long-term debt as we thought it would be. Certainly, QE has shortened the maturity of debt because central banks have bought government debt, financing it with overnight debt. That shortens the maturity of the collective balance sheet, and they're paying for it right now. But I think the broader point is, yes, and some people would advise this. This is like the Jubilee, right? We used to, I think it was what, every 50 years you had a Jubilee where all the debts were written off. This was in Babylon. The inflation, the big inflation is like a kind of Jubilee. Debts are written down and we start again. But you know, you can do it only so often before it gets anticipated, and when it gets anticipated, it is costly because there's also real interest rate premium which comes in. Well, so that's a good point, because the question is, in all these situations, you're just shifting the losses, right? You're shifting the losses. Who are you shifting it to is the important question. If you are shifting it to those damn foreign investors, as a country, you're better off, right? Until they wise up. In many countries, you're shifting it to the pension funds and the insurance companies, which is building up a hole that somebody has to fill at some point, which turns out often to be the same taxpayer who's getting a benefit from the lower government debt that has to be serviced. So if you're doing the shuffling around, but at the same time increasing the cost of borrowing, it's not the greatest idea, which goes back to maybe inflation targeting is a good idea rather than a bad idea. Even though it gives a windfall to the current bondholders, longer term, moving to that new equilibrium may be a good thing.
All right, I think we've got time for one more, and I did see a hand. It was your hand, wasn't it? Fred, I don't know your name, so maybe you could introduce yourself.
Thank you so much. Myself, Ashish. And I want to ask Raghu sir one question that I think most of us, and even you, would agree that cryptocurrency in a longer term may not help the economy as such. But what is your thought on central bank itself issuing its own digital currency? And second, sir, a very India-specific question that right now in recent time we find that the RBI has been increasing its doing rate hikes. So what do you think? Is it the right time, or it's delayed, or we have done it much earlier? Because still we don't find economy is, reviving in a better, is not still in a better shape.
Yeah. Look, I don't comment on RBI policy just because people think I know more than I do, and I don't know that much. So let me not comment. I don't want to also make life for my successors more difficult. The first question was on cryptos and CBDCs. We had a whole panel on it, of course, and I'd say that the usual thing that the technology underlying cryptocurrencies is interesting, can be used. Maybe the underlying fear of public sector malfeasance, which drives some of the narratives. Oh, the central banks are going to inflate away all currencies, and therefore we need a crypto. I think that's certainly overblown. But I do think the technologies, do we need as much decentralized ledger, or can we do more centralized ledgers? Would that reduce the costs? What is the trusted counterparty? Where do we really need decentralization? Probably cross-border is one place where we want to do it without intermediaries. Those are kinds of things that are raised. I certainly think the technologies are important. I certainly think we still haven't seen killer apps emerge, but we understand the possibility of these killer apps when we heard from the previous panel, the areas where we might find some of them. I think we should allow some of this to flourish under moderately more controlled circumstances. And that means some regulation. I think the regulation is on its way. The last thing I would say is, one of the problems with the crypto market is the problem with any new technology. It sort of promises so much, and we still don't know which promise is going to work out. But in that promise, this could be the thing. You have a lot of people drawn into it, especially young people, especially people who are not particularly rich. And that's the challenge for the authorities also. I mean, in the US, for example, I think 25% of black households have invested in cryptos, more so than white households. And, typically poorer households. And they've been drawn by the allure of easy money, but they're also going to be hugely affected by the losses there. So how do we ensure innovation, sort of the risks are borne by the right people and aren't more generally spread in the population, especially amongst people who are not that able to bear those losses? Those are some of the questions this raises.
Let's draw it to a close there. Thank you so much, Raghu. That was fantastic.
Thank you.
Thank you.
Give it a go. Yeah. So, welcome all to our last paper session of the conference. So the session on markets. We'll start with Anne-Caroline Hooser from the Bank of England, who will present her paper, How Do Repo Markets Behave Under Stress? Evidence from the COVID-19 Crisis. And then Nina Boyarchenko from the Federal Reserve Bank will discuss the paper. And Caroline, please.
Francesca, thanks very much to the organizers for including us on the program. There are two obvious challenges with this presentation. Obviously, following up on Professor Rajan is a rather tough act, and we're painfully aware this is the last session of the conference, which obviously has been very packed and lovely. So the way I thought about this presentation was that I will present, it is an empirical paper, so I will try to mostly really distill the results we find on how non-banks behave during liquidity stress. And the idea is really to then show or give insights on behaviors that we still struggle to see sometimes because we don't really have the data, etc., and how that might inform modeling and then hopefully also some further kind of research and possibly system-wide stress testing in the future. So with this kind of broad introduction, I will dive into the content. So I think we're all aware that there were recent signs of vulnerabilities in the repo market. It is a key market for the short-term provision of liquidity, but there has been recent turmoil, for example, in the US in September 2019, and even more recently during the COVID-19 crisis in March 2020. This even led our ED for markets at the Bank of England to use particularly strong words. In one of his speeches about the COVID-19 crisis, he said that the pickup in overnight repo rates we witnessed was a particularly serious sign of dysfunction. So let me tell you, these are very unusually strong words for a central banker. And so this has prompted some research on our side. And the main question we're trying to answer is, how do financial sectors adjust repo prices and volumes during liquidity stress? And the kind of sub-questions we're after is the role on non-banks in possibly amplifying liquidity stress, so there's a question mark there, and also on dealer intermediation capacity. To date, there's still a limited understanding due to a lack of granular data on the whole repo market, especially in the sense that the repo market is often fragmented, so there's often a cleared segment and a bilateral segment, so very rarely do you actually have data on both segments at once. So what we do in particular in this project is that we study the overnight segment of the gilt repo market. For that we use a Bank of England transaction level data set on the entire market, so cleared and bilateral. And we use a network analysis of the structure and functioning of the market, tracking all the sectors that are active within it, so dealers, banks, central counterparties, but also non-banks. And to kind of give it a bit of a kind of analytical framework, we compare the normal market functioning to two recent liquidity stress episodes. The main focus is on the COVID-19 dash for cash. And as a comparison case, we use the US repo market turmoil in September 2019. And to give you a quick preview of what we find is that, that during stress, the network becomes more connected, so there are more trading relationships emerging between different counterparties. But most institutions rely on existing trade relationships to transact. So relative stability in terms of the relationships, but what we do find is that the actual links, so the changes in volumes and spreads during stress, are massive. So we find a significant increase in volumes traded in the cleared segment of the market. So dealers have a real preference to transact in the cleared segment, so via the central counterparty, rather than in the bilateral segment. There we think this is likely due to the netting benefits of going via the central counterparty rather than bilaterally. Secondly, we find that funding decreases towards non-banks, only increasing for hedge funds. And we also find that spreads are higher when dealers lend to non-banks. So I will obviously unpack all of those results as we go along. Just in terms of how does it compare to the literature, as I said so far, data sets have been fairly fragmented. So there is a literature on repo markets during stress, but they typically focus on cleared markets. So our contribution here is more to actually look at the whole market at once and to track behavior of many different sectors. Now I will give you a quick overview of what the actual market structure is in the gilt repo market. So banks and gilt dealers transact amongst each other bilaterally. And the main difference between banks and gilt dealers is that gilt dealers are banks that are gilt-edged market makers, which basically get the primary issuance of gilts, so UK government bonds. That's the main distinguishing feature, that they kind of have a big stock of UK government bonds typically due to their specific role. Then there's a central clearing counterparty. So they clear trades on behalf of gilt dealers and banks. So in this market, only they are clearing members. One additional feature of the CCP is actually in this market that they invest cash margin they collect in their overall business into reverse repo. So there are very limited things the CCP can actually do with the cash they collect. This is highly regulated. One of the things they are allowed to do is to invest it into reverse repo, but given they need it back quite quickly, they often do it at very short maturities, so typically in the overnight market. And finally, to kind of complete the network, so the actual non-banks, they transact with banks and gilt dealers, but not with the central counterparty. So they only have access to liquidity by going to banks and gilt dealers and cannot access the cleared segment of the market. So typically in kind of networky terms, we would say gilt dealers and banks are the core of the market, and then the non-banks we would consider the periphery. So now delving into the data and giving you some numbers. So the data we then, well, this initial structure was based on, but obviously it wasn't underlying any actual numbers yet, is the sterling repo market data by the Bank of England. And it is very comprehensive. So we collect the near universe of gilt repo transactions in this market. And the data sample we use is from March 2019 to October 2020. And just a few quick stats. So the structure is as follows. So transactions in the cleared segment are around a third, and 2/3 are bilateral. Tri-party is almost non-existent in the gilt repo market. There are around 150 institutions, and gilt dealers and CCPs are the largest sectors. And CCPs are net lenders, and gilt dealers net borrowers on average in the overnight segment. Banks and hedge funds are also net borrowers, and all other non-banks are net lenders on average. And now I'll dive into a bit of a visualization of all the bilateral relationships. So there's obviously a lot of data going into this and a lot of bilateral relationships, so do bear with me while I try to build up a bit the chart. So it's going to be a form of a heat map at some point. But basically the rows show the average daily volumes lent. So basically the money comes in from the left. And then the columns will show the volumes borrowed. So it kind of goes down. And so if you wanted to find out how much a bank lent, so the reverse repo with a fund, then you would basically go to this square, and the color shows you how high the volumes are on average in this transaction between these two sectors. And so if you put this all together, these are the average daily volumes in the overnight market in normal times. And what you can see fairly clearly is that in terms of colors, the consistently red part is the cleared segment of the market, so that's the most important one. Then this is the bilateral segment between core sectors. You can see that it's more faint, so volumes are lower. And then the part between the core and the periphery, so where non-banks fund themselves or lend, you can see that the lending part from non-banks is higher than the borrowing part. So this is the kind of structure in normal times. And we can see, again, the cleared segment is very important in this market. And now moving to the kind of case study of how does this change during the dash for cash, so during liquidity stress. So I think we're still all painfully familiar with the evolution of that. So there was a massive liquidity stress in March 2020. The volumes and prices went up sharply. We had a massive peak in mid-March in repo rates, and then as other central banks, the Bank of England took several policy actions, and that kind of calmed down the situation over time. And here we can see some just time series charts. The first one is the volumes transacted in the overnight market, and the second is the repo spread. And we can see that there's a clear peak on March 11, both in volumes and in spreads. But it's quite interesting just for the comparative case. This is the September 2019 peak in the US. So you can see there that the volumes obviously went up, but there's no corresponding peak in spreads. So there you can see that just in terms of severity, the COVID-19 liquidity stress, at least in the gilt repo market, was definitely a very bad one compared to previous episodes where people sought more volumes from this market. In terms of how the relationships involve, I'm showing here a time series chart of the density of the network. So this is basically the percentage of relationships that exist compared to all those that could exist in the network. So you see it's overall very low. So on average, it's like 0.5% the density. So it's a very sparse network. But what we do see in the evolution over time is that on March 11, clearly, a lot more institutions transacted amongst each other. And if we look at where those new or old trade relationships, we find that of the 287 trade relationships that happened on that day, only 9 were new ones. So a significant amount of existing relationships were kind of drawn on to satisfy demand. Now we're just moving to a quick statistical analysis to check a bit the significance of the changes from normal times to stress times. And it's a very simple linear regression model, and we will simply try to compute the significance of the changes we look at. So it's a very simple linear model with only categorical explanatory variables, and then we do a bootstrap analysis to determine the significance of the estimates. But as promised, I will keep this hopefully fairly, light and bright. So back to colors. So here we see the changes in sectoral overnight repo volumes during the March 2020 dash for cash. The colors shows whether there's an increase or a decrease in volumes relative to normal times. And the numbers, which you don't need to bother too much about, but I thought I'd say what they are. Basically, they show the significance of the parameter estimate underlying the box. So if it's really close to 100 or really close to 0, it means the changes are significantly different from normal times. And if we want to get the high-level results out of this, so you don't have to hurt your eyes too much. So the first key result is repo funding traded through the CCP have increased. So you see the little black rectangular boxes are the ones where we have clear increases in trading in the cleared market during COVID-19. Dash for cash, this is largely due to the netting benefits, and this only benefits directly clearing members, so dealers and banks. What we also see is that geared dealers mostly decrease lending to non-banks in the bilateral segment. Again, likely because this doesn't come with netting benefits. The only exception is that hedge funds increase their borrowing from banks and gilt dealers. And as we, or most of us probably know, hedge funds have been increasing their reliance on short-term funding markets in recent years, and this is a clear example of where this happened again during a liquidity stress. I will now quickly mention what happened to prices, and this is a similar picture. You just see the bilateral spreads, and during normal times they're typically quite close to zero, so the spread is the repo rate minus the Bank of England policy rate. But if you then look at the dash for cash, you see that obviously they tend to increase across most sectors, but they increase the most when the lender is a core sector, and especially when the core sector lends bilaterally. So here we see again that the bilateral segment is a bit at a disadvantage here in terms of pricing. So here's a quick comparison to the US repo market turmoil, and then I'll conclude. So there was a very high temporary liquidity demand due to various tax deadlines and a large settlement of US Treasury securities. So there was also a big spike in the secured overnight funding rate in the US. And what we see is that there are quite a few common patterns. So we see that the cleared segment, clearly the volumes go up quite a lot. Lending to non-banks decreases, except for hedge funds, who still manage to secure borrowing, but still at slightly higher rates, but not as deeply read as during the COVID-19 crisis. So obviously this was a US-based stress as well, but it's just interesting to see that in terms of volumes, there's clearly an appetite for the cleared market when demand picks up. So I will just quickly conclude what we see as kind of key lessons for modeling risks in the repo market. So we see that the network structure changes in times of stress. So we saw that people, that it became denser. So people try to find more counterparties to transact with, but typically rely on existing ones that they reach out to again. Then we also see that volumes and spreads change quite a lot. There's a preference for cleared interactions, an increased usage of the market by hedge funds, which is also something we're actually looking into in a follow-up project where we try to understand whether there is actually amplifying behavior by leveraged investors, so that we will look at the repo market in conjunction with our data on the gilt, so the bond market, and try to see whether different trading strategies of hedge funds actually do amplify the liquidity stress. So I think my main conclusion here is the importance of the system-wide perspective, again, because behavior is heterogeneous, and I think the more we start to investigate non-banks and possible regulation of non-banks, the more we also need to be mindful of assessing materiality of their behavior. So how much does it harm the market? Does it harm the market? And how to best tackle it if there's in fact a case. So I'll stop here. Thank you very much, and looking forward to Nina's discussion.
Thank you very much, Anne Caroline. Oh, sorry. Hold on. This doesn't. Wait, there you are. It's there on the bottom. You can
But
see
I think,
it.
no,
Yeah.
I think that's what's open.
Yeah.
I have it.
It is. Strange. have. Clearly, this was not expected. We thought we had checked all the slides, and they were there before, so something must have happened. Let's try here.
There we go.
Better.
Sounds more promising.
All right. The sound is promising.
Great. So thank you to the conference organizers for inviting me to discuss this paper. I learned a lot in reading it. I should preface my comments by saying that I worked a little bit with the US repo data, but I am by no means an expert in the UK repo data. As always, the views are my own and not the views of the bank or of the Federal Reserve System. So I'm not going to spend much time summarizing the paper. And Carleen did a great job explaining what they actually do. But essentially, the main theme is to study how the network structure in repo markets changes during periods of stress. And in particular, the paper focuses on how transaction volumes between pairs of counterparties, interest rates for particular contracts, and haircuts change. In the version that I saw, they actually had 3 stress events, but that's not going to be material to my results, to my discussion rather. And in particular, as we just heard, they focus on the COVID-19 pandemic as being the biggest shock in their sample, as well as on the September 2019 disruption in the US repo market and changes associated with the Brexit vote. And so what I want to focus on in my discussion today, given that the paper is mainly descriptive, is to try to think about what are the bigger picture implications we may learn from this. If we want to go in the direction of the implications that I think can be teased out using this data, what else do we need to see in terms of the analysis? And finally, I want to come back a little bit to the analysis that's actually done in the paper. So just to make sure that we're all on the same page in terms of what it means for a contract to be centrally cleared. So on the left-hand side, I have a very simple network without a central clearing. And on the right-hand side, I have essentially the same network, but with a CCP inserted. And so from the perspective of the original lender of cash, so let's call it a money market fund, and from the perspective of the end borrower of cash, let's call it a hedge fund, their exposures look very similar in the 2 networks, and the crucial difference is that the intermediary, so B for bank or dealer, in the central cleared network actually has a 0 net exposure, whereas in the non-cleared, they have 2 bilateral exposures, one to the lender of cash and one to the borrower of cash. And so when we think about CCPs, we usually think of the benefit as decreasing costs of offsetting intermediation transactions. If we think about the way that most CCPs are actually organized, even though neither A nor C in this example are actually transacting directly with the CCP, they can still face reduced counterparty risk because a lot of CCPs will actually reassign contracts of defaulting members to other members. So thereby, if B were to default in this network, the CCP would essentially find new counterparties for both legs of the trade. Now, I think in a lot of cases, we tend to focus on the benefits of having a CCP, and we don't talk enough about the potential costs of a central counterparty. So one obvious one is, of course, that you are concentrating these risks, counterparty risks at the CCPs. So CCPs need to have adequate oversight and adequate capital provision. The other part of it is, given that most CCPs do have membership requirements, so Anne-Caroline talked about how in this particular case only banks and guild dealers actually have access to the CCP directly. The existence of a centrally cleared segment may actually reinforce intermediaries' market power because, again, if A and C want to have even an indirect access to the CCP, they have to go through a very limited set of market participants. So coming back to the actual paper, so one of the big findings in the paper is that cleared volume increases during periods of stress. Now, we can think about this, again, in two ways. So one is, this is the CCP doing its job, so it's acting as a shock absorber. It's helping intermediaries actually continue to intermediate in this market. Now, on the opposite side, again, kind of going back to what are the potential downsides to having CCPs is, of course, when there are increased volumes actually transacting through the CCP, you can imagine that that may be creating stress at the CCP. And I think maybe one of the things that Anne-Caroline was talking about was thinking about doing stress testing for the entire system and not just for the banks. Now, the other part that Anne-Caroline didn't have time to go into too much during her presentation is that when there is stress in the market, CCPs raise margin. Again, this is exactly what we would want them to do because they are supposed to be collecting insurance against the contracts that they clear. But because they then turn around and invest that margin through, in this particular case, literally the same network, they're potentially contributing to balance sheet pressure at regulated institutions because that investment margin, again, gets invested through the repo market. And so I think one of the questions that this paper should think about is when we observe these increases in the flows through the CCP, is that increase exactly in the magnitude that we would expect a priori? Even if it is, what do we learn about the overall benefits of having a CCP in this particular market, and whether there are broader implications that we can draw for cleared markets? Okay, so if we want to go in this direction of trying to understand whether during these episodes the CCP is doing exactly what we would expect it to do, there are a few other things that I think we need to know. So in the paper, they show that, again, there are increased spreads for all segments of the market, but in particular, if we think about the difference between the spreads that are being charged in this core segment versus the spreads that the core segment charges to the periphery of the network, that is going up. At the same time, volumes are, the core periphery volumes are going down. And to me, based on the summary stats that they had in the paper, the participation was actually going down overall, but that's a discussion for us to have offline. So I think one of the main questions is going to be whether this is supply or demand driven. So if we think about a set of institutions that, for example, use the repo market to fund the cash gilt leg of a cash futures basis, if they're in a situation like 2020 when they have to close out that basis trade, that automatically forces them to reduce their gilt positioning, hence they have a reduced need for repo financing, and hence you may observe lower core periphery volumes just because you have segments of the periphery part of the market that no longer actually need the repo financing. Now, usually I think when we look at these types of flows, we tend to, again, automatically default to it being supply driven. So regulated institutions are subject to a lot more regulation following the financial crisis, and hence whenever they start having to absorb more volumes, they tend to pull back from the market. But I do think that from the perspective of evaluating whether the current structure of the market is doing what it's supposed to be doing, we need to get a better idea on whether the overall patterns we're seeing are driven more by supply pressures or demand pressures. So the final thing that I really wanted the paper to do, and I didn't see them doing, is I think when they look at how volumes change during periods of stress, they aggregate up to the sector level. I'm not sure whether I misread it, whether there is a technological issue given how many unique nodes in the network there are. But essentially, I think we can learn a lot if we actually expand this basic specification to have the full network spatial autoregression set up. So you can still have dummies for institutional types, like the paper is really interested in. But then we can also control for things like individual characteristics of institutions. We can control for things like spatial autoregression terms, so meaning if a bank is actually able to turn around and clear trades in the central, through the CCP, are they more likely to be willing to actually participate in the bilateral market, et cetera, et cetera. And by including things like institutional characteristics, I think we can actually start going after the questions of, is it supply or demand driven? How much of the flows are actually accounted by network effects? And just to conclude, again, I found the paper super interesting. There's lots of rich, very interesting data. And I just want to encourage the authors to think more bigger picture in terms of what are the lessons that we can draw from it. One suggestion that I had, and again, I'm not an expert in this market, but I was actually wondering whether there are other smaller exogenous events, so such as yield auctions, that you can use as natural experiments in terms of how much flow has to be absorbed by the core of the network, that you can use as a benchmark for the results that you have. And I'll leave it there.
Thank you, Nina. And Carolina, if you want to take a couple of minutes to respond to the comments, and then we'll take questions from the floor.
Absolutely. I don't know, is this one as well? Okay, yeah, fabulous. Thanks so much, Nina. All these comments are very well taken. This is obviously kind of the start of a broader research agenda leveraging on this data set. And I fully agree that issues like supply and demand are key, and this is something we will look into as well. So we are planning to do this in a much more structural way, and to also try to disentangle supply and demand, because here obviously this is based on the data, so we only see what transactions actually happen. We don't know if some sectors might have wanted a lot more, or whether this was exactly the amount they required and were happy in the end. We just see the actual empirical changes. So these are things we're clearly interested in to then also go into more policy questions as well. In terms of the institution level analysis, I fully agree with that as well. So I think our idea initially was that there was a lot of darkness surrounding us about the actual behavior of the sectors as such, and so we wanted first to just have some results at the sectoral level, because that didn't require any additional data to be fed in on individual institutions, etc. So this was kind of the first step we took to get an overall idea, and then also to see what questions might arise from that to continue research on. But we do plan to go at the institutional level as well, given that's clearly also very important. And in the second project we have started on kind of hedge fund behavior in this market, we will actually use gilt auctions as a natural experiment to kind of see how kind of this exogenous kind of input of additional UK government bonds might change behavior. So this is very well taken and very good idea. So I'll stop there and happy to take other questions, obviously.
Thank you. I mean, we're a bit behind time, but I do think we have time for one question if there is. David.
Thanks. Really interesting data and presentation. I guess my question is also along the lines of the future agenda for this work. You mentioned the idea of stress testing the whole system, or system stress testing, I think you called it. Maybe you want to say a few words about, how this data set can be used in that type of broader endeavor.
Thanks. So obviously, ideally, we'd like to have a system-wide stress testing model that had several markets, lots of sectors, lots of granularity. So obviously, we at the bank, we are quite lucky. We have lots of granular data sets on many different markets. The question is, which ones to prioritize first, how to analyze them, and how to put it together. So I think from this one, initially, we only look at the repo market and its sectoral behavior during stress, mainly to inform the whole current agenda on what we might do to regulate NBFIs, also non-bank financial intermediation or not. But then I do think from this, then obviously the question is, how would you plug it into a standard kind of more classic bank stress testing model? Do you keep a lot of granularity? Do you lose a lot? So all those things are things we will need to look into first, and then possibly it might be that some sectors actually have, most institutions, possibly hedge funds, might have similar behavior. Then maybe you can use just the sectoral level, right? That would simplify system-wide stress testing model. If they all behave rather differently because they have different trading strategies, which they actually do often in practice, then you need to really think about granularity, etc. So we are very much at the beginning of this agenda, as you also know, given actually David did one of the first system-wide stress test models at the bank. But there's definitely a lot of work on several fronts on trying to make this more comprehensive, and hopefully will be successful. I'm not going to say a timeline, but we're working on it. I'll stop there.
Thank you, Anne Caroline and Nina. Thank you very much. So can I call on stage Aitek Malkosov and Dimitri Vayanos, who will discuss the paper. The slides should be there. Let's see if they actually are.
They were right there.
Perfect. There we are. So Aitek, the floor is yours. Please.
Well, thank you very much for the organizers and all the participants for having us. It's a joint work with Sam and Guri, who actually is in the audience, and you can also ask questions to him later. So this is work on swap spreads. And so why did we decide to look into it? Let me just remind you that a swap spread is a difference between a fixed swap rate and a treasury yield of same maturity. And what we observed since 2009, so basically in the aftermath of the global financial crisis, we saw that this spread was negative. In other words, we had swap rates that were lower than treasury yields, in particular for long maturities. You can see it on the chart. Right after kind of the crisis, 2009, the solid black line goes deep into negative territory. This is the 30-year swap spread. So you see swap rates lower and significantly lower than the treasury rate of the same maturity. And you see something similar if you look at the red line, which is the 10-year spread. And if you look not at the more standard previously LIBOR swaps, but either SOFR or OIS swaps that became available later in our sample, they are even more in the negative territory. We're going to show in a couple of slides that it's a violation of the law of one price, and for some of us that's already exciting enough to look into it, right? So like just from a theory point of view, how does this arise, why, and so on and so forth. But there are kind of more pressing or policy relevant reasons to think about this. Well, for one thing, it's a very kind of large, liquid, active market. Why are these institutions, intermediaries, not stepping in, who are they to correct this apparent violation of the law of one price? It is also important to the topic that has been discussed during this conference, namely the costs of government debt. In fact, last year, the so-called Treasury Borrowing Advisory Committee, so it's like a committee set up by the US Treasury, was specifically tasked to look into this question, is why some investors are willing to accept in the swap market yields that are 40, 50, and if you think about OIS swaps, 100 basis points lower as remuneration than what the Treasury has to pay them. It's kind of quite a significant thing and important for understanding the cost of US government debt. Who are these investors who are willing to accept much lower yields? So this is our motivation for this paper. What do we do? In this paper, we're going to first sort of disentangle two forces that drive these negative swap spreads. On the one hand, we're going to have end-user demand to receive fixed rate, and then intermediary supply. So using kind of our theory, our model, our empirical expertise, hopefully sufficient to do that, we disentangle these two forces, and this allows us to tell things like, in a given point in time, was it that intermediaries were actively withdrawing from these trades, or was it that demand for certain type of securities, for instance, interest rate swap, was so large and overwhelming that this was driving the swap spread? So there is this kind of decomposition that we find interesting and topical. And we can also think about this kind of another decomposition, another duality in swap spreads is in terms of what mechanism gives rise to it. If you're familiar with the limits to arbitrage literature, it is kind of almost always the case that, arbitrage spread of any kind primarily reflects the shadow cost of some constraint, for example, a leverage constraint, capital constraint, and this is sort of the prevailing view. Well, we think that there is more to that, and we show empirically that is the case. There is one force that is kind of ignored and that we find important, is that once we do have these arbitrage violations appearing, and potentially affected by either demand or supply shocks, well, then these trades become risky for intermediaries, right? You can enter a swap spread trade that you think is an arbitrage, and yet because there is, let's say, a demand shock, the spreads move against you, you have losses. So it's a risky trade. You would like to be compensated for that risk. At least that's our hypothesis that we test in the data. And the premium, the risk premium for this arbitrage or demand-supply imbalance risk, hence the title of the paper, effectively amplifies the magnitude of the negative swap spread. So part of it reflects the effect of leverage constraints, as we are familiar often in models of this type. Part of it would be arbitrage risk. Okay, so how are we going to do about disentangle these two forces or these two mechanisms? We're going to write down a model. And the model, let me just try to sort of first explain what we're modeling intuitively. So an interest rate swap is an agreement between a receiver and a payer. So where the payer pays a fixed rate, we have it like yield swap, so to speak, and receives from the receiver a stream of reference floating rates. Here, LIBOR for LIBOR swap. What the receiver can then do, it can actually short a treasury, so it will be paying the yield on the treasury, and then invest the cash it receives in the funding market, receiving something like a repo rate. The cash flow from this trade is going to be, at every period, the difference between the yields on the swap and on the treasury, as the swap spread, and then the difference between the funding rate. We're going to call this interest rate differential. So here it's a LIBOR swap, so it's a LIBOR rate, and then in the repo market, you get the repo rate. So the difference between LIBOR and repo. Now, if swap spread is positive, this trade is not necessarily an arbitrage. Why? Well, swap spread is positive. We get, can I get, there it is. Swap spread is positive. But this LIBOR repo interest rate differential has historically been, and there are good reasons to assume it is always positive. So this is not necessarily an arbitrage. However, a negative swap spread would lead to a series of negative cash flows, right? Negative swap spread minus positive interest rate differential. So this is sort of a situation where we're going to be trying to model this type of market and this trade specifically. And we will see that in equilibrium, a negative swap spread will arise in our model. So the final bit to this thing is that, so who are these payers, receivers? And we discussed in more detail in the paper, there's been a kind of a big shift in this market. Also, this report by the Treasury Borrowing Advisory Committee provides a lot of information on it, that since the global financial crisis, there has been an imbalance in the demand for being sort of receiving the fixed rate. So here are these end users. They actually enter the opposite of the trade that we saw, on the previous page. They want to receive the fixed rate on the swap, and this TBAC report documents that after the global financial crisis, most major categories of investors became actually receivers. So on net, everyone wants to receive fixed rate in the swap market, and it has to be then absorbed by the intermediary sector, who then can hedge. And we are going to focus in this presentation. The paper has a bit more general focus, but in this presentation, we're going to specifically focus on this regime, where we always have demand to receive fixed, and then it will be accommodated by the intermediary or dealer sector. So how do we model all these different bubbles on the chart? We're going to have in the model two identical securities, fixed income securities. One we call treasury, the other swap. We're going to see in what way they are potentially different or traded differently. There will be a short rate differential, so effectively you can think about this MT as the LIBOR repo spread, and this is the first kind of fundamental shock or structural shock in our model. There will be an end user demand, a preferred habitat end user demand to receive fixed in the swap market. We think about these investors as kind of these long-term investors like pension funds for some sort of regulatory accounting reasons really would like to get into the swap market. We discuss a bit more in the paper what are potential reasons for that, also referring again to the TBAC report. So this demand has some stochastic component. This is the second structural shock of our model, but can also be sensitive to the swap spreads. If swap spreads get too negative, like swaps are really expensive relative to bonds, you may kind of scale down your part, like you may want to substitute into bonds after all. So it's price dependent. And finally, the key kind of group ingredient is this model are the intermediaries who are going to supply the swap, so pay the fixed rate, and then hedge in the bond market by buying the bond. So it's a relative trade between these two securities, and we are ultimately going to be interested only in the relative valuation between the two, which is the swap spread. So these intermediaries are risk averse. They have mean variance preferences. They have a budget constraint where they worry about their kind of realization of their next period wealth. And this realization depends on the return they make on the swap spread trade. So just the one we said, they pay fixed and hedge. And they also have access to some outside investment opportunity, about which I will tell you in just a second. Very importantly, they are leverage constrained. To give rise to a violation of arbitrage, you need some sort of constraint to begin with, although, as I said, there will be more to the swap spread than just the shadow value of this constraint. And this leverage constraint, sort of, their absolute value of their positions in the swap spread trade and in some outside investment opportunities has to be less than equal than their wealth. And here we have a third exogenous shock, the shock to their wealth. That is kind of a supply shock in this model, their ability to supply swaps because of the constraint on their balance sheet. The return on the swap spread, which enters here, has two components. A carry component, they earn the swap spread itself, and the interest rate differential. That's exactly that cash flow that we saw on the chart with all these nicely drawn bubbles. But it also has a kind of capital gain component because it's a long-term swap spread, right? So yes, over one period you make this cash flow, but the valuation of your trade can fluctuate over time. So you see the change in the swap spread, and this term is essentially the duration of your swap. And finally, you also have an outside investment opportunity, with some return and some variance that effectively determines the opportunity cost of using your balance sheet for swap spread trades, as opposed to doing something else with it. Finally, the market for swaps clears, so intermediaries here absorb any end-user demand that comes from these preferred habitat end users. When we take the first order conditions and also impose market clearing, we get that the expected return on your swap spread trade has to compensate you for two things. First of all, compensation for using a scarce balance sheet, which depends on the Lagrange multiplier, the sign of your position, and also the capital requirement for the swap spreads. But also it has to compensate you for risk, because you enter this trade, you are kind of short-term horizon intermediary, and this is a 30-year trade, right? Your investment horizon is much shorter than this. You are worried about the variation in the market, kind of mark-to-market value of your position. So you also have to compensate it for risk. And as you notice, the sign of this compensation, both of them depend on whether you are providing fixed rate swaps or actually yourself receiving. So we're going to focus on only one of the regimes, as I will tell in a second. When we iterate this first order condition forward, we get that the swap spread depends on the expected short rate differential. It's a little bit like in any term structure model. It depends on the expected compensation for scarce capital over the life of the trade, and the expected compensation for risk, again, over the life of the trade. Note that in this general kind of version, it doesn't have to be that the constraints always bind. It doesn't have to be that positions in the swap spread are one sign or the other. It's quite general. It's only important that there will be some demands coming in the future, and you are potentially constrained in the future at some point. And that already gives rise to a non-negative swap spread, even if you ignore the short rate differential, right? If this part is essentially like a cash flow component that is not of major interest, you get a non-negative swap spread if you believe that there will be some fluctuations in demand, and it's risky, and it may make you constrained at some point. However, to kind of do a little bit more from this analysis, we're going to consider a special case of the model. We're going to make a few assumptions just to get a closed form solution to the model. We're going to assume affine dynamics, to get an affine model. We're going to assume that end user demand is positive. So we're really in this post-crisis regime where everybody wants to get fixed rate, to be paid to them, right? So they want to receive fixed rate in the swap market. And we're also going to assume, to avoid nonlinearities, that intermediary constraint is always binding, right? So there will be no nonlinearities arising from the occasionally binding constraint. We can do that, but in this part, it's not going to buy as much. If we make these assumptions, we get that swap spreads is affine in the three shocks of three exogenous processes: the short rate differential, the LIBOR repo, the demand for swaps from all these end users, and the wealth of the intermediaries. Interestingly, so this is how these coefficients are characterized. You see that they all depend on V, where V is effectively the variance of the swap spread return, and V itself depends on the coefficients. As often the case in models with demand shocks, this is a model that has multiple equilibria. And there is a lot of interesting discussion to have about it, but perhaps not in this presentation. What I want to say is that unlike in some of these models, the equilibrium where all the interesting effects that I will talk about now arise in the unique stable equilibrium of the model. Okay, unique equilibrium that is robust to deviations in beliefs by the intermediaries, robust in the limit, and so on. So what are the implications of the model? So if we assume that this is the regime, and let's assume for the moment that this interest rate differential is 0, swap spreads are always negative in the model, reflecting both compensation for balance sheet cost and risk. Moreover, their term structure is on average downward sloping, reflecting specifically compensation for risk. Just balance sheet cost does not generate downward sloping term structure of swap spreads. What do you see in the data? here, the blue line is the primary dealer net positions in treasuries. So if you believe that they do indeed hedge, their swap position in the treasuries market, this would be a noisy proxy for their participation in this type of trades. And as you see, around the crisis, their position switched from being net negative to net positive, suggesting, if you buy that this is a good proxy, that we're indeed in this regime where end user demand is to receive fixed. And as this happened, in line with our model, swap spreads move deeply into negative territory, as we predict. Moreover, we also see a downward sloping term structure that appears. You see that the 30-year is now significantly more negative than the 10-year. And you also see it if you plot the average term structure across different periods, and either for LIBOR swaps, for SOFR swaps, and so on. The second thing, and let me maybe in the interest of time skip very quickly, is clearly a demand-supply kind of framework, right? You have demand shocks and supply shocks, and they can be identified using sign restrictions. Our model actually has a very nice structural AI representation, which basically implies that, an increase in demand makes swap spread more negative, right? You require higher compensation for holding all this demand, and also, well, the position obviously increase. You have a larger short position in this trade. And the supply shock would have the coefficients would not have the same sign. When intermediaries supply more, the swap spreads become less negative. The intermediaries are happy to hold more of this position for lower compensation, while at the same time positions increase. So these sign restrictions allow us to identify these demand and supply shocks. And what you get out of it is historical decompositions of this type. So for example, kind of end of 2014-15, you have a big decrease in the supply, and that coincides with some of the regulatory reforms that happened around the time, SLR finalization, Volcker rule, and so on. But then you see that the subsequent period of very negative swap spreads only in part is explained by this shift in the supply. There has also been, more around 2016, a large increase in demand that helped drive these swap spreads more into negative territory and keep them there for quite a bit. So, it was not just the supply shock. This is the type of result you get out of this decomposition. Finally, let me skip that in the interest of time. These demand and supply shocks have properties that line up with a lot of the things you would like to line up. Let me talk about the arbitrage risk. This idea that it's not only about compensation for balance sheet costs, but also for risk. Already the fact that the swap spreads had a negative slope should tell you that it is there, because this is that risk that generates the slope, not the balance sheet cost. But there are some more specific propositions that kind of rely on the risk, and they are the following. Intermediaries' position should predict return to swap arbitrage. So how much risk, quantity of risk of this trade they hold should predict their return. Demand should matter more than supply for predicting returns, and this is because demand increases balance sheet costs and their exposure, whereas supply increases balance sheet cost but reduces their exposure to risk. And finally, that slope thing that I mentioned in very much Fama-Bliss style should predict returns to swap arbitrage. I would not have told you all these predictions if I haven't verified them in the data before. In the interest of time, well, the primary dealer positions, also their financing of other intermediaries in the repo market, predict returns to swap arbitrage with the right sign. Demand matters more than supply, and the slope is a strong predictor of the arbitrage. Finally, just to mention that this type of analysis also helps explain the relationship of swap spreads, negative swap spreads, in particular to other violations of no arbitrage, such as CIP deviations, and more on this in the paper. So let me conclude, as I'm running out of time. Intermediaries' demand and supply play both an important yet quite distinct role in driving these negative swap spreads. In addition to the balance sheet cost, compensation for arbitrage risk is a key determinant of these violations. And that's once arbitrage kind of spread arises, it becomes a risky thing, and you require a premium for enter these trades. And finally, our framework can be applied to other interesting phenomena in financial markets, such as the CIP deviations and so on. Thank you.
Thank you, Ajay. And now Dimitri Vayanos from LSE will discuss your paper.
Okay. I don't need. I just need to. I don't need a mic or anything. I just speak here close to them. Perfect. Okay. So thanks a lot for inviting me to discuss this paper. So. Okay. So in a nutshell, what it does is that it's a model of equilibrium swap spreads based on limits of arbitrage. So it assumes that there are some intermediaries who are both risk averse and margin constrained. And these intermediaries accommodate shocks to the demand by end users. And in the paper, there is a very comprehensive and informative discussion about what these end users are and what are their demands in practice. So that's the theory part. And then there's an empirical part where the paper uses the model, kind of in a very model kind of structured-based way. It disentangles the shocks to end user demand and to intermediary wealth, or to the supply of this arbitrage by the intermediaries. So, and the way it can disentangle them is because the demand shocks and shocks to intermediary wealth have different effects on swap spreads and on intermediary positions. One shock affects both of them in the same direction, the other shock affects the two of them in opposite directions, prices and quantities in opposite directions. So, I will say a few things about the model. I mean, I did a pretty good job to describe it, so I will be quick. So it sets things up in an infinite horizon in discrete time, and much of the theory is about a perpetual swap spread, essentially the difference between the rate on a perpetual swap, that involves kind of a perpetual stream of payments, and the perpetual bond, the console bond. And the one period return on this trade, on this swap spread trade, is this given by this formula here, this ST minus MT minus this delta over 1 minus delta, ST plus 1 minus ST. So ST is the swap spread, MT is the short rate differential, so think of it as a one period swap spread, and the delta is the duration of this associated to that kind of perpetual trade. So so if MT is equal to 0, then this is in principle a riskless arbitrage, a riskless trade. Okay. So but kind of having MT being non-zero and kind of moving around adds what we would call fundamental risk into that arbitrage trade. So intermediary is the form of overlapping generations. Each of them lives for, I mean, there is one generation at least for one period, and then, or at least invest with one period horizon. They have this mean variance preference over wealth and with risk aversion alpha, and they can invest into two trades. One is the swap spread, and this investment denoted by XT, and the other is this outside investment opportunity that has this return that kind of declines the more intermediaries are investing in it. So, and there is this margin constraint that essentially says that how much investment these intermediaries can do in the two trades is bounded by the kind of times appropriate margins, is kappa, and the kappas is bounded by their wealth. End users have an exogenous demand for this swap spread. So if it's okay, so fine. So this is DT. So for kind of why they may prefer more the swaps relative to the bonds. So the paper derives first of all a nonlinear equilibrium, and the equilibrium is nonlinear because of this margin constraint, which introduces these nonlinearities. However, then it makes a very clever set of assumptions, and then it derives a linear equilibrium, which under these following restrictions, first of all, that DT, this demand for the swaps does not change sign, is always positive. So the end users in net always want fixed, which the paper argues this is what happened after the global financial crisis. Then the second assumption is that intermediary wealth is always sufficient for the swaps spread trade, but it is always insufficient for both trades, the swap spread trade and the outside trade. So under these assumptions, we're always in a region where somehow the spreads, the spread and the position vary linearly with the state variables. And what are the state variables? One is the fundamental, this MT, the one period swap spread. The other is the demand by the end users, the DT, and the other is the intermediary wealth. In particular, when the fundamental is zero, so the, in a frictionless world, there would not be any swap spread because the repo rate, which matters for the trades in the bond market, is the same as the rate on which the swap is based. Then there would, even in that case, there exists an equilibrium where the swap spread is non-zero and moves in response to shocks to demand, in response to DT. And why is that? Because of margin constraints. So this is I think this is a very nice contribution. I would say perhaps this is the most interesting thing from this paper, at least certainly from the theory side of this paper, is that so in general, the way we would kind of think about this kind of arbitrage spreads emerging, sometimes we would take these models with wealth effects and would put margin constraints in them. However, these models generally are non-linear and quite hard to work with. And this paper somehow finds a clever combination of assumptions also together with this linearization, which is not completely innocuous, but I would say is pretty acceptable what they do. And kind of has a nice, beautiful, fine equilibrium out of that, which where both the wealth and the demand is state kind of enter linearly in that equilibrium. So I think that's a very nice step forward in the literature. And also on the kind of on the literature with demand effects, it kind of nicely contributes because all these papers abstract away from wealth effects. So somehow it manages to bring both of them in. So that's very nice. Now, what are the main results kind of conceptually on the theory side, and then it looks in the data kind of through this after establishing these results. So essentially there are three types of shocks. One is a demand shock, the other is a shock to intermediary wealth, and the other is a shock to the fundamental. Now, the demand shock has the following implications. So when there is, so that shock, this is what I spent quite a bit of time describing. The swap spread decreases, so it becomes more negative. It's negative and it becomes even more negative. Kind of it widens. The intermediaries take a bigger position in that trade, try to kind of trade against, absorb the demand shock, and the return on that intermediaries realize by trading on the swap spread increases because intermediaries now have to lean more against the wind, kind of more against the demand. Moreover, in a simple extension of the model to multiple maturities, not just a perpetual swap spread, the slope of the term structure decreases. So it's this decreasing slope that ITEC showed us, it becomes even more decreasing when there is this kind of bigger end user demand for fixed rate. Then, if there is a positive shock to intermediary wealth, then, so intermediaries become richer, then the swap spread increases, so the dislocation becomes smaller, the intermediaries hold a bigger position, and their return on the swap spread becomes smaller, and so does the slope also becomes less negative. So these are the two main shocks. There's also a shock to the fundamental. Let me spend less time on that because it does not appear to matter as much in the empirical part. So yeah, okay. So okay, so the empirical part, okay, so they essentially they look at the data through their model, the lens of their model. They estimate this by varied VAR, and using the fact that the two shocks, the demand shock and the wealth shock, affect the prices and quantities in a different way. So they have a interesting set of results about, for example, that demand and supply shocks approximately explain more or less the same fraction of innovations to the swap spread at a short horizon, although because supply shocks turn out to be more persistent, supply shocks explain more of the innovations at longer horizons. Then, as ITEC said, they correlate with various proxies of demand and intermediary wealth in the way that is kind of roughly intuitive. So I think it's kind of certainly is a fruitful way to organize the data. So let me just, in the little time that I have left, let me say a few suggestions for improvement. So three, I mean, the first one, so how would I try to take this forward? I'm certainly let me say again, I think it's a very nice framework that they have come up with that allows for both shocks to demand and intermediary wealth, and in a very tractable way. Now, these shocks are assumed independent. So I think that it would be nice to look a bit more into, think a bit more about what is kind of what is inside the black box. First, for one thing, the theory says that should say that in principle there should be some mechanical correlation, even if just because if intermediaries absorb the demand, whenever the demand increases, if you trade against the spread, if there is kind of bigger demand causing the spread to increase, then you lose money. So there is a mechanical should be a mechanical correlation between wealth and demand. Now, of course, there are other things happening in the market. There are other trades that intermediaries are doing, and it would be nice to think more generally how this. How the arbitrageur wealth and how shocks to demand correlate with everything else that arbitrageurs are doing. And in principle, maybe what happens to this swap spread is is a positive beta trade for arbitrageurs, or is a negative beta trade for arbitrageurs, and how does this affect its pricing? So I think it would be nice to dig a bit more into that. The other kind of suggestion for improvement is to look a bit more comprehensively through the term structure. Essentially, most of the paper, and the authors are very clear about this, assumes that there is just one single maturity, kind of this perpetual swap spread. It would be, they talk a little bit about the idea that in kind of the term structure of swap spreads could be driven by other forces at different maturities, different forces at different maturities. And I think it would be nice to look a bit more into that, perhaps in follow-up work. This, among other things, one we would have to think about how does the margin for the swap trade depend on maturity. And then sometimes I would say try to bring the empirical part even closer to the theory. Some places they do a bit of hand waving, saying that somehow we don't find this result, but could happen for some reasons. Anyway, I would say that they could take their model even more seriously. It's a very nice contribution, and I think they kind of can even give it kind of more of a push kind of to kind of say how it would fit some aspects of the data even a bit more. So that's it. Thanks very much.
So if you want to take a couple of minutes to respond, and then we'll see. We're quite out of time, but yeah. Please.
Yeah, certainly. I'll keep it quick. I mean, thank you, Dimitri. This is a very useful, very great discussion and very useful comments for us, especially, as you say, on improving the theory part. I mean, I think all of them is a great to-do list for us, and particularly the part on endogenizing wealth, right, and having it more like as an exogenous process. I think that's something we've been thinking and trying to find good ways to do it to keep the structure tractable. And obviously, we also wanted to discuss it with you and see if you have any ideas how to do it. But yeah, I think yeah, it's a great list of things to put on our table and look into. Thank you very much.
So should we first, I don't know if there's a question from the floor that we want to take briefly before we conclude. I guess the last session of such a packed conference is always a bit, so maybe we'll thank you, and also Nina and Anton. And I'll hand over to Evelyn and David for the concluding remarks of this conference.
Well, let me just introduce Professor Evelyn Welsh, Senior Vice President of King's College London, to say some closing remarks.
Thank you. And this is where we definitely bring the theory and the empiricism about how long can we talk between you, the view, the drinks, the end of this amazing event. And I'm so pleased to be able to offer a few remarks at the end of this wonderful in-person conference. And to thank all of the organizers, all of those involved in making this such a success. I know that you've learned a great deal over the past 2 days about the issues currently facing central bank policymakers and, by extension, all of us. And as an interested observer, rather than a specialist in monetary economics or central banking, although do read my piece on how money works in 15th century Florence, and I find it striking how rapidly the world has transitioned from a state which I first discussed with the governor of the Central Bank of Qatar about 5 or 6 years ago, where there were serious fears of severe depression, and the #1 topic was negative inflation. I don't think I wish that those days were back, but it is remarkable how you think you're going in a sudden direction and then it flips. We are now having alarms about inflation and overheating. And this really underlines for all of us how difficult it is to stabilize a system as complex as the economy, local, national, or global. And perhaps we, the general public, and some media commentators need to be more realistic about the terms of what we can expect from our central banks. And occasionally, just occasionally, even say thank you to those who are managing this economy for us. And even if our media commentators don't say thank you, please allow me to do so. A key question that emerged from the discussions is to whether or not we've reached a critical turning point. Have the favourable tailwinds that have supported low inflation and strong economic growth in recent decades, globalisation, increases in labour supply, now shifted decisively with a much choppier outlook for the global economy in the years ahead? And it's an enormous pleasure, even though the questions are complicated, to know that we're addressing that within the context of a university that not just has amazing economists and mathematicians and central bank monetary theorists, but also colleagues in war studies and international development who can help us understand those global shifts, much of which are political as monetary. And then another theme of the discussion today, which was certainly one that the governor of the Central Bank of Qatar was interested in, was the ongoing digitalization of our economies, and in particular the development of private and public digital currencies. Transformations in money and payments are of course not new, and the trust that lies behind them is centuries old. But the introduction or not of a central bank digital currency will have profound implications for banking systems and for countries' ability to exercise the same degree of control over their currencies as is the case now. And anyone who wants to ask me about money clipping in 15th century Florence is very welcome to do so. So this is a debate we'll clearly be hearing much more about in the years ahead. So let me end by saying that conferences like this have a vital role to play in bringing together that theory and practice, that empirical data and those mathematical models, to bring together academic researchers with practitioners to share insights and to learn from each other, helping us bridge that gap. I'd like to finish with a big thank you to David, to the team in the Qatar Centre for Global Banking and Finance, for all of those at the King's Business School who have made this event possible, and to all of you for contributing so effectively. So with that, I'll pass back to David for the very final word. Thank you very much on behalf of King's.
Thank you, Evelyn. And that thanks should really go to Francesca and Reese, who are responsible for the fantastic programme you've enjoyed over the last 2 days. I just want to thank you all for everything you've contributed over the past 2 days. I think it's been a really fruitful discussion. As ever, when you run events like this, there's an army of people in the background who are actually responsible for making sure it goes smoothly on the day, and I think we should just remember those guys. So particularly Megan and Jacinta from the Conference Collective, who handled a large number of your travel and hotel arrangements, so big thanks to them. I'd also really like to thank Ruth and Catherine, who handle the comms for the Qatar Centre, so thank you guys. And really above everyone else, Tom, who is lurking in the shadows here, but is the key person to make sure events like this actually run smoothly, so thank you very much. So you should correct me if I'm wrong, Tom, but I believe, so we have coaches, so people who are joining us for dinner at the Gherkin, we have coaches leaving in about an hour, 6:30. So you've got a little bit of downtime now if you want to go back to the hotel and freshen up, or if you just want to hang around, and teas and coffees are on the 8th floor. See you in about an hour. Sorry, sorry, I knew I was going to forget this. We are really interested in your feedback on this event. We want to run this again, on an annual basis. There are some QR codes, Francesca is telling me, where you can,
on the way out of the auditorium.
as you leave the auditorium, so if you take a little photo of it with your phone, it'll open up a little feedback form with just a couple of questions. So if you've got any kind of positive or, suggestions for the future, we'd be super keen to hear them. Thank you all.